Good morning and welcome to day 2 of the RedChip Global Online CEO Conference. I have another full day of presentations for you today. Up first, we're going to go to a keynote presentation by Dr. Ram Selvaraju of Aegis Capital. He's Director of Research at Aegis Capital. He's going to talk a little bit about the state of the healthcare sector right now. So we're going to start off with that. I want to remind everybody throughout the day, if you have questions for any of our presenting companies, please submit those questions as soon as possible. We'll get those answered on a first-come, first-served basis. We will not be having a Q&A for the keynote, but we will be having a Q&A with the first presenter starting at 10 a.m. And with that, we'll get started now. Again, our first presentation is our keynote from Dr. Ram Selvaraju of Aegis Capital, Director of Research.
Hello, my name is Ram Selvaraju, and I'm the Director of Research and Head of Healthcare Equity Research at Aegis Capital Corporation, a full-service investment bank headquartered in New York City. It's my great pleasure to be giving the keynote address at this year's RedChip virtual conference. Founded in 1984, Aegis Capital has been serving retail and institutional investors for the past 30 years. The firm focuses on small and microcap companies, and we have pinpointed emerging trends in healthcare, energy generation, and technology, media, telecommunications, particularly cybersecurity, as particularly likely to deliver rapid growth in the foreseeable future. In this context, we are deeply appreciative of the work RedChip does every year to spotlight and showcase emerging growth companies. Aegis Capital was responsible for raising over $500 million for U.S. corporate issuers in 2013 alone, a year in which the firm was ranked first among investment banks for U.S. equity underwritings totaling up to $50 million in size. During 2013, Aegis completed 28 deals as the left lead book running manager, and since establishing an equity capital markets division in late 2011, has been the sole book runner on 14 initial public offerings, or IPOs, in the healthcare space. The healthcare sector is of paramount importance to our equity capital markets effort. We are the leading boutique investment bank for healthcare-focused IPOs, and we're also very active in the secondary market. With over a decade's worth of experience on Wall Street as a sell-side analyst, I currently cover more companies than any other analyst, with 50 names under coverage, and our equity research platform is one of the most highly respected in the industry, spanning the sectors of biotechnology, specialty pharmaceuticals, established pharmaceuticals, molecular diagnostics, and medical devices within the context of the healthcare sector. Biotechnology is both one of the most lucrative sectors in the market and one of the riskiest. The results of a single drug trial or a single FDA decision can dramatically alter the fortunes of a company and its stock. Investing in biotechnology stocks carries some unique risks not present in other sectors. While the sector can be viewed as defensive from a macroeconomic perspective, given the ever-present need for new medicines, fundamentals of biotechnology firms matter to a degree not seen in any other sector. We think the biotech sector is a great domain to invest in for a number of reasons. Firstly, the sector has a number of defensive characteristics and enormous growth potential. In addition, large pharmaceutical companies are constantly looking for acquisition opportunities in the sector to replenish their pipelines and provide additional upside. However, there is also the possibility of binary event risk, and as such, risk mitigation strategies should always be taken into account. We believe that it is often prudent to trade stocks in the sector in pairs. We can always look at companies that are both in development as well as companies that already have drugs on the market. The difference between large and small companies is that each drug in development means much more or less to each company depending on its size. The opportunities also carry far greater profit potential. One of the reasons why the microcap and small cap sectors are so important is their prospects for growth. It is much more common to find a company that can grow from a $40 million market cap to a $400 million market cap than it is to find a company with a $40 billion market cap that can still grow to a $400 billion market cap, yet the portfolio return is essentially the same. While the risks are substantially higher, we believe that looking for investment opportunities in the small and microcap sectors can be far more lucrative than focusing solely on the large cap space. In addition, there are ways to effectively mitigate the risks associated with investing in small and microcap healthcare-focused stocks. Firstly, appropriate screening techniques must be utilized in order to pick stocks effectively, and insistence on solid management, preferably with a demonstrable track record of substantial success, cost-effective and capital-efficient operations, multiple shots on goal, solid clinical data, and reasonable valuation relative to peers are all important. Second, the pairing approach allows us to identify companies that may or may not necessarily be first in class, but can follow larger firms down an established clinical pathway and bring a best-in-class drug to market. This is what we like to call the fast follower approach. Finally, a diversified portfolio approach works best. Rather than putting all of one's eggs in one basket, we advocate investing simultaneously across multiple areas within the healthcare sector. This is particularly important when considering the impact of recent developments on a macro scale, including, for example, the advent of healthcare reform policy, as has been embodied by the recent enactment of the Affordable Care Act, colloquially known as Obamacare. I'd like to provide you with some sector perspectives, both from the context of the global financial industry as well as within the context of the healthcare sector as a whole, so we can see where we're at. Essentially, it's a bit of a State of the Union kind of summary here. The global financial industry continues its recovery apace from the worldwide financial crisis of 2008 and 2009. In the U.S., we're currently in a situation where financial markets are at or near all-time highs with respect to equities. U.S. stocks have risen recently amid a plethora of favorable macroeconomic data, including a decrease in unemployment to 6.1%, rapid gains in home construction, and solid operational performance by U.S. companies. Roughly 71% of S&P 500 companies reported first quarter 2014 earnings that beat consensus estimates, with 55% of these companies surpassing revenue forecasts. The U.S. Federal Reserve continues to be accommodative as well. While it remains committed to winding down the quantitative easing program, reducing bond purchases by another $10 billion at its most recent meeting, the Fed has reiterated its commitment to keeping the federal funds rate near zero for what it calls a considerable period of time, after its bond purchasing program has been completely wound down. The IPO market also remains healthy despite greater price sensitivity among investors. We believe that all of these macroeconomic factors are important to consider when looking at opportunities within the healthcare space. Turning our attention now to the healthcare sector, there was a pullback of approximately 15 to 20% across the board among biotech stocks that lasted from mid-March through early May of this year. This was primarily catalyzed by a publicized letter sent from Congress to the biotech bellwether firm Gilead Sciences, ticker GILD on the NASDAQ, asking for justification of Gilead's decision to price a new drug for hepatitis C infection, Sovaldi or sofosbuvir, at $84,000 per patient on an annualized basis. The letter sparked concerns among investors that imposition of broad-based pricing controls on specialty drugs might be the next step taken by Congress. However, although Gilead's response to this letter has never been made public, it now appears clear that the pricing for Sovaldi is justifiable, considering the pharmacoeconomic benefits of the drug. Among other things, the interferon-containing regimens that Sovaldi replaces effectively carried an average price tag of over $120,000 per patient annually, meaning that Sovaldi, despite its high cost, actually saves the U.S. healthcare system money. Currently, IPO filings are at an all-time high, and several recent healthcare IPOs have performed well. Aegis Capital recently took Globimune, traded on the NASDAQ under the ticker symbol GBIM, public, and within less than a month of the pricing, the shares have appreciated over 40%. Globimune currently trades at a market cap of roughly $80 million. While we have always been convinced that healthcare stocks would be hard-pressed to repeat the heady performance of 2013, when various healthcare indices rode by a factor of 40 to 60%, we believe that the long-term growth potential of this sector surpasses all other verticals. During June 2014, the U.S. biotech indices rallied strongly, with the BTK and NASDAQ Biotech Index, or NBI, both up by 7.3%. They are now up by 18.1% and 12.6% year-to-date respectively, and up 30.2% and 35.8% respectively over the past 12 months. Within the healthcare sector itself, there have been several developments over the course of the past several years that, in our view, represent substantial grounds for optimism. Firstly, the enactment of the Affordable Care Act, or ACA, colloquially referred to as Obamacare, has created multiple new avenues for growth among healthcare-focused companies. This is not limited to firms focusing on drug development and commercialization. Rather, its broader effects are being seen in areas such as diagnostics, health insurance, healthcare information technology, or healthcare IT, and healthcare services. Thus far, Obamacare has claimed at least 8 million new subscribers to health plans provided under the new act. In addition, this new legislation has provided greater incentives on preventive detection of underlying disease conditions, preventive medicine, and personalized therapy, also known as specialized therapy for specific patient subpopulations. Second, we would point to a newly optimized environment at the U.S. Food and Drug Administration, or FDA. Since the promulgation of the FDA Amendments Act, or FDAA, in 2007, the principal regulatory agency responsible for the approval and post-marketing assessment of drugs in the U.S. has become increasingly risk-tolerant. The number of drugs approved in 2012 and 2013 reached all-time highs, with 39 new molecular entities, or NMEs, approved in each year. That's approximately 63% higher than the average of 24 NMEs approved per year from 2003 to 2011. For several years, the FDA acted in an extremely risk-averse manner, particularly after the fallout from the Vioxx disaster that occurred in 2004. However, with new risk-mitigating strategies in place, and with all NMEs requiring review by an independent advisory committee prior to an approval decision, the FDA finally appears to have arrived at a happy medium between carefully considering the risks of new drugs while approving effective and safe new products in a timely manner. Examples of the agency's more expedient review processes include breakthrough therapy designation, in which a drug that provides a potentially life-saving benefit for a significant unmet medical need and is clearly superior to standard of care can actually achieve approval within as little as 3 months of submission. The fact that the FDA has become more risk-tolerant and clearly is now approving drugs that ought to get approved is a crucial factor in influencing investor sentiment in the healthcare space. We would finally draw investors' attention to the fact that the current market environment differs markedly from that seen in the 98 to 2000 biotech boom years, which paralleled the emergence of the dot-com boom and internet bubble, and in which companies essentially took off with virtually no business plan and only uncharacterized genomic sequence data to go on, which had been generated in the wake of the completion of the sequencing of the human genome in the year 2000. In the current context, by contrast, companies have encouraging clinical data, often in disease areas that were previously considered untreatable, like metastatic breast cancer or prostate cancer, and in many cases have successfully launched drugs on their own and demonstrated the ability to attain sustainable profitability. This is also a very encouraging new development. Unlike in the past, when development stage companies were dependent on larger, more established firms to either partner with them or acquire them in order to ensure effective commercialization of their innovative products, emerging firms of today are much more focused on niche markets. These can be targeted with far smaller sales and marketing infrastructures, requiring much less dependence upon partners to achieve commercialization. In addition, many emerging companies are focusing on being shareholder-friendly. Their executive teams are compensated on a performance basis, they engage in effective tax management strategies, and they are constantly seeking ways to optimize the value of the assets that they hold. Investors are also being far more discriminatory than they were back in 2000. In today's world, very few highly speculative companies, which expose investors to undue binary event risk, are able to receive funding. We believe, for example, that the massive pharmacopoeia of existing drugs provides ample room for optimization through innovation. Why reinvent the wheel by trying to discover entirely new drugs when repurposing or reformulation of existing agents can work just as well? The FDA has even created a special pathway for drugs that embody this more risk-mitigated approach, which is known as the 505(b)(2) approval route. Using this approach, drug developers can take an existing marketed drug and develop it in a new indication or using a new formulation, while benefiting from a more rapid review process because the active pharmaceutical ingredient, or API, is already on the market and possesses a well-established safety profile. I'll turn now to a brief discussion of deal activity in the healthcare space, which has been an area of much attention over the course of the past few quarters. One of the core drivers of valuation metrics in any given sector is transactional activity and the points at which such activity occurs. We are fortunate indeed to be witnessing an unprecedented surge in deal activity within the healthcare sector at this point in time. Average pharmaceutical M&A transaction values have been steadily increasing since 2009, and from $39 billion reached in that year to roughly $74 billion in 2013. The deal activity has been increasing across multiple segments of the healthcare sector and encompasses large-cap pharmaceutical firms swapping divisions, a la Novartis and GlaxoSmithKline, specialty pharmaceuticals firms gobbling each other, such as Actavis taking over Forest Labs, large biotechnology companies swallowing smaller ones, such as Celgene buying Acetalon, large pharmaceutical companies acquiring smaller biotech companies, exemplified by the acquisition of Ceragon Pharmaceuticals by Roche for a total deal value of $1.725 billion, with $725 million being provided up front, and multiple transactions aimed at mitigating tax burden, such as the acquisition of QLT Pharmaceuticals by Auxilium and the recently announced acquisition of Cosmo Technology by Salix Pharmaceuticals. Large partnerships have also occurred, including the link-up between Nogra Pharma and Celgene, which carried an upfront payment of $710 million, the partnership between Oncomed Pharmaceuticals and Celgene, with an upfront payment of $155 million and total potential future deal value in excess of $3 billion, and the tie-up of Lundbeck and Otsuka involving an upfront payment of $150 million and total deal value of $825 million. Partnership deal values have risen substantially in recent years, with the upfront payments for even relatively early-stage drug candidates having risen dramatically. Clearly, we can see that if larger companies see substantial value in early-stage science, they are more than willing to open their pocketbooks. We consider these developments to be key to future growth in the sector and willingness of investors to deploy capital in this space, since these kinds of transactions serve as benchmarks that capital providers typically expect to obtain for future exits. Now a word on stock selection. At Aegis Capital, we believe in identifying companies that pursue product development within the context of the healthcare sector in a judicious, risk-mitigated, and cost-effective way. In order to illustrate how we are attempting to redefine the healthcare investment paradigm, consider the following. Typically, in the past, it was considered de rigueur for companies to define the cost of developing a new drug from concept to market as somewhere in the billion-dollar range. In addition, it was believed that the time required to take a new drug from lab to patient bedside was in the 10-year range. Since the typical approval percentage rate for new drugs at the FDA has historically hovered between 15 and 20%, we believe that asking investors to swallow such a business model, i.e. invest $1 billion over 10 years and only have a 15 to 20% chance of ultimate success, is utterly indefensible. Instead, therefore, we have focused on companies that pursue product development and regulatory approval via the 505(b)(2) pathway, firms that have proven themselves adept at doing drug development and research with non-dilutive funding, particularly as it has been shown that the most innovative products have actually often been identified by government researchers using government funds, and that they require subsequently companies to take them to the next stage. And we also focus on companies that are developing products with very different risk profiles to those of innovator drugs. For example, medical devices, which typically follow a much shorter and less expensive path to product approval, and molecular diagnostics, which can be commercialized as laboratory-developed tests, or LDTs, without requiring formal FDA licensure, as long as the labs from which these tests originate do have FDA approval. Simply because we are focusing on risk mitigation for our investors does not mean in any way, shape, or form that we eschew innovation. On the contrary, we embrace it as a key and crucial component of the future of the healthcare sector. Many companies that are presenting at RedChip's virtual conference exemplify this focus on innovation. There are many diseases that remain completely unsolved today. To name a few, glioblastoma multiforme, which is a particularly aggressive form of brain cancer, ischemic stroke, Alzheimer's disease, and others that are woefully poorly addressed by currently marketed treatments, such as diabetes, pancreatic cancer, and ST elevation myocardial infarction, or STEMI, a particularly severe form of heart attack. Accordingly, new classes of therapeutics and devices and new ways of preemptively diagnosing these conditions will need to emerge in order to provide us with true advances in healthcare. Existing drugs such as organic small molecules, secreted proteins, and monoclonal antibodies cannot do the job alone. We are, therefore, extremely interested in advances within the fields of RNA interference, gene therapy, cell therapy, stem cell-based medicine, personalized cancer immunotherapy, armed antibodies, next-generation sequencing, and quantitative proteomics. The RedChip virtual conference is showcasing many of these cutting-edge innovations in the form of the selected presenting companies. Examples include Actinium Pharmaceuticals, ticker ATNM, which has developed novel radioisotope-armed antibodies to treat various forms of cancer; Acres Biosciences, ticker AKER, a recent Aegis Capital-led IPO, which has developed a suite of proprietary diagnostic point-of-care tests that provide rapid answers in the context of breath alcohol detection, heparin allergy detection, cholesterol monitoring, and various other modalities; Cancer Genetics, CGIX, which is a leader in the field of high-content molecular diagnostics that have proven prognostic and theranostic, i.e. paired with targeted therapy value, and which was an IPO that Aegis successfully consummated last year; Neostem, ticker NBS, which is developing cell therapy-based solutions for unmet medical needs such as ST elevation myocardial infarction, as mentioned earlier, or STEMI, type 1 diabetes, and malignant melanoma; and Opexa Therapeutics, ticker OPXA, which is developing a novel, personalized medicine-based approach to solve the unmet medical need of secondary progressive multiple sclerosis, a progressive, highly debilitating disorder that affects mostly younger individuals. At Aegis, we are proud to stand with RedChip as they showcase the innovators of tomorrow. A few key takeaways. We are living in exciting times. Innovation and accelerated clinical development in the healthcare sector has never been more dynamic or productive. Furthermore, over a decade after the sequencing of the human genome, an in-depth understanding of the nature of genetic interaction and protein regulation, as well as the systems biology underlying genetic networks, is finally beginning to translate into meaningful advances in diagnosis and treatment. Accordingly, therefore, we believe that the healthcare sector may provide some of the most compelling investment opportunities that investors are likely to see over the course of the next decade, and indeed beyond. We would also remind investors that the only truly priceless commodity for the human race is time, and that only advances in healthcare can translate into more time on an absolute scale. Thus, even in a resource or capital-constrained environment, we anticipate that healthcare innovation is likely to continue to preferentially attract investment. In a sense, there is no alternative and no substitute. Most analysts believe that healthcare spending will continue to rise at least as fast as gross domestic product, or GDP, over the long run. So the question of whether that response takes place over 5 years, 10 years, or longer is not that important in thinking about the long-run trajectory of healthcare spending. We are left with the same set of unanswered questions that have been plaguing forecasters for decades. When and how will excess cost growth in healthcare spending slow? It is clear that it is the combination of technological innovation and a continued willingness to pay for that technology that has allowed healthcare spending to rise faster than income growth for so long. For example, without the dramatic decline in the share of health expenditures paid out of pocket, many Americans today would simply not be able to afford new technologies when they become ill. It is inevitable that this willingness to pay will diminish at some point, but we have very little ability to predict this trajectory. What is clear, however, is that technological innovation across a multitude of different fronts is going to be necessary in order to mitigate the impact of continued increases in healthcare spending. We note that there remains massive wastage in the U.S. healthcare system, and that substantial cost savings could be unlocked simply through the creation of more efficient processes, such as allowing health insurers to compete across state lines. In addition, the pressures of cost containment and healthcare delivery acceleration should create even more opportunities for investment in firms that innovate on this front as well. Thanks very much, and please look forward to what we expect and believe will be an extremely exciting conference.
Okay, we were just listening to Dr. Ram Selvaraju, Director of Research at Aegis Capital, and we'll be moving on to our first presentation, company presentation for the day with Bitcoin Shop. CEO Charles Allen will be presenting. Ticker symbol is BTCS on the OTCQB, and that'll be coming up at 10 a.m. Eastern. I want to remind our viewers, if you have any questions for any of our presenting companies, you can enter them at any time throughout the day. We will take those on a first-come, first-served basis. You just click the submit question box, enter your question, select the company it's for, and we will get to those as we can. Again, our first presentation for the day is coming up with Bitcoin Shop, Charles Allen, CEO, presenting. That'll be starting at 10 a.m. Eastern. start our first company presentation of the day with Bitcoin Shop. Charles Allen, CEO, presenting. The ticker symbol is BTCS on the OTCQB. I want to remind our viewers, if you have any questions for our presenting companies, please enter them at any time, clicking the submit question box. Also, if you'd like to stay up to date on additional information for any given company, you can always enter your email in the box provided below the presentation. And with that, we'll get started with our presentation from Bitcoin Shop with Charles Allen, CEO, presenting. Thank you again for joining us today.
Good morning. My name is Charles Allen. I'm the CEO of Bitcoin Shop, and I'm going to give you an investor presentation today. So let's start by taking a moment and looking through our safe harbor statement. I'm going to cover a few key areas today. First, our investment highlights, then walk through both the industry and the market overview that covers our company, do a corporate overview, and then a summary. So today, looking at the investment highlights slide, Bitcoin Shop, we're an early mover in the virtual currency ecosystem, and we're one of the first publicly traded companies in the space. We plan to use our e-commerce platform as an on-ramp into the virtual currency ecosystem. Right now, we offer 140,000 products and plan to expand that by connecting to other vendors. We are not involved in the logistics or supply chain. We leverage our vendors' resources, and we're very excited about the opportunities within the virtual currency space. The regulation is developing in a very positive way. And as one of the first public companies in that space, we're very excited for the future. So to start moving on to the industry and market overview, obviously the e-commerce market is a huge space. It's anticipated to be almost a $260 billion forecast in terms of retail sales for 2014. That's kind of the highlight on that slide. Looking at slide 7, for those of you that are not familiar with the Bitcoin ecosystem, there are a lot of different players in the space, and they can be basically carved up into a couple different buckets. There are companies that provide universal services such as Coinbase and Circle and now even BitPay. And then there are different smaller kind of silos such as mining Bitcoins, wallets that help you hold Bitcoins, exchanges that exchange Bitcoins or other virtual currencies for dollars, payment processors similar to what's happening in the traditional space, such as Square or PayPal, and the players in that space are GoCoin and BitPay and the like. And then there are financial service players such as ATM manufacturers, prepaid debit cards, and a lot of other businesses that are moving in. If you look at moving on to slide 8, there's been a lot of VC money moving into the virtual currency space. It's primarily been focused from a dollar amount on players that are active in kind of the universal space, trying to connect many components of the ecosystem to provide a one-stop solution for their customers. Moving along the landscape of virtual currencies, Bitcoin is currently the largest virtual currency in the market today. There's others such as Litecoin and Purecoin and Next that are also there, but they do not have quite the same following as Bitcoin. Moving on to slide 10, the acceptance of virtual currencies is coming a long way. I mean, there's been developments even since this presentation, such as in Canada. It's now they've given guidance on what you need to do to operate in certain areas of virtual currency, and that it falls into a money services business. So, we believe that as adoption and regulation come, guidance starts to become clear, there will be more opportunities within the space. When we think about the ecosystem for our business in general, we think the companies that provide universal solutions will be those that have the most growth. Companies that only provide single solutions such as a wallet, exchange, prepaid debit card, we feel that those are just they're really products, they're not businesses, and the ones that will survive will be the ones that are able to do everything in an elegant and efficient manner. So let's talk a little bit about Bitcoin Shop and our company. So today what we currently do is we connect to Amazon through their affiliate program and resell their products with Bitcoin. That really is a short-term solution to a problem, not necessarily a long-term business. So we've spent the last 6 months since we raised capital working on building out our business. So if you look at what we've done to date from a growth strategy, our number one goal has been development. This is on slide 14. we've been focused on adding more vendors, integrating new service offerings, and developing basically a single account ecosystem. So that's where our development is. After we're done kind of getting our development done, we plan to move on to customer acquisition and monetization. So those are the three focuses of growth. On the e-commerce side, we view what we currently have as kind of a solution to a problem, but not a long-term business. But what we're building, we're very excited about. So by connecting through affiliate programs, we believe there's a tremendous amount of products in the millions that we could offer to consumers, and we can do that in an automated way. Almost a good analogy would be trying to build the kayak of e-commerce, which no one has done yet. And in doing that, if you were to take Bitcoin away and we were just to accept credit cards as an example, we believe that would be a standalone business model compared to our current website today. So this is where our core focus has been on the e-commerce side. We're researching drop shippers so we can go direct to those groups. And we're in ongoing discussions with some manufacturers and potentially trying to get some exclusive products to offer on our site. Those we believe will be much higher margin and will, hopefully be, we're trying to target products that we believe will be in high demand and have a lot of customer interest to drive customer acquisition for us. On the development side, we are internally doing our beta testing. That started just a little while ago. We've completely redone our front end. The back end architecture is completely redone. We basically started from scratch, and we're looking to diversify our customer base to around over 10 vendors and into the millions of products. Looking at our kind of key accomplishments and the timeline, our company was just founded in June last year. Since then, we launched our website in September, followed up by kind of expanding the management team in early January, closing just under $2 million financing in early February. We're a strategic investor in GoCoin, which is a payment processing company similar to like a BitPay, except they also take Litecoin and Dogecoin. I'm also on the advisory board there. They're our payment processor as well. We've integrated with them. We've brought on Markham as an accountant, as we feel that it's important for the public shareholders to have a good confidence in our financial reporting. And we started our internal beta testing in May of our new website, and we're hopefully we'd like to turn the beta on to the public when ready. Just looking at the non-financial metrics, as I said earlier, that our core focus has been on development, not growing metrics, but we are seeing reasonable growth in both in site traffic, registered users, products sold. Obviously, in e-commerce, the fourth quarter is when any company in this business expects the largest sales. Looking at some of the industry comparables, and this is quite interesting. BitPay, a payment processor, just raised $30 million at about $160 million pre-money valuation. Coinbase raised $25 million at $125 million valuation. Not sure what Circle's valuation was, but they raised $17 million. And where we are, we having an investment in the payment processor, integrated with the payment processor, we believe that, based on what these companies are doing, our valuation is a very good investment opportunity. And most of these companies are looking at the universal play as well, with BitPay now announcing that they're going to create a multi-signature wallet. Coinbase has moved into having a payment processor. And I believe Circle is trying to do everything, but they haven't fully disclosed exactly all the details of what they're doing. Moving along to slide 20, which is our corporate structure, where the parent is Nevada Corp, which owns 100% of our Bitcoin Shop LLC, which is our e-commerce operating subsidiary. We have minority investment in GoCoin LLC, and we've created a little acquisition company to look at potential investment opportunities or deals in the future. Looking at our cap table, we have about 140 million shares of common stock outstanding. Management owns about 100, which is subject to a lockup agreement. The public float's about 38 million shares. And we have Series B and Series C preferred stock, which have basically no rights. And we have no debt, so we have a very relatively clean capital structure. moving along our management team, is I'm running it. My background is, I'm an engineer by background, have my MBA, worked in investment banking for about 10 years. Michael and Tim are both, are head of our technical team, and both have backgrounds working for NASA. And Charlie, who runs our marketing strategy, has, a very extensive background in business development and marketing. So we have a very small, tight team that we believe is highly efficient. So we're excited about our management team. So in summary, we're one of the first movers in the virtual currency ecosystem. We're obviously one of the few, actually pretty much the only really investable public company in the Bitcoin space. And what we're planning to do is to build this ecosystem where, as I said in a few of the other slides, being a universal player is kind of where we want to go. And I'll take this opportunity to talk a little bit more about that. We recently closed on an investment into ExpressCoin, which is it's a private company that allows for users to buy and sell Bitcoins. We believe right now is a marketplace that only accepts virtual currencies. For users to be able to use that system, we need to get them an effective way to get Bitcoins or Litecoins or Dogecoins. And by partnering with a group and integrating with a group, or planning to integrate with a group that can allow us to seamlessly provide a way for our users to acquire Bitcoins is key to our growth strategy. And the first step in doing that was to make an investment into ExpressCoin. So we've made a $150,000 investment into the company. We've also been given an option to invest another $1 million into the company at the same valuation. That option is good for about 3.5 months. So the $150,000 will give us about 2% of the company. And it's a $9 million pre-money value. So it's obviously a much lower valuation than our company at this juncture in the public markets. And they are seeing, tremendous growth and adoption. So to be able to, one, have an investment, to have the option to invest up to $1 million more at a future date, and I'm sure they will grow. We hope they will grow in the coming months. Is a great exposure for our shareholder base. We also have the option to invest with Bitcoins, so we can, when that, if we do plan to exercise that option, we could do it with either cash or Bitcoins, which will be, a first in the industry. So that's a very nice recent development that, when we look at how we can, grow our business, that's kind of a first step. As is really the only public company, we see a lot of ways to partner with other groups in terms of how we grow. So our options for growth are both are a couple-fold. One is through organic growth. Another is through mergers and acquisitions, which is obviously premature for a company of our size at this juncture, but it's definitely something that we think about and look at, and evaluate opportunities in that space. And then the third is to partner with other companies such as ExpressCoin and GoCoin. So now we're the lead investor in both of those companies in the last rounds, and we'll be integrating with both of those companies. And we believe that will be key to our growth strategy as we need to, as we look to compete to some of the bigger players in the space that I previously mentioned that have raised more sizable financing rounds. So I think that is a pretty good summary of what our company is doing today and where we're looking to go. And at this point, I'd like to open the floor up to any questions that listeners may have.
Okay, we're going to open the line now for our Q&A session with Bitcoin Shop. We have on the line with us CEO Charles Allen. Welcome, Charles.
Good morning. How are you doing?
Very good. We'll get started. We have several questions that have already come in. I want to remind our viewers, if you do have a question, please click the submit question box and enter that in, and we'll get to those as we can. Our first question, Charles, how do you view further Bitcoin adoption as a driver for your business?
We believe that as Bitcoin continues to grow, it will help our business. There's a few key elements driving adoption. One is as more retailers start to accept Bitcoins, it means more people will be interested in having them. It means there'll be more services, both to exchange dollars for Bitcoins or euros for Bitcoins, as well as wallet services. So we think that will help drive growth. Obviously, helping people get Bitcoins is a key factor in providing in making it easier for people to use our site. That's one of the reasons why we invested in Express Coins. Right now, people come to our site because we don't take credit cards at the moment. They need a way to get Bitcoin. So once we've the plan is to integrate with Express Coin, then we'll provide them a way to get Bitcoins. So that I don't know if that helps answer the question, but we see adoption is coming.
Very good, thank you. And our next question, how would adding additional vendors affect your revenue and your margins?
Well, I think it's less about affecting revenue and margins. Right now, through affiliate programs, there's kind of a range of commissions that can be anywhere from 5 to 15%. Sometimes it's as low as 2. Sometimes it's slightly higher. The reality is our website, as you see it today, is just a solution to a problem that no one accepted Bitcoins. What we're building is the ability to connect to numerous retailers, and by doing that, we're effectively creating a kayak or Travago of e-commerce, which no one has done. So there's a compelling reason to shop on our site. In the event we said, okay, let's not accept Bitcoins and just accept credit cards, there needs to be a business there that makes sense. And we believe by having that kind of kayak of e-commerce, by finding the best price for the consumers across numerous vendors, that should be a solution that would survive outside of Bitcoin. You add Bitcoin on top of that, and it is a great on-ramp to drive virtual currency adoption. And if we're integrated with Express Coin and we're integrated with GoCoin, and as we continue to look at opportunities to be a universal service provider within this space, we think that that will be the driver of growth. On the margin side, it's really just there isn't much difference between connecting to one vendor or 100 vendors. It's really we've benefited our consumers by offering a solid service as opposed to right now just a solution to a problem, which was it's actually solving itself. Right, Newegg takes Bitcoin, Tiger Direct takes Bitcoin. We assume everyone is going to take Bitcoin. At which point, what is our competitive advantage? Well, if we are an aggregator of products, that's a great business outside of Bitcoin, which means with Bitcoin on top of it, it'll be we believe that'll be a great on ramp and great path forward.
Okay, thank you. And I guess sort of touching on a little bit of what you just said there, the next question: what will happen to Bitcoin Shop when some of the more major online retailers, such as Amazon or Walmart.com, begin to accept Bitcoins as a payment?
I would assume they would. It's just a question of when. I think by the time they do that, if we have successfully built, a shopping, aggregator, such as like a kayak for e-commerce, it won't really matter, right? In that there's a reason to shop with us because we're going to look across lots of vendors and find the consumer the best price. So Bitcoin comes out of the equation there. Then you start looking at, well, now we have a relationship with Express Coin. We have an investment there. We have an option to invest another $1 million. If we can provide a way to get Bitcoins, we're offering other services to the consumer beyond e-commerce. So e-commerce is just the on-ramp. So I'm not really worried about, because it's not even if these companies will take Bitcoin, it's when. And I assume they will. It's just, is it at the end of this year? Is it this summer? Is it the beginning of next year? We assume that's happening. So that's not, from our perspective, a threat with the way we're building our business.
Okay, thank you, Charles. Our next question, are you able to accept other types of digital currencies beyond Bitcoins themselves?
Right now, we accept Bitcoin, Litecoin, and Dogecoin. Obviously, Bitcoin is the biggest currency. When you just think high level about what do you need for a virtual currency to be accepted, right? It's kind of like gold or diamonds are kind of a good analogy to take a step back. Gold's valuable because people believe it's valuable. It has very little uses in practice, right? It's a conductor and it's it's good for jewelry. Diamond, same thing. There's some optic uses. It's good, in drill bit heads. And apart from that, it's jewelry. So Bitcoin's valuable because people believe it's valuable. And once you hit critical mass, it's actually exchangeable. So for other currencies to be really used, you need the whole ecosystem built around them, right? Bitcoin right now has the biggest ecosystem around it. You can spend it on lots of on services and products. You can exchange it for cash on multiple exchanges. There are people building ATMs so you can do the exchange. There's lots of wallets to store your Bitcoins. There's a whole ecosystem around it. So we probably won't expand beyond, right now it's Bitcoin, Litecoin, and Dogecoin, to other currencies unless there's a decent amount, a decent sized ecosystem for it to actually be viable.
Thank you, Charles. Our next question, what types of products have customers been purchasing the most?
Can you repeat that one more time?
Yes. This investor is wondering what types of products have your customers been purchasing the most?
I would say the category tends to be electronics. I mean, right now, the biggest challenge is, Bitcoin adoption it's growing quickly, but it's primarily the demographic of Bitcoin holders are those that are more interested in technology. They can really grasp the idea of the blockchain and what's going on. But we are seeing this move to mass market, right? You have companies that are making it easier for people to get Bitcoin, such as Express Coin. There's obviously Coinbase and BitPay. So as more of the general public move into the into the space, we imagine that we would see kind of a move from consumer electronics into other areas.
Okay, thank you. Our next question, do you foresee having any additional funding needs?
We're not actively, in the market in any way, shape, or form. However, just looking at companies with in the sector that are like a BitPay that raised $30 million at $160 million valuation, or Coinbase raised 25 and Circle raised 17. From a funding perspective, we are with just raising $1.875 million in February, and being a public company with slightly higher costs that most private companies wouldn't have to incur. We're kind of a little, we don't have the same capital resources that some of the larger companies do. So we'll always evaluate, opportunities to grow the business. I think at this juncture with the current valuation, it's not, we're focused on developing our beta and moving our beta from, into a public beta and then to launching the product. So I don't think we're, where we are today, I don't think we're, we've got a great valuation. I mean, if you look at the private company competitors, the amount of money they've raised and the pre-money values they're getting compared to us in the public market with a liquid company, and to investments in other companies that we plan to integrate with, I don't think it would be the right thing to do at this juncture, to be going back out to market. I think we have to, we're focused on development at this moment.
Very good, thank you. Our next question, can you give a little bit more detail about how you plan to increase your product offerings from the current levels into millions of products?
Well, right now, we have 140,000. We don't know the exact number, but we'll be in the millions, and we plan to do that by connecting to numerous retailers. We've been accepted into about through 10 affiliate programs, but obviously, what makes it very interesting is a lot of the products will be, if multiple retailers offer the same product, we'll be able to do that, get the best price. So that kind of kayak model is very compelling. Now, obviously, there will be cases where maybe only one person sells the product, and so the price is the price, because that's, it's a unique product. It's not as widely carried. How we'll do it, we're already, we're connecting to multiple retailers, and that's the way we're going to go about it. So we haven't put out, and I don't think we're necessarily going to disclose, which ones we're connecting to, but what we're doing is going to big box retailers. The thought being that if we're a conduit to shop on those sites through a seamless interface, and we're finding the best price across those sites, you should be comfortable. I mean, those are places you would otherwise shop on your own, as opposed to if someone was to shop on, let's say, an eBay, where it's just a marketplace where you can't necessarily trust the seller, right? You have to look at how many stars this guy had, or were there complaints. We believe that if we're connecting to big box retailers, places you would feel comfortable shopping, you just don't necessarily have the time or effort to want to create an account with those people or those retailers. We're a good solution for that.
Thank you, Charles. And that was actually the last question we had come in from investors. We have a few more minutes left. I guess we've already covered a lot of great points, but what would be the main takeaway investors should have today from about the Bitcoin story?
Well, I think the key is what we're building, right? And what we're building is trying to be a universal player within the Bitcoin ecosystem. But we're taking a very different approach to that than some of the other companies. And by using e-commerce as an on-ramp, we believe, one, we'll be able to grow our customer base. Two, that's a known business, right? We know what the margins are in that business. It's tried and true. So we're doing it in a different way, but we know what the margins are. Versus some of the other businesses that are coming out within the Bitcoin ecosystem have unproven business models, uncertain economic models in terms of what you can charge a customer, how you make money. Are they, is it going to be for instance, you try to charge a customer for a wallet? Well, maybe a customer doesn't want to pay for a wallet. That should be a free service. Or, do you have to move to an advertising model? I don't think we're going to have a lot of those problems because we're using a model that's been proven to work in the past, right? We're doing it in a very different and creative way. So if we can use that as an on-ramp, I think we'll really be able to grow our users and offer other services. So we're pretty excited about that.
Very good, thank you. It's definitely a lot of exciting things going on for Bitcoin Shop. And for our viewers, we are just speaking with Charles Allen, CEO of Bitcoin Shop. Ticker symbol is BTCS on the OTCQB. To stay up to date on all the developments that are happening with Bitcoin Shop, be sure to enter your email address in underneath the presentation window, and we'll keep you updated as things progress for the company. And we're going to move on to our next presentation, Intercloud Systems, ticker symbol ICLD on the NASDAQ. And that'll be beginning here in just a few moments. Thank you again for joining us.
Good afternoon. This is Mark Monroe, CEO and Chairman of Intercloud Systems. And today I'm going to walk through our corporate strategy presentation and then take some questions. First, I just want to point out the disclaimer slide 2. Then I'll move on to slide 3, which is our agenda. Today I'm going to cover who is Intercloud Systems, the opportunity in our markets, the cloud-centric IT, advantages and challenges in the segment, our business focus areas, our cloud-centric solutions and services defined, and obviously our key vendor partnerships. Intercloud. The Intercloud is an interconnected global cloud of clouds, so to speak, and an extension of the internet network of networks on which it is based. So Intercloud is a cloud of clouds. We offer private, hybrid, and public clouds. We're going to talk a whole lot more about that as we move through the presentation. Who is Intercloud Systems? We are a cloud-centric solutions and services company, and we serve enterprise and service provider customers. Those are our two market segments, and they're the two largest segments in all of IT spend in the world. Both are just under $2 trillion a year. And what do? We partner with our enterprise and our service provider customers in building a next generation cloud-centric organization. And we help them do that by modernizing their infrastructure that they have today by utilizing public, private, and hybrid clouds. And obviously that affects their storage, network, and compute, as well as their virtualization layers. We help set strategy, creating a business case and defining the architecture for the cloud by client, obviously. We're building robust reliability, security, and governance models for the cloud for our clients. And obviously, we deliver a cloud-centric IT vision that is aligned to business value. As you look at our opportunity, we talk about some of our customers' advantages and challenges in the cloud and with their existing IT infrastructures. If you look at the vendor lock-in issues, security, reliability, lack of control, those are all things that are very challenging in the legacy IT environments that many CIOs are stuck in today. And what does cloud computing do for them? It allows them obviously to get scale at a much better cost, much more elastic architecture in the cloud. They're not locked into certain vendors. It's very open. In our case, everything is built off of open source. We're very flexible. We can work with any vendor. It doesn't matter whose equipment or software, we can use that in our cloud. So it's one of the big differentiators. Obviously, we allow them to help. It helps them in their changing in the fluctuations in their business. When it comes to reliability, we're obviously working with next generation architectures, fully virtualized models, where routers and switches are virtualized and riding on virtual machines rather than buying so much hardware. You don't have to do that anymore. And obviously, the big one would be choice and agility. What's more important for these major corporations today in the enterprise and service provider segments? Controlling their costs, but they need to be agile. How do they roll out applications to compete with their competitors if they can't do it quickly? And in the old IT environments, that could take 6 months to roll out a new application, whereas in the cloud environment, it could take as little as 2 weeks. So those are very important issues and differentiators about the cloud. The evolution of our business focus, clearly I just talked about it a little bit. Legacy infrastructure, where vendors locked in customers, sold them a bunch of their equipment, and then they have to buy that equipment for the next 4 to 5 years because they're stuck with a given type of infrastructure and maybe software. As you move more to the software-defined enterprise, the power is going to the company now instead of the vendors. Everything is virtualized, software-driven, very flexible, on-demand kind of capacity, very, very different. And as we move after customers are rolled into a software-defined enterprise environment, then we move on to obviously cloud-to-cloud mobility. This is one of the number one issues for all CIOs that are moving to the cloud and have been for the last couple of years, because many customers today have several cloud providers. And then now, how do they manage that interaction with their legacy infrastructure, and how do they move and approve people in and out of the cloud-to-cloud type services that they're utilizing? And that's one of the areas we're focused on, and one of the things that we can help our customers execute and integrate. So there's two business focus areas that are aligned to the growth trends in the markets today, especially in cloud. Software-defined enterprise, we just talked about that a moment ago. What is that really? It's the ideal architecture for private, public, and hybrid clouds, which is exactly what we offer our clients. All infrastructure is virtualized and delivered as a service. And control of this enterprise is entirely automated by software. That's the crux of really the cloud itself. but you'll move from the software-defined enterprise, and then it's even easier to move fully into the cloud after that. In terms of cloud-to-cloud mobility, it's an evolution for organizations that implement software-defined enterprise. We provide solutions and services that assist our customers in selecting the right cloud or clouds. Intercloud services, obviously part of that. But in some cases, they're going to use other cloud services because one cloud company just cannot do it all. We also deliver a strategy for migrating workloads on demand to and from any private, public, and hybrid cloud platform. And that's our area of expertise in the cloud-to-cloud mobility area. In terms of the market, I think everybody knows, you hear so much about cloud and the growth in the markets. But in particular here, we're talking about cloud computing from a services perspective only for a moment. But Gartner's estimating that'll grow from $68 billion to $148 billion in 14, 1 year growth. I can tell you from our customer base, a year ago, customers were talking and looking at cloud, and now they're starting to actually implement more and more services in the cloud. So it's an evolution that's taking place, and we see 3 to 7 years of continued high growth, double-digit growth. The software-defined enterprise market is going to grow to about $50 billion by 2016. In cloud-to-cloud mobility, just having that feature and functionality in your IT network is going to grow to about $11 billion by 16. So clearly, we're in the right markets. All high growth. This slide is to try to help people better understand what is a software-defined enterprise. What does that mean when we talk about that? If you look at the bottom where it says physical hardware, in legacy IT environments, you have compute, you have network gear, and then you have storage equipment. All that typically was bought as equipment in these networks and installed either in many data centers or in premises or both. What's happening when the software-defined enterprise is you're virtualizing all that and putting those onto virtual machines in the cloud. So once you do that, you can see you no longer have to buy all that hardware. It's a software that rides on an infrastructure, but in the cloud, and it's provided as a service. And that's where your policy-based management automation comes in. These are the things that allow companies to manage their networks across thousands and tens of thousands of employees and do it effectively and quickly. That software has matured quite considerably in the last 2 years. Obviously, cloud automation tools so that they can manage these networks themselves or pay us to do it, whichever they choose, and clearly buy either private, hybrid, or public cloud environments. As you step up the ladder, the workplace, now you start talking about the applications, whether they're software as a service, and clearly bring your own device where anybody can bring any device, utilize it to access these cloud networks. It makes no difference, whether it's Apple, Droid, whatever kind of desktop you want to use, it makes no difference. And that's basically creating a virtual workspace. What is cloud-to-cloud mobility? Some companies will use public cloud, for instance, just to do their test development of future applications that they haven't rolled out yet, but they're testing them. And they do that because that's very elastic. They can rent that infrastructure from people like Intercloud or Amazon, and they can test development. That would be the public cloud. And then you talk about hybrid, where you do a bit of both, where you have some applications running in the private cloud, and then other applications will be private. And when you do that, you can see here just an example of 4 or 5 different cloud services you could be utilizing. And that's creating the opportunity that we're involved with in helping these people put together an integrations plan and strategy and utilize our professional services organization to help build out those tools that allow that mobility to take place and do it efficiently. And that will continue to grow in the future as more and more cloud services are rolled out within these enterprises or service providers. The slide just talks a bit about our cloud-centric solutions on the left and our services defined a little bit more on the right. Obviously, we're meeting with these CIOs and talking about software-defined enterprise and helping them virtualize their entire network and helping them with cloud-to-cloud mobility. We're setting strategy, we're consulting, we're helping them integrate and implement those changes. And then if you move to the right, more specifically, that means we're offering infrastructure as a service where they may rent our capacity for their test development, software as a service where we may be providing a CRM tool or other services that are software based out of our cloud, or a platform service like virtual desktop, and so on. Backup as a service, backing data up, DR as a service, cloud bursting, and cloud migration. So we're a pretty broad-based cloud-centric solutions and services company. This next slide dovetails from there. When I talked about us being a broad-based services company, this is a snapshot of a handful of competitors. If you notice, on the lower left side, it talks about developers, and on the right side, IT management. So it depends on the buyer focus, but if you look, we're way up high in the right-hand corner, where we offer a broad base of services, including the development community can work with us, all the way through to the most sophisticated SAP or other applications that CIOs may need to run, and we can run and manage those applications for them in the cloud. We believe we have an advantage long-term here as we have a broader base set of services, and our customers are trying to get more and more service from fewer vendors, and we obviously can meet those needs and demands. This also continues to just talk about some of our differentiators. If you look at an Amazon Web Services, they're more of an infrastructure as a service player. They're clearly the biggest and the leader in that space. And DataPipe is a local company that we compete against that's more data center centric. But some of the biggest differentiators here is we have a full international cloud integration professional services group. We can work with our customers to integrate, migrate applications, help them build out private clouds in any data center in the world, if they so choose, beyond the ones that we actually offer. But we can do that. And that's a tremendous differentiator, because someone like an Amazon, a customer of ours may use them for test development, but they don't provide the deep white glove professional services group to help them truly migrate more and more applications to the cloud. So that's where we see ourselves one of the biggest differentiators in what we do. This is a slide that I want to take a minute to go through. On the left, you have traditional enterprise data closet, so to speak. This is say you had 100 locations around the United States. This is what your closet would look like. You would have dual internet connections from 2 different internet providers at high speeds. You have 2 WAN routers, wide area network routers. Then you have 2 WAN switches, 2 LAN switches, and then your wireless controller, and then your user desktops. If you look at the right, what I'm trying to get at here is to simplify as much as possible what does cloud computing mean. It means that the enterprise no longer needs the WAN router or 2 of them. They no longer need 2 firewalls. They don't need 2 WAN switches. They just need 2 LAN, local area network switches, on-prem. All those other things go away. Think about all that hardware that has been being purchased across their entire footprint for the last decade. All that goes away, and all that gets completed and managed for you in the cloud. That is a compelling story. That's truly the real value in what's going on in cloud, to simplify it. Some of our key vendor partnerships. We work with the best, VMware, EMC, Cisco, Juniper, Dell, you name it, Ciena, all the big OEMs and software companies in and around our IT space. What I want to talk about here for a moment is, for the last 2 years, we've been making some strategic acquisitions. And those acquisitions were meant to build up our global professional services organization and capabilities, as well as roll out our IT, our IT sales and services organization throughout the world as well. And what we're doing now, what we're really been focused on in 2014, has been building out our organic sales organization to increase our organic sales growth. And if you look at this slide, we're adding 18 sales executives this year, and I think we've already added over 9 or 10 already. And what I want to point out is these are very sophisticated, long-term industry sales executives. They have books of business. They have large quotas. An example, typical quota would be $4 million a year of new revenue to the company. And that's how we're building out our organization. Moving into next year, we will continue to add on the sales side. This is an organic sales growth company. We just had to build out what we needed for all the capabilities we wanted to have in our cloud portfolio of services and our executive team, and now we're rolling out and moving forward on our organic sales plan. I'll take a moment to review the cap table. 11.8 million common shares, If the convertible debentures that we did last December fully converted, they would add 1.9 million shares. I think approximately 45% of those have actually converted in the last 3 weeks. Convertible debt, if it was to convert, would convert into the 1.4 million shares. We have 459,000 warrants outstanding. 190,000 trading warrants remain from when we did our offering last October. So fully diluted, 15.8 million shares. If we look at our balance sheet from December 2013 versus 2014, you'll see we went from 17.8 million to approximately 4 million of cash at the end of Q1. A big part of that was we spent 12 million of that money to acquire IPC January 1st. And another highlight to note would be that in the first quarter, we did pay off fully our 12 million or so of senior debt we had with mid-market capital. And again, you can ask any questions when we do our Q&A. This points out our tremendous annual revenue growth from 2011 to 2013. Clearly, we've been both organically growing the company as well as through acquisition. A little over 50 million in pro forma revenue in 2013. And I have stated in my last quarterly earnings call that we believe we can exceed 80 million of revenue in 2014, and we're still confident in that. So in concluding, why Intercloud? Clearly, we believe we are perfectly positioned to handle the disruption in the IT markets today. Clearly, we're in the right place at the right time with incredible growth opportunities across all segments of cloud for the foreseeable future, the next 3 to 5 years. You obviously have to have a successful and seasoned executive team to execute on opportunities like this, and clearly we believe we put that together. Every one of us has had success in both major corporations as well as building startups to success and then selling them. We believe we're building the right strategic alliances, as I rolled out on that one slide, talking about our partners. We're aligning ourselves with the right partners so that the Fortune 1000 and the service providers that we work with understand that we have top shelf both equipment and software running in our cloud. We make the transition as easy as possible. And clearly we're building a recurring revenue model with high margins in recurring revenue services. That concludes my presentation for today, and I appreciate your time, and I look forward to our Q&A.
Okay, we're now live with Intercloud Systems CEO Mark Monroe, ticker symbol ICLD on the NASDAQ. We're going to begin our Q&A session. Welcome, Mark.
Thank you for having me.
Our first question, can you provide an overview of how an enterprise customer moves from a legacy infrastructure to the cloud?
Sure. There's no single answer here, but I will give you what we have seen occur over the last 24 months and what we believe will continue to occur. Typically in an enterprise customer, they could have anywhere from 40 to 200 applications running in a legacy IT environment. So it's not so simple to just forklift and move all the applications. That just isn't going to happen. What happens is it typically moves their test development. All their test development goes to the cloud first because that's elastic in nature anyway as they're developing and looking at new applications to work within their environment. So that's easy to bring to the cloud. The next step beyond test development typically is their greenfield opportunities. And what does that mean? That means as they look out the next year to 2 years, they say, okay, what are the applications that we want to wind down off of our legacy IT environment? Either because the equipment's been depreciated, because it's not performing properly, it doesn't give them enough elasticity or agility in delivering products and services to their customers, whatever the application may be. The greenfield opportunities are the next set of applications that are typically moved into the cloud because it makes sense. They don't have to continue to invest in their legacy infrastructure. So that's typically how it goes. So it's not going to be 30 or 40 applications at once. They'll do 1, 2, 3 at a time and move them. And that's typically how it's going to happen. And that's why when we talk about the growth opportunities in this space, we do believe it's 5 to 7 years, because it's going to take that long for large corporations to begin to move their applications to the cloud. That's the best description I can give for it at the moment.
Very good. Thank you, Mark. Our next question, can you discuss the difference between Intercloud and DataPipe, and what is the value add from cloud integration and professional services?
Yeah, I know a fair amount about DataPipe, but obviously I don't, I never worked for the company. I don't know the ins and outs of every aspect of it. So if I'm off base a little, I apologize. But from what I understand, the biggest difference between us and DataPipe is that DataPipe started out as a data center centric company. So they own their own data centers, and they have that infrastructure to maintain, and they sell cages and colo. And we don't do that. And I think, look, that it doesn't make them a bad company or less competitive moving forward. But that's an investment in infrastructure that we just don't need to make. We believe that we're better off having flexibility to work in any data centers that we choose, depending on the resources that we want to get out of that data center, as opposed to owning them. There's no reason to own them. However, moving forward, they also offer, I believe they're big Amazon partners for Amazon Cloud, the public cloud services that they sell. But from what I understand, they don't have a professional services organization in DataPipe that will help customers. When I just talked about test development, moving greenfield applications to the cloud, they don't have the staff that can help the customer integrate and roll out those applications to the cloud. They can just sell the cloud, from what I understand. So there's a big difference. We actually offer the team that can go in and provide ongoing integration services to make sure that transition's done right. We can put those people on site, send them anywhere in the world they need to go to help, depending on where those applications reside and what data centers they have to be moved from. I think that we have a more comprehensive approach to the transition over time than a company like DataPipe, and that's what I understand our major differences to be from a DataPipe.
Okay, thank you, Mark. And our next question: once you obtain a customer, how much ongoing service do you provide, and how does this translate to revenue?
Number one, it would be very rare, extremely rare for us to sell to a new customer or to an existing customer and not have ongoing services related to it. In almost every single case, we are always providing, whether it's maintenance services on whatever solutions we're providing for the customer, or cloud services, it's back-end, white glove services they can call, and our team 24/7 is available in our NOC. So we can help them if they're having any difficulty with managing the cloud applications themselves, if they even try to do that. So they have their choice. Manage it themselves, manage it fully through us, manage it partially through us when they have issues or need additional resources. So in almost every single case, we're providing solutions, services, and maintenance ongoing for all of our customers.
Thank you, Mark. Our next question, you sort of already touched on earlier that each customer is unique, but this investor would like to know, how many employees' resources do you typically have to devote to a client project?
Yeah, that's another very difficult question, because every single client, either application or opportunity, is totally different. If you picked one application, let's say, hosted exchange, even that depends on the size of the customer. If the customer is 1,000 seats versus 10,000 seats, it's going to take us, we'll have to have 2 or 3 more people involved in an integration or transition of a solution like that than we would if it was 1,000 seats. So it's really hard for me to tell you how many resources it would be for every given sale or customer we work with. It could be as little as 2, and it could be as many as 50 or more. It depends on the application. We have over 400 employees, and probably almost 250 are professional services engineers that will be working with clients on a day-to-day basis all over the country and around the world. So I hope that helps.
Very much so. Thank you, Mark. And our next question, we've seen many new contracts announced over the last few months. Is this a pattern that we should expect to see continue?
Well, you never know if the pattern is going to continue, but we have seen a steady uptick in business along the second and third quarter here this year. So we're optimistic that can continue. Our pipeline is larger than it's ever been, which is a great sign and a great signal. And in addition to that, we have not announced it really, but we've hired 7 new salespeople since February, and these are enterprise-based salespeople that carry quotas anywhere from $2 to $8 million a year, depending on their skill sets. And our objective is to hire a total of 18 new enterprise salespeople this year. So what you've seen us accomplish in 2012 and 13 was building up our platform. And then in 2014, our objectives are finish up any remaining integration issues that we have in any of the entities that we've acquired. That's gone very well. And lastly, to now embark on our organic growth strategy, which is to hire geographically. So these people have been hired, anywhere from New York to Florida to Dallas, and we'll be moving into other markets as well, like Chicago and LA, et cetera. So I think my overall statement there is that we've seen an uptick and that we are positioning ourselves to take advantage of the continued growth opportunities in our space over the next 3 to 5 years with our organic growth plan.
Very good. Thank you, Mark. And we have a few more minutes left. I guess to wrap things up, I know you've already commented on this in the presentation, but one investor would like you to just discuss the 2014 guidance. And I guess as a second part to that, what's the main takeaway? I mean, you talked about a lot of great information today, but what's the main takeaway investors should have about the Intercloud story?
I think the main takeaway is that we're positioned perfectly for the transition that's taking place in IT from what we call Infrastructure 1.0 or legacy IT to the cloud or Infrastructure 2.0. We're flexible, we're nimble, we're not tied down to a specific set of data centers that might limit our capabilities in the cloud. We are completely flexible to go where we want as we need to for our customer base. 2, everything we've built around our cloud is completely around open source, so that we are completely flexible in terms of what applications we want to run or what technologies we want to integrate and work with for our customers. So we don't have any limitations when it comes to our abilities to develop solutions for our clients. And I think at the end of the day, that's probably one of the biggest differences in today's competitive landscape from the legacy IT world where everything was proprietary, and once you got locked into a vendor, you were stuck with that vendor throughout your entire footprint. And we eliminate that. So I think we're positioned perfectly well. We've got scale now. We've got our organic growth plan in place, and we're executing on it. The market is right for growth in all segments of cloud and IT. So we like where we sit. We like our strategy. And lastly, of course, we've added the right personnel in the right executive roles that will allow us to succeed and execute on our plans, because it always comes down to the people. And everybody on our team has been successful, and I believe we'll continue to build our culture and our successes moving forward.
Very good. Thank you, Mark. And for our viewers, if you want to keep up to date on all the developments as they take place with Intercloud, be sure to enter your email address below the presentation window, and we'll keep you constantly updated with as new developments take place. We were just talking with Mark Monroe, Chairman and CEO of Intercloud Systems. Ticker symbol again is ICLD on the NASDAQ. Here in a minute, we're going to move on to our next presentation, which is Veritech, ticker symbol VTEQ on the OTCQB. Scott Silverman, Chairman and CEO, will be presenting. And again, that's coming up next, Veritech, VTEQ.
Good afternoon. My name is Scott Silverman, and I'm Chairman and CEO of Veritech Corporation. I'd like to make reference to the safe harbor statement in our presentation that is online with RedChip and dive into the presentation itself. Veritech Corporation was started in December of 2011 with a strong intellectual property portfolio to develop implantable RFID, or radio frequency identification technology, for healthcare applications. Today, we have over 100 patents, patent pendings, and exclusive licenses, and multiple regulatory approvals and clearances related to our technologies. We went public in July 2013 through a merger transaction. Veritech's unique value proposition lies in our two primary business lines. Our first is a business line that we call the UDI, or Unique Device Identification business line, and we call our specific technology in the UDI business line Q-Inside Safety Technology. The second is sensor applications on the end of an implantable RF chip with a focus on radiation dosimeter applications. As a result of recent legislation from the FDA, or promulgated by the FDA, that Obama signed into law in July of 2012, there is now a final rule out there by the FDA that creates a unique device, or UDI, identification system for all medical devices in the supply chain that ultimately are used in medical and clinical care. We call our device, as I said earlier, related to the UDI legislation, Q-Inside, and it can serve as a direct part marking to help device manufacturers comply with this UDI legislation and the FDA's final rule. In addition to our UDI direct mark Q-Inside safety technology, our second main business line that creates our unique value proposition is intellectual property related to sensor applications on the end of an implantable RF chip. In the past, we've developed several sensors, including a temperature sensor, and we're now focused on radiation dosimeter sensors on the end of an implantable RF chip to help in radiation treatment for cancer therapy, to help prevent overdosage and underdosage by taking readings directly from the body itself. Before diving into more detail on our two primary business lines of UDI and dosimeter applications, I think it's relevant to spend a little time going over history. History is important for a number of reasons. Number one is to show you the credibility of our management team. And number two, to show you the roots of where this implantable RF technology comes from. Our management team, spearheaded by myself and Randy Geisler, have been the leaders in implantable RFID technology for over 20 years, for more than 2 decades. Over 2 decades ago, Randy invented an implantable RF transponder, or a chip, similar to the one that I'm holding up here, if you can see it, that was used in the animal world, specifically with companion pets. So if you have a dog or a cat, there's a good likelihood that that dog or cat has our chips inside of the scruff of their neck, implanted by through a needle by a veterinarian or a clinician. And that product is used to identify your pet in the event that he or she is lost and brought to a shelter or a vet clinic. A scanner, similar to this one, is sitting in a vet clinic or in the shelter, and when the dog presents lost, they will scanner over the scruff of the neck, and it identifies the dog, and immediately through a database can you call the owner. That product was one of our initial products over 20 years ago. It is no longer our product. It was part of a company called Destron Fearing Corporation, which was ultimately sold to Shearing Plow in the mid-2000 eras. So Shearing Plow is now operating that product. It's under the name Home Again. Over 150 million dogs and cats have received a product of this type. And on a monthly basis, over 10,000 dogs and cats are reunited with their owners as a result of the use of this microchip. The reason I bring that up, although it has nothing to do with Veritech, is to show you the roots of the technology and how we built our business over the last 2 decades. In 2004, we got an FDA clearance to take a similar technology, a chip looking like, which will probably look very similar on the presentation itself. And we got the FDA clearance to use this product in a human being, injected subcutaneously in the upper right arm so that high risk and their medical records can be identified in the event of an emergency or a clinical situation. That product was called Veritchip. Many of you may remember it because it got a lot of attention in the press back in 2005 and 2006, because people had the misconception that it was a GPS tracking device, when in reality, it is actually an identification device that is only used for identification purposes. So if a patient presented unconscious or non-communicative, a scanner could be waved over the arm, just like it's waved over the scruff of a dog or a cat, and identify that patient, their medical records by accessing a database. So what you see here is I'll scan my arm. It'll pull up a unique 16-digit identification number. That identification would tie to a database with my personal health record. Veritechip Corporation was IPO'd in 2006, and it was sold in 2008 to Stanley Works, the lock and tool company, for approximately $50 million. After a series of non-competes, Randy and I decided to start Veritech in December of 2011 with a focus on what had evolved in the healthcare industry. People were now using implantable RF chips, or needed implantable RF chips, to help improve healthcare. And that was evidenced specifically what I referenced before, which was the UDI legislation, Unique Device Identification legislation. The FDA promulgated the rule, Obama signed it into law in 2012, and in September of 2013, the FDA issued what's called their final rule under the legislation that requires, amongst other things, that all medical devices have a cradle-to-grave tracking system through the manufacturing process, through the supply chain, into the doctor's office, into the OR, and ultimately into the body. The majority of that final rule can be done through barcode technologies. However, there's a very unique aspect of it called the direct marking aspect. And the direct marking aspect of the final rule requires that implantable medical devices that are reusable and reprocessable, in other words, going in and out of multiple patients, must, and it's mandated that they must, have a direct mark on the device itself so that it can be identified either through direct site or through AIDC compatibility. We believe that our product is the only one that has the ability to meet the AIDC compatibility aspects from an electronic perspective. And that's why we believe that we have significant advantage in the market related to the direct mark mandate for reusable and reprocessable parts. As it relates to permanent implantable medical devices, our technology is very useful to medical device manufacturers to identify their devices once it's inside of the body. And although that is not mandated, it is clearly an advantage for a medical device manufacturer to be able to identify their device when they're in a competitive situation with another medical device manufacturer. The early adopters in the direct mark application for implantable medical devices is the breast implant industry. As a result of a number of recalls that took place in the EU over the last 4 to 5 years, manufacturers and even governments have recognized the need to identify a breast implant once it's inside the body in the event of adverse event or recall. Our product gives breast implant manufacturers the ability to do that. In the worst case, over the last 4 or 5 years, a company by the name of PIP, or Polyimplant Prosthetics, based out of France, actually used industrial silicon rather than biological silicon inside of a breast implant. And as a result of leakage or subsequent leakage, women were harmed. They had significant medical problems as a result of the leakage. The company was shut down. There was prosecutions of the management teams. And today, the EU is leading the charge on creating a requirement that if that ever happens again, that the breast implant inside of a woman will be able to be identified using a unique technology. And obviously, we hope, and it already is in the case of one manufacturer, our QInside safety technology that's used to identify the breast implants. So today, we have a partner by the name of Establishment Labs who manufactures their breast implant under the brand name Motiva. And over the last several months, they have started to market their product after getting the CE approval. The CE is the equivalent of the FDA in the EU. They've started to market their product through their European distribution streams with our QInside safety technology inside of the breast implants. So over the last year, we have filed a number of patents, and we've worked with Motiva to create a manufacturing process where their breast implants are manufactured with the QInside safety technology. So what I'm showing you now is one of their breast implants. And if you can see closely, there's a QInside safety technology right there on the breast implant. So when this is inside of the woman, in the event of adverse event or recall, a scanner, and there's a new age scanner which we just came out with, like this, can be used to identify the device. I'll show you how it works. It brings up a unique 16-digit identification number that ties to a database that's managed by us and our partner Motiva, and it would say the lot number, the batch number, the manufacturer name, and could be identified years down the road in the event of adverse event or recall. Now, you may ask why a woman would need this. Why wouldn't she know what type of breast implants were inside of her, batch numbers, lot numbers? And although there are card systems and registry systems that have been in place for years, it's never been required, and it's never been complied with. So most women know who their doctor was when they get breast implants. They don't know who their manufacturer was. They certainly don't know the batch number or the lot number. And obviously, you see the way that this system works. As a result of what we've done with Motiva, in the first 4 months or so of marketing the product in the EU, we now have over 500 women that have received breast implants with the Q Inside safety technology. And we've proven the commercialability as well as the efficiency of the product in the marketplace. And what we've come to learn is that other breast manufacturers, including the largest ones in the world, which are Allergan and Mentor, are interested in our technology. And we do believe that ultimately it will be applicable across part, if not all, of the breast implant marketplace over the next several years. So we're very happy with where the evolution of the product has gone on the breast implant side of the business. And before I leave that, I think it's very relevant to say that the database aspect of managing breast implant registries or other medical device registries is also an important future revenue stream to Veritech as we move forward. So in addition to breast implants, we've also partnered with a vascular port company out of Philadelphia by the name of Medical Components, Inc. Initially, they were using our product to identify high-speed ports in clinical situations. So just as I showed you before with the breast implant, there would be Q Inside safety technology inside of a vascular port that's used in chemotherapy treatment. The port typically goes inside of the chest cavity or in the arm, and a clinician could use a scanner in order to identify that it was in fact a high-speed port to identify chemotherapy treatment that can be delivered at times the speed of normal chemotherapy treatment. In other words, a high-speed port can deliver the treatment quicker. A clinician needs a way to identify that high-speed port. Q Inside safety technology is a way to do that, in addition to meeting the direct mark recommendations of the FDA final rule as it relates to permanent medical devices inside the body. So there are other applications on the UDI side, on the Q Inside safety technology side. Obviously, it could be used in hips, knees. The mandate relates to reusable and reprocessable parts. A prime example of that, jumping back to breast implants, is sizers. Some physicians, some plastic surgeons, use what's called a sizer before they put in a permanent breast implant. Sizers are also relevant in chin implants, other cosmetic surgeries, even heart valves use a sizer before ultimately putting in the permanent heart valve inside the body. So these are reusable and reprocessable parts that can be used in the case of breast implants in up to 10 different women. And the FDA's rule or mandate relates to being able to identify what sizer went inside what woman and who else used that similar sizer in the case of future infection or recall or whatever the case may be. So in the case of breast implant sizes, there is a mandate out there that must be complied with by September of 2015 that requires that a breast implant sizer and other reusable and reprocessable parts have to have a direct mark on the device itself. And again, we believe that our Q Inside safety technology is the best way to do that. So jumping from the UDI side of the business to the sensor side of the business, when we started this in 2011, we bought what we call one of our seminal patents to put a biological sensor on the end of an RF chip. It's a very broad patent. It relates to what I believe is most sensors that could be put on the end of an implantable RF chip. And you can imagine the applications in the healthcare world regarding a sensor on the end of this RF chip, whether it's subcutaneous, whether it's in a device, or whether it's elsewhere in the body. We've developed a temperature sensor. in the past, which is maybe more relevant in the animal world than it is in the human world. Just by way of interest, obviously we can tell a doctor how we feel and we can take our temperature. Well, an animal can't tell a doctor how they feel, and taking an animal's temperature is a more difficult process than taking our temperature. But the technology that we're focused on today from the sensor application perspective, and we've acquired intellectual property to add to our portfolio related to this technology, is radiation dosimeter applications. So what you see here has been cleared by the FDA, which is a big statement. And you'll see that this transponder is slightly larger than the one I showed you before. It's actually about twice the size. And this is what we called our Q-Inside Smart Marker that goes inside or next to a prostate tumor or a breast tumor. That's what it's been cleared to be used in by the FDA. And it actually takes the dosage of radiation being delivered directly to the spot, to the tumor site. And let me tell you why that's relevant. That's extremely relevant because today, radiation dosage is measured from the machine that's emitting the beam outside of the body. So you're in a room getting radiation treatment. There's a machine next to you that's emitting the beam. You set a setting on that machine, you push a button. Well, what's coming out of the machine is not the amount that's being delivered to the tumor site. And that's where underdosage and overdosage can occur. Overdosage, as you probably know, can cause death and does cause death frequently in radiation treatment. In fact, radiation overdosage is a top 5 concern of all the major medical associations, the AMA, and even the FDA, when it relates to the top 5 health concerns on an annual basis. So our technology that I'm showing you here goes into or next to a prostate or breast tumor. It marks the location of the tumor itself to help localize the radiation beam so that the ancillary tissues around the tumor are not affected as they are sometimes with today. And it is the only technology in the world that has the ability to measure the radiation dosage directly at the tumor site itself from a scanner that sits outside of the body that takes that measurement every 30 seconds or so. So in addition to our Q-Inside Smart Marker, we also have a product that we call OneDose. And OneDose is a small adhesive. It's about a quarter of the size of a Band-Aid. Again, it's been cleared by the FDA with all the necessary reimbursements in place. And what that does is it takes the radiation dosage from the skin site, from the skin, as the beam is going through the body. Less invasive, can be used in CAT scans, although it's not currently approved for CAT scans. We know that CAT scans is a larger market than radiation therapy itself. And we believe that these technologies that have already been in the market, that have already been in up to 200 hospitals across America under a former owner, we did not own the technology at that point, has significant opportunity. When we break down the two businesses, the UDI Q-Inside Safety Technology business is up and operating. It is producing revenue from the breast implant market that I described previously. We have a contract with one breast implant manufacturer. We hope to have more with others over the next year or so. And that business is our main thrust today. The majority of our intellectual property lies on the sensor application side, specifically the radiation dosimetry side. And we believe that with the proper funding, that business can provide substantial revenues over time. And underlying both of the businesses, obviously, are database applications and data analytics that can provide additional revenue streams as well. So like I said in the beginning, Veritech, rather young company from a public perspective. Our unique value proposition lies in our two primary business lines, which is the UDI, or Unique Device Identification System, using our technology called Q-Inside Safety Technology, which is premised on our implantable RFID, or radio frequency identification technology, that the management team here has been involved with for over 20 years. The second piece of our unique value proposition are the sensor applications that come from one of the seminal patents we acquired when we started the company, with a primary focus today on the radiation dosimetry applications that I previously explained. We think we have significant upside. We're very excited about what's going on as our business evolves. We've started to produce revenue, and I thank you for your time, and if you have any questions, I look forward to taking them. Thank you very much. It's been a pleasure presenting, and I'll see you soon.
Okay, we're now going to move into our question and answer session with Veritech, ticker symbol VTEQ on the OTCQB. With us today we have Scott Silverman, Chairman and CEO. Welcome, Scott.
Thanks, Paul. How are you?
Very good. Let's jump right into our first question. What is the biggest challenge you find in trying to convince medical device manufacturers to adopt your RFID technology?
Yeah, well, the challenge regarding adoption in the medical device world relates primarily to the UDI legislation. The UDI legislation mandates that reusable and reprocessable devices need to have a direct part mark, which is where our product Q Inside Safety Technology is relevant. However, the permanent implantable medical devices no longer are mandated to have a direct part mark, but there are a number of early adopters in each of the specific device areas that are that breast implants actually have this identifier in the event of adverse event or recall. So the challenge is getting that leader, getting that early adopter in each of the specific medical device lines that can lead the way, show the relevancy of the technology, show how it affects the health, safety, and wellness of patients, and ultimately how it complies with either the FDA or CE recommendations and mandates related to direct part marking.
Okay, thank you. And our next question, we have, can you give us an overview of your sales projections you expect for the Q Inside breast implants?
Yeah, we don't give formal sales projections, but I can point to market opportunities for us, specifically related to breast implants. Our initial partner, as you know, is a company out of Costa Rica by the name of Establishment Labs that sells their Motiva brand breast implants in Europe, Latin America, and Asia. This morning we announced that in less than, or approximately 4 months, over 800 women in Europe and a few in Japan have actually received Motiva breast implants with Q Inside Safety Technology, specifically for the reasons that I just stated in the last answer, to help in the event of adverse event or recall. That business with Motiva will be, as time goes by, a significant business for us, but the real opportunity in breast implants lies with Mentor and Allergan, who combined have well over 95% of the U.S. market, and we believe well over 80% of the worldwide market. And based on pure numbers of permanent breast implants and breast implant sizers that they sell into the market, that opportunity for both of those companies combined can be in excess of $40 million per annum.
Okay, thank you. And our next question, you sort of touched on this a little bit in the first answer, but what has been mandated and what has been recommended by the FDA in regards to the final rule?
Yeah, that's been an interesting evolution. There's been benefits to us, and there's been things that hurt us as the company has evolved. Going back a number of years, the original rule suggested or recommended or was actually intended to mandate that all implantable medical devices, whether permanent or reusable or reprocessable, had to have a direct part mandate. Obviously, our technology to this day, we believe, is the only technology that could comply with and meet with the recommendation related to permanent implantable medical devices. There are a few competitive devices that can be used for the reusable and reprocessable. But to answer the question directly, what has been mandated is the reusable and reprocessable devices. What has been recommended is the permanent implantable medical devices.
Okay, thank you, Scott. Our next question, do you anticipate having any additional funding needs?
Yes. For those that have followed the company, you know that we have a difficult financing in place from last November with a group called Hudson Bay and other investors that recently triggered a ratchet in their warrants that has caused the recent decrease in our price per share. That's the bad news. The good news is, obviously, it's up to volume. The more volume, the quicker we get rid of them, and once we get rid of them, we think that the cap structure will be in a good position with no overhang to go out and do additional financings for the company.
Okay, thank you, Scott. And our next question, how do you plan to market your radiation dosimetry products to oncology centers?
Yeah, good question. Just a little bit of background on that, because we haven't talked about it yet on at least the question part of the interview. We have a significant IP portfolio related to sensor applications on the end of an implantable RF chip. The one that we have focused on over the last year is radiation dosage levels taking radiation dosage levels from a tumor site using a chip that gets implanted either in or next to a prostate or a breast tumor that not only marks the location of the tumor itself so that the radiation beam can be localized and not affect the ancillary tissue. There's other technology that does what I just stated, but where we're unique is that we are the only ones that can take a radiation dosage level from the tumor site itself. And that's an extremely relevant fact when you look at the number of radiation underdosages and, more importantly, overdosages that occur on an annual basis, and it's become a major concern of the AMA, the FDA, and everybody else. So we own the IP. The technology has been commercialized in the past. We intend to commercialize it as soon as possible with the proper funding in the company. And unlike the medical device business that we're in, where we have our own sales force that markets to the 30 or 40 medical device companies out there, in the case of our radiation dosage technology, we believe that going with a partnership with a larger company like a Varian, for example, or even a General Electric, who have large sales forces out there that are already hitting the oncology suite, will probably be the proper route to go.
Thanks, Scott. And we have just a couple minutes left. You've already obviously touched on quite a few great points, but what would you say the main takeaway investors should have about the company's story going forward from today's
Thank you for the opportunity to state that, Paul. We're in a very unique position. We have a significant intellectual property portfolio, over 100 patents, patent pendings, and exclusive licenses related to all of our technology. We have a unique opportunity in the medical device space related to the UDI legislation, as evidenced by our first mover in the breast implant industry in Europe. And I think the biggest takeaway is we are now commercialized. We're in the market. We have our regulatory clearances. In some cases, we have insurance reimbursement codes. So this isn't a company that's developing technology. Our technology is developed. It's already in the market. We see it expanding quickly in the breast implant market and then going to the other medical device manufacturers and ultimately into the radiation dosage area. So with all of that unique IP, we believe that the opportunity is significant on both sides of the business, the medical device side and the radiation dosage side, not to mention all of the data and analytics that can go behind it. So we're young, and we're moving forward, and we think that the opportunity over the next 2 years in those areas is very significant.
Thank you, Scott. And that was our last question. We were just speaking with Scott Silverman, Chairman and CEO of Veritech. The ticker symbol is VTEQ on the OTCQB. Again, that's Veritech, VTEQ. To stay up to date on future developments of the company, please make sure you enter your email address in the box below the presentation window, and we'll be sure to keep you updated as future developments take place. We're going to be moving on to our next presentation here in a minute. We're going to be, next up will be Lattis Incorporated. CEO Paul Burgess presenting, the ticker symbol LTTC on the OTCQB, and I'll be starting here in a few moments.
Thank you, everyone, for joining us on the Lattis Incorporated presentation. I'm Paul Burgess, CEO of Lattis Incorporated. Going to the second slide, I'm just going to bring to everyone's attention our safe harbor statement. I'm sure you've seen these on a number of presentations. This is our version of it. Moving to the next slide, just to give you an overview of the company. The company's a technology leader in the corrections facilities market. We primarily provide technology services and technology directly to the corrections market, both domestically here in the United States and abroad. I'll go through the division of those two markets and the competitive landscape in the upcoming slides. In 2009, the company re-entered the corrections market in the services side of the business, and since that time period, our business has grown revenues by approximately 700% from 2009 through 2013. We're looking for continued expansion going forward in the years ahead. The company provides a suite of cloud-based services that enable smaller facilities to access technology that traditionally has only been available to larger facilities. This technology enables the smaller facilities to access technology in a modular form, whether they just want basic telecommunication services, a high end of investigative tool sets, kiosks for both inmates and people visiting, video visitation technology, which is called ICON in the upcoming slides. The company's actually been in existence since 1973 and has traditionally been a higher end engineering company in the telecommunications market. As I mentioned before, we entered the corrections market in approximately the mid to late 80s, and we entered the service side of the corrections market in 2009, and that's why you're starting to see the scale in the revenue. Just to go over the financials that I mentioned previously from 2009 through 2013. As I mentioned, in 2009, we were doing revenues in the corrections market of approximately just over $1 million, and we've scaled that to about $8.3 million in 2013. And in the coming years, we anticipate seeing strong growth as we have in the previous years, as this is approximately a $5 billion market, and we've yet to penetrate a large percentage of market share. Moving to the next slide, to give everyone an overview of the corrections technology market. It's about a $5 billion market that encompasses federal, state, and county, and includes not only telecommunications revenue, but all the other supporting technologies for supporting correctional facilities. Additional revenue from other non-communication-based services that we are able to provide through our cloud-based system. There are approximately 2.3 million inmates in the United States, and it provides us with a strong recurring revenue base. Of our 8.3 million last year, approximately 70% of that was a recurring revenue stream. The prison population, although it tends to fluctuate state by state, has steadily been growing at about 3% annually, and capturing market share is really what this company is focused on doing. What it enables us to penetrate the market and actually provide not only a service to the inmates, but a service to the correctional facilities, is our ability to actually share the revenues from the telecommunications market with the correctional facilities. This allows them to use the funds to not only help operate the facility, but help with state and county budgets. Moving to the next slide, we continue to grow our technology portfolio throughout 2013 and well into 2014. One of the key things that we did is we bought a company called InnoVisit. We were, in early 2013, we were looking at either continuing to develop our video visitation technology or acquire. We were working with InnoVisit for approximately over a year. Their technology integrated very well with ours. They had a strong customer base, and in the latter part of 2013 Q4, we acquired InnoVisit. They'll add approximately 15 new states that we're currently not operating in. They currently service over 90 correctional facilities, and they should add approximately 1.5 to 2 million in additional revenue in 2014. Based on our first quarter of integrating the InnoVisit acquisition into Lattis, we've seen those numbers come in line between the 1.5 and $2 million range as far as the revenue that we're going to be adding from our video visitation product line. Moving to the next slide, the competitive landscape is really divided into two primary areas. First, small regional service providers. These are usually smaller, locally based companies that have a solid relationship with some of the smaller facilities within that region. They tend to use outdated technology and generate lower revenues per inmate. The other side of the competitive landscape are the large national providers. They tend to focus on the larger facilities. They're using multiple technology platforms through acquisition, making service inconsistent to some of the smaller facilities. And losing smaller facilities to customers such as ourselves. What we tend to be able to do is provide not only the small regional service providers with technology, but some of the larger service providers utilize portions of our technology as well. The business model in the U.S. market is really focused on getting access to the exclusive rights to a facility. That's the exclusive rights to provide telecommunication services to that facility. The revenue sharing with the facility provides an extra revenue stream for cash-strapped state and county budgets. And the range of revenue sharing ranges from about 20 to 60%. And within those ranges, we're still able to maintain a healthy profit margin. What it also enables us to do is upsell leading features and products to provide our customers a little more stickiness. The ability for family members to credit inmates' call accounts, video visitation, kiosks, integrated jail management systems, our new tablet-based technology that I'll be talking about a little bit later in the presentation. All these technologies we can provide to our customers, and with that, what we usually do is decrease the amount of revenue sharing we get from the telecommunications with the facility. This provides the facility with a much stronger technology base that allows them to operate more efficiently. Our sales and marketing strategy is really divided into two key areas in the domestic market. First, direct sales to facilities. This is usually a local sales presence that we expand upon established local concentration. In other words, what we tend to do is focus on some of the smaller facilities. As we build a reputation within that market, we tend to expand through word of mouth. Referrals are very important for winning county customers in this business, as they tend to utilize the same technology in same regions. We also do indirect wholesale and technology licensing to other service providers. We utilize channel partners for larger facilities and state bids for out of direct sales regions. In other words, regions that we're not currently focused in, we may provide a competing service provider a license to utilize our technology, or we'll white label the service for them. This allows Lattis to build a footprint and brand recognition throughout the industry, even in markets that we're currently not focused in. Moving to the next slide, as I mentioned earlier in the presentation, we're not only focused on the domestic market, but we're focused on the foreign markets as well. The competitive landscape in the foreign markets is usually incumbent telecommunication companies as the primary competition, and they're using a legacy payphone model, which is collect calling, which is not only very inefficient, it also has a large portion of bad debt associated with it. And a lot of the new technology that we've introduced here in the United States has yet to be introduced in the international market. Lattis has a unique technology advantage in the international market in that Lattis's technology provides cost reductions in a lot of the facilities, not only because of the telecommunications systems that we operate, but the other technologies that we provide, such as investigative tools and jail management systems, etc. Lattis's model provides enhanced revenue streams in these areas where traditionally this model hasn't been introduced in the international markets. It is an additional revenue stream for the facilities in those areas. And Lattis also provides enhanced security and investigative tools that they currently aren't available in a lot of the international markets that we've reviewed. Continuing with the foreign market, the business model leans more to a technology sales, licensing, and revenue. There are some transaction fees associated, but the services revenues are probably 30% as opposed to the domestic market where they're 70%. Current foreign sales pipeline, we do have installations in Asia, Canada, we have RFP response in Israel, Mexico, we do have a small operation in the United Kingdom, we have bids in India, Belgium, and we do have some technology operating in the Caribbean as well. Continuing in the foreign market, the Canadian market is probably our largest foreign market right now. We've awarded 4 installations. All 4 were implemented in 2013, with the primary partner in Canada being TELUS Canada. They provide services to the larger provinces. Currently, we're doing an installation for BC Corrections. For smaller facilities, we partner with a company called WiMACTel, and we have a couple of installations with WiMACTel currently operating in the Canadian market. In the UK market, our first site was actually operational in Gibraltar in 2011, and we used this as a showcase to demonstrate what our technology could do. We successfully completed a trial for a 400-bed facility and are currently responding to RFPs for multiple facilities in the UK. The UK inmate population is approximately 90,000 inmates in the United Kingdom, and they are moving more towards an outsourcing model, which bodes well for us being able to partner with some companies going into those markets. In the continue with the foreign market, we retained communication media advisors to help accelerate our international expansion and really review our international business plan. We did this in Q1, with the first phase of this being complete in the second quarter of this year, and currently is complete. And what that allowed us to do was identify the most attractive markets for expansion and identify potential partners and licensees that best enable Lattis to penetrate those markets. We're currently through the first phase, and now we're looking at implementing the strategy that we built with communication media advisors. To be in direct contact with friends and family. Quite a few studies have cited that the more you keep an inmate in constant contact with friends and family, the easier it is for that inmate to integrate back into society. And that's really what our technology platform enables us to do. As I mentioned, the core of our technology is called ICON, which stands for Integrated Corrections Operating Network. And it provides a centralized database for management of everything from the products and services we offer to customer care, to a customer database, to accounting and billing for the facility, and payment processing, which is a key item when inmates actually have money deposited on their accounts from friends and family, as well as the money that they bring into the facility. This allows us to actually process those payments, whether they're buying something from commissary or buying one of the communication services from us. Just moving to the next slide. If you look deeper into the ICON product, the products and services are managed by this technology, and that allows the inmate, whether it's through video visitation or through basic telecommunications, to keep in contact with friends and family, but it also allows them to do a whole bunch of other things, such as secure email, download music, text messaging back and forth through a secure network back to friends and family. And one of the key devices that we've been working on and that we've looked at introducing in some of the foreign markets and will be introducing in the US market here in the second quarter is a tablet-based technology. This allows the inmate to utilize all the products and services through an e-device or a tablet, which not only expands the amount of services that the inmate has for communicating back to the friends and family, but alleviates a lot of the overhead required for operating from the correctional facility itself. Just moving to the next slide, one of the components that we'll be implementing later this year is a jail management system. The jail management system is really the core operating component of a corrections facility. It allows everything for the facility to do as far as managing the activities in the inmate from the time they're actually brought to the facility and booked to their, whether it's their medical records, whether it's their account management, whether it's special dietary needs, whatever it may be, the whole component of managing that inmate from the time that they're booked to the time that they're released is really operated through a jail management system. And we'll be looking at introducing our next version of this in the upcoming quarters. Moving to the next slide, just to give an overview of some of the investment highlights. The company is in a rapid expansion mode. As I mentioned previously, in 2009, we re-entered the corrections market in the form of providing not only technology, but services. The growth from 2009 to 2013 has been 700%, and we look at expanding upon that growth in the years to come. We offer industry-leading proprietary technology. All our technology is proprietary. We are looking at providing the underserved component of the market, which is the smaller county-based correctional facilities. These are the smaller and mid-sized facilities. We're looking at grabbing market share in that area. International expansion with a few key partners. Currently, approximately 10 to 15% of our revenue in 2013 came from markets outside of the US. We're going to look at expanding on that footprint, not only in the Canadian market, but in the European market, as well as the Asian market. As I mentioned, over 4 years, 700% revenue growth. You're getting in on the early stage of the growth potential of this company. With that, I just want to thank everyone for participating in the presentation today, and I'll open it up to questions for anybody. Thank you.
Okay, we're now going to open the line for our Q&A session with Lattis Incorporated, ticker symbol LTTC on the OTCQB. With us today, we have Paul Burgess, CEO of Lattis. Welcome, Paul.
Thanks for having me.
Our first question, can you give us an idea of your customer retention rate?
Yeah, since we got into the direct service market, we have yet to actually lose a direct service customer. So in the 4 years that we've been active in that market, it's been 100%. We do have wholesale services as well, and they tend to fluctuate. Customers tend to change services, and as they drop out facilities or switch out technology, they can come and go. But on the direct services, right now it's been 100% retention. Obviously, going forward, as we continue to grow and expand market share, we don't expect it to always remain 100%, but that's the number we always strive for.
Thank you, Paul. And our next question, are there any other areas that you are considering expanding your technology into? And would you want to do this organically or through acquisitions?
Great question, and we've actually just in Q1 and Q2 we brought in communication media advisors to help us with our international expansion business plan, as well as to review our domestic business plan. And one of the things that we're currently looking at is what ancillary markets we can go after. So in other words, what markets that are very close to what we currently operate in, which is the corrections market, can we expand, or what areas would our technology be utilized in? And some of the areas that we're looking at are things like extended care facilities, old folks' homes, halfway houses, things like that, where this type of technology, where you want to have strong control over the communications but keep people in touch with their friends and family, this technology fits very well. So we're in the early processes of reviewing what those markets would be, and more importantly, how we go after and capture market share in those areas. Now, to answer the question whether we do it organically or through acquisition, probably what we'd end up doing is we would look at doing a couple of beta trials to make sure that we have all the pieces of the technology that would address those new markets. And secondly, we would probably look at partnerships with companies that are already selling into those areas that either we can partner with or acquire. So it would probably be a combination of both, but we should have a better idea in the coming months of what those markets are and how we would actually address going out and capturing market share.
Thank you, Paul. Our next question, do you currently have any funding needs?
Well, going into this year, we have obviously we've seen over the last 4 years we've had strong revenue growth in this area, and we anticipate continuing to see that type of revenue growth. The problem that we had with the company is the balance sheet was upside down. So we looked at going into Q1 and Q2 at bringing in some financing at favorable terms, which we did part of. We have a second tranche of financing that we're looking at completing here in the short term that would bring in some more strategic investment into the company. And once we have that completed, we'll actually have positive equity back in the company. We'll have positive working capital, so our balance sheet will be gone from being upside down where we finished 2013 to having a fairly strong balance sheet going forward. As far as future needs for capital, probably what we'll look at is the capital needs if we look at market expansion into other areas, if we look at acquisitions, if we look at expansion into the international markets beyond what we're looking at today. So that, to answer that question, it's really going to be determined by what other markets we're looking at going after, probably going into 2015.
Thank you, Paul. And our next question, how should investors view revenue growth over the next 12 months, both domestically and internationally?
Yeah, I think what you'll see in the company over the next, I'll call it 12 to 36 months, is you'll start to see the revenue ramp again. We had a few years where we ramped it quite rapidly, then we just did some small growth. Now we're going into the cycle in the second half of the year where we should start to see strong growth again in the company. And the core reason for that was our product portfolio. We were looking at strengthening and revamping and getting our next generation technology to the point where we could really expand and start to see some economies of scale of using a cloud-based system. Now that we have a large portion of that technology in place, and even though we're continuing to add to it, we're able to go out and start to sell some of the pieces of that technology into the market. And a good example of that is the video visitation company that we recently acquired at the end of 2013. We're starting to ramp up sales in that area, as that is another sales point that we can go into customers and sell this type of technology, and that's been very successful for us so far, and we're just starting to see it ramp in 2014.
Thank you, Paul. And next question, what do you view as the most attractive foreign markets for Lattis?
Right now, we actually have installations both in Asia, Europe, the Caribbean, and the Canadian market. The Canadian market has been the first market that we've gone after, that we've been able to generate a significant amount of revenue from. We anticipate that will continue, but it is a relatively small market compared to the U.S. market. The other market that we're really looking at strong growth in is the European market, and we're currently working on response to a few RFPs in that area, and we anticipate that that will be our largest growth going forward. We do have some other installations that we're working on in Asia and other parts of the world, but as far as the biggest growth area right now, that's going to be the Western European market for us.
Thank you, Paul. And our next question, how should investors expect the new jail management system to affect revenues per customer numbers?
Well, the next generation jail management system will just be going through beta tests through this year. So you'll start to see the revenue impact of a lot of the new technology into 2015. And a lot of the things around products such as jail management systems, the video visitation, what it allows us to do is go and introduce our company and introduce our technology to customers beyond just the telecommunications component. And the reason that's important is telecommunications contracts are very cyclical. So state by state, the contracts come up in a periodic fashion. So it's not something you can go in and just sell until a contract's expired. The other technologies that we've added through the Icon product, such as video visitation, the jail management system will be introducing. We're actually going to be introducing a tablet-based technology in the third quarter as well. Those types of technologies allow you to go to sell something to the customer before the telecommunications contract even comes up. So what it does for us is it reduces the sales cycle for going in and selling to certain customers. So what you'll start to see as we add more of these technologies through Icon, our sales cycle will be reduced and our revenue and number of customers will increase proportionately.
Thank you, Paul. And we have a few minutes left here. I don't know if we have any other further questions that have come in at this point. In the few remaining minutes, can you just, I guess you've already made a lot of great points about the company, but what would be the main takeaway you think investors should have about the Lattis story going forward?
A couple of things. We're, as far as the U.S. market, we're really looking at grabbing a significant amount of market share from the small and mid-sized facilities, because that's been an underserved market as far as integrated technologies go, and that's really our sweet spot. Because we have a cloud-based system, we can offer the same services whether it's a small facility or large facility. So what you've seen as far as the growth has really just kind of been a beta test of our business model. Now that we've got proper financing coming into the company, a new technology and product portfolio, you're going to start to see the rapid growth of the company and see us start to grab domestic market share. On the international front, what we've seen there is that there isn't a solution provider that provides a complete cloud-based integrated solution like we have. And that provides us the opportunity to go and capture international market share with very little competition in that market as we see today. The other thing you're going to see is as our platform increases, we're introducing a tablet-based technology which will allow us to provide a whole new suite of services to both the inmates, the friends and family, and the facilities themselves, which should help expand our revenue growth in the company.
Thank you, Paul. And there were no more further questions. We want to thank, we were just speaking with Paul Burgess, CEO of Lattis Incorporated. Ticker symbol is, again, LTTC on the OTCQB. For any investors interested in staying up to date on the latest developments of Lattis as things move forward, please enter your email address in the box below the presentation window. Also, you can follow the conversation on Twitter at RedChip Nation. That's our Twitter handle. Please visit that as well today throughout the conference. We'll be moving on to our next presentation momentarily. We're going to be going to Drew Desai, CFO of Quadrant 4 System. Ticker symbol is QFOR on the OTCQB, and that'll be getting started just in a few more moments. Thank you again for joining us, everyone.
Hello, everybody. Greetings. My name is Drew Desai. I'm the Executive Chairman and the CFO for Quadrant 4, QFOR ticker symbol, a vertical cloud platform company servicing healthcare, media, and the retail vertical sectors. Today in the presentation, right after the safe harbor statement, I'm going to review with you the exciting quarter we just had, Obviously, for some of the new followers, I will review the basic business, its inception, and the track record one more time. And we will be talking with you all where we are taking the business and why we are excited about where we are today. Obviously, a quick summary. Trading OTs over the counter, market cap just under $40 million. Fully diluted shares, roughly about 95 million, and servicing healthcare, media, and retail industry. Products and service offering should be categorized as a platform as service, software services for the quick comps and so forth. Very quickly, what do we do? We are a next generation vertical cloud company. Let me take a second defining what a vertical cloud is. Vertical cloud is cloud 2.0. In our next slides, we're going to talk about it. It is what everybody does in the cloud plus something else. Your general cloud company does the storage optimization and some of the efficiencies related to the CapEx dollars. We not only leverage that technology for all of those reasons, but we also load up the business systems and the enterprise applications on top of that and turn that into a vertical cloud offering, which is honed in and extremely, positioned well to address all of the nuances of the specific vertical industry. Anyway, so we have built our vertical cloud platforms on a core set of proprietary technologies, which is our core DNA, social mobility analytics and cloud-based computing. We have used our proprietary core basket of SMAC technologies into building 3 vertical chassis, we call them, QHIX for the health exchange, QBlitz for the media and publishing, and QSKU for the retail and logistics management system from the cloud. Obviously, we are beyond startup stage, we are beyond beta. All 3 platforms are in deployment, and we have got a little over 150 very key clients relying on these people and personnel and the platform to manage their mission-critical applications. Very quickly, for the people who are new to the story, where we started, how we started, where we're going, on slide number 6. The company was started in 2010 as a private company with the founders' own seed capital coming in to start the company. Me and my partner, Dr. Tandawari, are one of the founding partners. And obviously, our strategy was to, for the first 2 years, we would acquire certain synergistic asset and build core competencies and technologies in social mobility analytics and cloud computing, and then raise a little bit of money in the public sector and realign those technologies to build a very large, very massively scalable set of platforms for a vertical specific applications. So that's where we are at now. After the first couple of years worth of M&A, we acquired a set of technologies that are proving to be a right set of technologies because it is improving our time to market, and it is giving us a huge leg up over our competition because it has got a very comprehensive product and feature set offering that we've been able to put together. One more comment that I'd like to make before we move on is the company has been growing for the last 4 years. Last year we finished at $37.5 million top line, producing about $4.5 million EBITDA. That is roughly about 35% growth over 3-year period. And the other thing that I want to point out is obviously our products and our platforms are targeted towards filling in rather large spaces, very large opportunity, very large market segment. Each of the 3 market segments that we are active in roughly gives us $1 billion, addressable market. And we're going to break it down for you as we move forward in the presentation. next slide, obviously where we are today, our bulk of R&D is behind us. We have already rolled out 3, cloud-based platforms. We have got referenceable clients of a great importance and a great sort of notoriety. Obviously, we are at a sort of an inflection point where the core business is transforming itself from a services and system integration to more of a recurring platform-driven, software service-driven business. So it's one of those things where there were a lot of doubts when a software services company gets started and they say that we're going to be a technology company transforming ourselves. I think we are one of those companies that has got successfully been able to do it for all the right reasons, because we didn't want to raise a lot of capital and take a lot of risks in terms of deciding what platform to build and so forth without any customer sponsorship and so forth. So we not only were able to leverage the R&D, both time and capital, through the M&A process, but we were also able to leverage the customers that we got and the people that we acquired in the process, leverage them all to calibrate our product strategy and do it in a sort of a very compressed time frame at a very affordable price point, because some of the platforms that we are now launching and deploying literally would have costed hundreds of millions of dollars worth of R&D and several more years of making to get to this stage. Obviously, looking ahead, we are very excited to have finished this R&D work, and we are very excited to have put some referenceable clients and the paying lives and paying pops on the platform. Looking forward to expanding from here on out, both on the top line as well as on the gross margin expansion arena. And obviously, all the seasoning requirements, all the other lot of uplisting requirements are being met by the company, because we've been reporting 4 years now. So we are moving the company in the right direction. The next couple slides are sort of very detailed. I would invite you to pursue them at your own sort of a pace, but very quickly defining what a vertical cloud platform does. It's a cloud your traditional storage and cloud management, likes of Amazon's and so forth. Added to that, some of the industry logic, industry vertical, industry security access, industry logic in terms of analytics, commerce, transactional processing, all of them baked into it. We call it a vertical platform. This slide is just meant to just convey the fact that we have got a ton of proprietary innovations that are categorized in social, mobility, analytics, and cloud-based computing. We are able to leverage these proprietary horizontal pieces of technologies into building vertical set of chassis for media, healthcare, and retail. Not only that we have built these 3 chassis and they're rolled out with paying clients, but the company, as we move forward, is in a position to continue to open additional verticals with the application of these leverageable set of technologies. It is kind of a Lego system where we have built a huge inventory of Lego components which we can assemble into a set of chassis. And these are the ones that we are applying for the huge disruptions that we are witnessing in the 3 verticals. I'm going to very quickly go over those disruptions for you, and then we'll break it down what it means for us in terms of doing business. Health exchanges, everybody knows the way the Americans buy benefits and exchange and the healthcare products is at the inflection point itself. Obamacare in itself is a big catalyst, but the way the employers are now moving to the fixed contribution model as opposed to continuing to sponsor a health plan is starting to become a reality. And our health exchange platform allows both the employers as well as the health plans, health insurance companies, redefine their business plans in a way that they can offer this product in a marketplace-driven economy. The second vertical that we are really focusing on is media and publishing. I will very quickly define what that disruption is. As you all know, the readership and the magazine consumption is migrating more on the digital side. Obviously, publishers cannot walk away from the print side of the business, but they have to and they have to have strategies on how to efficiently distribute the magazines in a digital world, which is very complex. Multiple devices, a whole proliferation of the digital devices, iPhones, Androids, different tablets, different operating systems. On top of that, the whole consumerism, people don't want to pay for the content on a retail basis. So publishers are looking for technologies to be able to bundle the contents, identify the user group more precisely, and run the digital operations much more effectively, and most importantly, look at the ways to monetize the content by using the recommendation engines and some of the heavy-duty analytics that we provide in terms of defending their advertisement revenues and so forth. So that's the opportunity for us. We do that very effectively. We've been doing it for several years. And we just signed a very large contract. I'm going to talk about it in my next several slides. The retail industry, again, the disruption that we are focused on and which is meaningful for us is supporting and helping and letting the new and up-and-coming retailers compete with some of the established ones. And the new ones don't have any legacy retail operation systems, and they are heavily relying on analytics, knowledge-based systems, and just test the online multi-channel retail operations through social commerce, mobile commerce, your traditional online shopping, and some of the other co-branding, co-marketing, satellite store management, and so forth. So very quickly on a vertical cloud that is servicing healthcare, our platform got rolled out about a year ago. Today we have 5 exchanges in construction. We're not doing public exchange work. These exchanges help the brokers and health plans alike roll out the solutions for the Americans and the employers who are trying to buy health and benefit products in the open market. It's kind of like Expedia type of system. You go on a system like ours, and you just say, I'm Joe Blow, living in Montana, 52-year-old. This is how much my employer is going to give me to buy various health products, and this is how much I want to add. Navigate me through the shopping experience, and then complete the transaction for me as far as underwriting, managing the benefits, and so forth. So our system does everything end-to-end, shop and compare, experiences of marketplace, enrollment management, as well as financial back office component, and all of that is bundled into one system. It is offered through the cloud as a multi-tenant system. Our distribution strategy is we will be choosing carefully about 25 exchange partners from the broad cross-section of health insurance folks, the carriers, as well as some of the progressive global brokers who want to leverage this disruption, go direct to the consumers, go expand their product portfolio, change the distribution model, and truly embrace the consumerism that is about to happen in this industry. Our market size is about 120, 130 million Americans who will now be buying benefit products in such marketplace-driven systems. And obviously, as I suggest in our sales pipeline down below on this slide, we are operating with a very hefty sales pipeline. We are already in construction with about 5 exchange partners that include large insurance companies and the brokers alike. We are qualifying these additional opportunities. We are in trials with some of the very well-known insurance companies. For confidentiality's sake, I cannot reveal them right now, but we are looking very good to exit the year with some additional wins. Just one quick thing, how do we get paid and what's our revenue model? Our revenue model is pretty straightforward. It's between $2 and $6 per member per month on a recurring basis. And this range comes from the fact that people may be buying different set of products, health, non-health, all the ancillary products and so forth. And also, there are a whole bunch of portals that they could be availing themselves for wellness, for education, for obviously for different set of analytics for the health plan providers to be able to gather additional data on certain segments of the markets and analyzing their underwriting and risk-taking activities. So there's a whole set of features that are priced sort of on a line item basis, but on an average, we like to think that we can get anywhere between $50 to $75 per year per person on our system, and very quickly it can become a little over $150 million run rate type of opportunity for us, just based on the QHIX platform. The next slide number 12, it's a very busy slide. I apologize, but it is a quick summary of where the challenges lie. As I already visited with you these challenges, which is to empower the publishers with the knowledge and the technology to bridge the gap and actually go and build the businesses on the digital side, digital distribution of content and blending the advertisements through the recommendation engines that we have built. We signed a very large contract about four weeks ago with a publisher called Source Interlink Media. Source is the publisher of about 90 plus different magazines that includes Motor Trend, Hot Rod, all kinds of enthusiast related magazines. Our technology, our people, our platform are now being used by them to manage the content of all of these 90 some magazines in a way that they can distribute it over the different digital platforms. They can very precisely understand the demographics of who is on their websites and what content is of relevance at a given time, so that they can better monetize this content by using our proprietary technology that helps them use the recommendation engine, which will be a key to their monetization strategy as they rely on the advertisement revenues and so forth. So that's the QBlitz, our media platform. It does end-to-end media management for the publishers. We are opening doors. We are gaining some significant tractions with some of the national newspaper, as well as some of the other entertainment-related media publishers, giant ones. I believe, just like we said in our health exchange discussion, we have a little over 25 to 30 target publishers, each of which can spend closer to $15, $20 million a year on our platforms. So we just launched this platform this quarter. We are extremely excited about this and the potential it offers to us and our shareholders. And as we move forward with our sales pipeline and closing additional deals, we'll be reporting back to you on that. Very quickly, I know we have a little time limit on the pre-presentation, but very quickly on our retail vertical cloud platform called QSKU. Obviously, it's like analytics heavy. The specific segment that we work for is the small and medium and up and coming retailers who don't have a lot of legacy retail operations. A lot of legacy mature retailers are struggling with the inflexibility of the different systems that they have invested in, but the newer ones are able to give a complete experience to their consumers, no matter where they are coming from what channel of shopping they come to, whether it's a social media-based channels or mobility-based channels or storefront anywhere in the cloud. We give them all the analytics. There are certain examples that I have given on this slide that help them decide what items to inventory where, what is the conversion of these items into sales, what is the per square feet, expected revenue generation in a given geography, so that their expansion strategies are much better. And obviously, these are all built on open source, so our system would allow these up-and-coming nimble retailers walk away from having to pay very large software licenses to the likes of SAP and Oracle, while they can achieve similar or even better, more faster results. Some of our key clients include the likes of American Apparel, and a largest Verizon Wireless retailer out the Southwest. There are several grocery chains that are up and coming, which has got 10s and 20 stores. So that base is growing, and we're looking forward to having an exciting year on that front as well. The next slide is just a quick snapshot. I just want to share with you how fortunate we feel having such impressive list of clients that have come to rely on us year over year. These are all multi-year recurring relationships, and they trust their mission critical aspects of business to us, and we are very fortunate to have them shaping our product strategy as we move forward. Very quickly on a financial summary side, I just wanted to show how we are consistently growing year over year, both on the top line as well as EBITDA contribution. Just a quick point I'd like to note on 2012, it was a little bit of a compression year that was primarily coming out of a singular event from Kodak bankruptcy. We lost some money there, but we have recovered well. Both on the top line as well as on the bottom line. The other part of the picture that doesn't come quite clearly out of this chart is in the early years, we were doing some acquisition work. So as everybody knows, acquisition work always also bring a set of book of business that is not really desirable for a go-forward strategy. So in this growth chart, not only there is some organic new businesses, but also there is a businesses that got backfilled by replacing some of the businesses that we acquired, but are no longer necessary or strategic to spend our resources and engineers on. So I think the picture doesn't do the justice of our organic growth strategy. We're growing pretty close to about 30-35% organically on the areas that we have chosen to grow in, and that are more in line with our company strategy. I just want to spend a couple of minutes giving a quick synopsis of what to expect in 2014. We're looking to finish up the year. We have given a guidance of $50 million top line, which would be up significantly. Last year we did 37.5. We would exit 30% gross margin on a combined basis, which truly proves my point that the company is at an inflection point of completing the transitioning from a software services and an acquisition-related company into more of your classic platform as a service, software as a service provider that would typically be characterized with a high gross margin and a larger portion of the revenue coming through a recurring revenue through the platform services. We would like to exit the year with 75% or greater recurring revenue. We are currently at about 70% recurring revenue, but the bigger story is in how the revenue mix we want to exit the year with. We'd like to see a little over 35% of our revenue coming through the new introduced platforms, both in QHIX, QBlitz, and QSKU products that just came out this year. Obviously, more quantitatively, we have signed 5 health exchange deals. We'd like to sign 7 more this year to make it about 12 before we exit the year. And when we add up the underlying business and underlying number of lives and premiums that these partnerships service today, would be north of 2 million. So what I'm saying to you all is in next 18 months, we expect to onboard all of these people, a little over 2 million people onto our QHIX exchange, and that will be a very significant milestone. And the even more important and significant milestone to talk about today is to finishing up all the plumbing and the technology decision with all these 12 exchange partners. The lives will move and migrate and transition onto the platform, and recurring revenue will start to move. Let's just first build them out and win the technology selection. So having a very wide and very robust pipeline puts us in a very, very, very favorable position to achieve this goal, and I think we are very excited about finishing up that milestone this year. On the media business, we are setting ourselves to exit the year with a little over $100 million in the total contract value. And obviously, we are a little over halfway mark there with just one contract that we signed, which is an indicative of how strong the pipeline is and how the sizes work in this business. We have signed a 5-year, $50 million contract just about 3-4 weeks ago. The contract is going very, very well. We have onboarded their systems and people onto our system, and their contract is actually generating revenue and the margins for us as we speak. So that's who we are. It's a growth story, my friends, and I'd like you to continue to watch it carefully as we unfold the rest of the story. We are very excited about these platforms that we have built for a fractional cost that the industry has seen spent otherwise in other places. And more importantly, these are very fresh, very forward-looking set of technologies that will enable both us as well as our partners explore the new and disruptive business models and reap the economic benefits as we move forward in the year 2014, 15, and 16. Like I said, we have got a very, 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 very high quality blue chip clients on our system already. The platforms have referenceable clients and revenue generation in place. Our operations have been tested and working very smoothly. All the acquisitions have been fully integrated, fully branded, and all the acquisition-related risk has been taken out of the system. We've been generating EBITDA positive results for the last 15 quarters straight and showing some significant movement and the progress in the industries that clearly are offering us very large playing fields. So that's all I have. Obviously, industries with a large disruption, healthcare and media is where we are focused. We are leveraging our core R&D across multiple sectors, and a bulk of R&D, all of the heavy lifting has been completed. Each of the 3 platforms that I reviewed with you offers a little over $100 million SaaS or platform as service type of revenue streams that we can build out over the next 3-year period. These are all long-term recurring relationships, and company is at an inflection point. So those who are very, very much interested in comparing the traditional SaaS and platform and services business models with our peer group, we are making move towards that position. So as you continue to track us and as continue to analyze us, you will be happy to see that we are conforming to those numbers and those metrics, if you will. And we're looking forward to continuing to report to you the progress and the wins that our team is working on. And thank you again for your interest. And anytime if you have any questions, please reach out to me directly for anything about the platform, the technology, the market, the performance, anything. I'd be happy to discuss with you. Is there any questions? I don't know how much time we have now on this call, but I'll take a few questions. If not, please reach out to me directly.
I want to thank everyone again for joining us today at the RedChip Global Online CEO Conference. We were unfortunately able to reach Drew Desai of Quadrant 4 System for the Q&A session. So we're going to move into our next segment, which is actually a RedChip Money Report TV interview with Tom Brady, CEO of Alira Therapeutics, ticker symbol ALDX on the NASDAQ. And we're playing that interview for you right now. Thank you again for joining us today.
Todd, thanks for being with us today.
My pleasure. Thanks for having me on the program, Dave.
It's my pleasure. And congratulations, you raised $12 million. You were just put on the Russell Microcap Index. You know, I want to start with your background. You have not only a medical degree from Duke, you have a PhD as well. And you've spent 18 years in the biopharma industry. Just give us a brief overview of your background and then what you hope to accomplish with Alira over the next several years.
Well, you know, when I was in medical school and graduate school many years ago, we were involved in starting a biotech company. I've been on the industry side ever since, and most recently spent 10 years on the investment side of the world's largest and oldest healthcare venture capital fund, Domain Associates. This deal, Alira here, was my first deal back in 2005. I've been on the board ever since, and was fortunate to recruit Johnson & Johnson to the table as an investor.
That's very significant, and investors should take note of that. Talk to us about the technology a little bit, and then I want to talk about these two trials that you're going into.
Sure. Aldehydes, Dave, are a toxic class of chemicals. We all have them. They're rampant in many biological species. The problem is they do bad things. So they bind to proteins, they bind to fats, they bind to DNA. They're toxic. And never before has the pharmaceutical industry thought about them as targets. And so we have developed what we think the first concerted effort to trap aldehydes. And that's the whole basis of our pharmacologic platform here at Alira.
Okay, now you're going into 2 clinical trials this year. So talk to us about those clinical trials, and one's a phase 2/3. I think they're both phase 2, phase 3, right?
The first, which is what we hope will be a phase 2/3 trial, a late-stage clinical trial, is in an orphan disease. That is a very rare disease, probably about 1,000 patients in the U.S. that have a genetic mutation in an enzyme that metabolizes aldehydes. That's one trial. The next trial is an anti-inflammatory approach with a severe ocular disease called uveitis. Uveitis is a very poorly treated condition. When it occurs in the front of the eye, it can be very painful. You can treat it with drugs called steroids, but the problem with steroids is they're toxic. So they cause cataracts, which are opacifications in the lens, or they cause glaucoma, which is increased pressure inside the eye that can lead to blindness. So the demand for a novel, non-toxic therapy in uveitis and frankly other inflammatory diseases is very large.
When do you actually go into these trials?
We're hoping, towards the end of this year to initiate these trials. We've told the street that we're going to report these trials the second half of next year. We believe in under-promising and over-delivering, so I think there's some upside to those.
Okay. Now, the trial that treats the ocular disease, that's about a $200 million market opportunity for you, correct?
At least. I think inflammation in general is a large market. We said about Sjogren-Larsen syndrome, which again is the orphan disease that it affects the skin all over the body. That's at least a $200 million market in the U.S.
Okay. So that what alone is a $200 million market. You would be the only one with the drug. Not a bad value proposition for a company with a $40 million market cap at this point.
That's right. And better than that, we get to help a whole subset of patients that have no options today.
30 seconds. I've got to close it up. What's the essential value proposition today, Todd, for investors?
Well, I think if you're an investor, you can focus on 2 things. The first is what I've already talked about shots on goal. I would never invest in a biotech that has a single shot on goal. We have many shots on goal. We're starting with 2 clinical trials. I have high hopes for both of them. The second I would focus on is our comparables. So if you look at other orphan disease companies that are roughly at the stage we are now, they're multi-billion-dollar companies, many of them. We're sitting at a $40-odd million market cap. There's your room for appreciation. I think that's a good value proposition for an investor.
Dr. Brady, great being with you today. We'll have you back on soon. Thank you.
Drew Desai, CFO of Quadrant 4 System, ticker symbol QFOR on the OTCQB. And welcome, Drew.
Hey, how are you?
Very good. Got quite a few questions. We'll jump right in here. You recently reiterated your target to reach 2.5 million lives on your healthcare exchange by the end of 2015. Can you go over some of the factors that make you confident in this projection?
Sure. We have got, as you all know, we have 5 exchanges that are already signed and under construction. We are very confident that before the year end, we will sign another 5, maybe 6 more exchanges. Exiting the year 2014, we would have about 11, 12 exchanges under our contract. And obviously, we are working out of a very large pipeline. We have set out to build about 25 private exchanges total. So we'll be halfway through the mark. And on an average, we are looking at every exchange partner to have a underlying business that represents anywhere between 100 and 300,000 lives. So what we are doing that is, if you do your math, it just gives us an access to a little over 2.5, 3 million lives based on the contract that we would exit the year 2014. And that is the basis for giving the projections and giving the guidance that if we exit the year 2014 with the exchange partners signed and sealed, that represents their book of business worth 2.5 million lives. So over 12-month period after that, I think the transition and the enrollment will be complete. Exiting the year 2015.
Okay, thank you, Drew. And a couple similar questions here, so I'll bring these together. What are some of the big name clients of Quadrant 4 System, and do these blue chip customers help when it comes to marketing new products?
The overall Q4 client list that you see is there are a lot of blue chip customers that we have, all the way from Alcoa, Blue Cross, Blue Shields. We have got Sourcing Building Media. We've got Tribune Company. We just added to our distinguished list of customers. We have got Ford, General Motors, Chrysler, Kia Motors, Walgreens, all kinds of domestic names, if you will. And we are very fortunate to have these clients that we've been servicing over year, a number of years. Most of them are under our long-term recurring contracts, service agreement, managed services. Some of them are on our platforms. And it not only gives us the visibility in our revenue stream, but it also gives us a very strong calibration on what technologies and what additional things that we need to add to our platform.
Okay, thank you, Drew. Our next question, what are the main drivers behind increasing software as a service related revenue?
The main drivers are basically our platforms are now at a point that I think the features being added to the platforms are completing the range. There are many constituencies in the marketplace that are finding it very attractive to get all the features and functionalities under one platform. We are proving that these technologies are scalable and extremely leverageable. And as the deployment of these platforms grow, the number of subscribers, number of organizations on the platform increases. It gives us a ability to expand our gross margins, because beyond certain point in a software service and platform services business, beyond certain point of utilization, I think that every incremental dollar revenue gives us a greater gross margin potential.
Thank you, Drew. And our next question, should we continue to expect more announcements with regards to contracts from the media division?
Sorry, what was the question again?
In regards to the media division, what could be the expectations for more announcements regarding new contracts?
I think just like what we had said about our healthcare business, that our target is to have 25 strategic partners to bring onto our platform. And these are the partners that are battling the disruptions in the healthcare industry. And they believe that our technology platform gives them an edge over the rest. And all these 25 partners are not in competing spaces. In fact, they are more of a collaborative. So media has a similar equation for us. There are about 25, 30 very large publishers in the media industry. They are trying to gear up for a digital business model for the digital publishing, and they are relying on our technology set to go to market faster and actually monetize their content pretty effectively. So we have a very full pipeline. As a matter of fact, the Source Interlink Media contract is a 5-year, $50 million contract, and that is a sort of representative contract that we can actually expect to get from a majority of these 25 partners that we are pursuing. We expect to close maybe one, maybe two more of these kind of contracts this year. Some of the validation and pilot activity with some of these large publishers is already underway, and it's just a matter of time that entire blueprint of their transition is made out, and return on the investment is calculated, so that we can extend the final arrangement and get it signed off. So we are very comfortable that maybe one or maybe two more such deals will be completed this year.
That's very good news, Drew. Our next question, it's actually in regards to this morning's announcement. This investor is wondering if you can just comment a little bit further detail about what this announcement means for Q4. And for our viewers that haven't seen this, Quadrant 4 announced this morning that they've secured a web broker entity agreement with the federal government for the Centers for Medicaid and Medicare. So if you can just comment on that a little bit, Drew.
Absolutely, Paul. I mean, this is a very significant milestone in terms of completing the scope of the platform as a truly one-stop shop in terms of the marketplace. As you know, with the evolution of moving the employee base onto the defined contribution, the employers are moving the employees on the defined contribution model and driving the employees to do their shopping and enrollment on a private and or public health exchanges. By having a private exchange like ours, completely connected with the federal systems, is a critical piece in terms of giving a full and consistent experience of shopping and enrolling and managing the benefits to every cross section of the employee groups. Because, say for example, if Walgreens decide to move all of their employees on a private exchange, Walgreens has got such a wide census. There are certain portions of their employee group would be part-timers or people who are probably making a lower income level or what have you. So they may be eligible for a series of subsidies, and they may find it attractive to actually go and shop on the federal programs. But on the other hand, some of the other benefits they may be interested in participating alongside with the rest of the employee populations of all Greeks. That's just an example. So what this does for our platform is all of our broker community as well as our employer groups can now standardize on one platform that gives their entire employee population an ability to shop completely, whether private plans or private products or public products, calculate the subsidy and eligibility, and make the decision on one platform. Does it make sense?
Yes, absolutely, Drew. Absolutely.
Because this just avoids fracturing the shopping experience and managing the benefits. Because if a private exchange doesn't offer disconnectivity, what that means is a certain population that is looking to do shop would have to do shop in two different places and make the payments and the benefit management under two different systems, and that would defeat the purpose. And I don't think there is any other technology company out there that we know of has an ability to provide this certification. So a lot of brokers can also ride on the back of this platform being certified, so that they don't have to go and get the certification to be eligible to do commerce on the federal platforms. We provide them that gateway.
Very good. Very good. Thank you again, Drew. Our next question: how does the retention rate or attrition rate of Quadrant 4 compare to its peers?
Are you talking about the employees or customers or what?
I would assume that we're talking about the customer retention and attrition rate.
Well, customer retention is pretty high. I mean, we have never been fired by any customer so far. Not good, because our people take a lot of pride in what they do. As far as customer service and delivery, quality is excellent. Pricing is always great, and obviously we are a very broad offering company that's got the state-of-the-art technology, and we actually build long-term partnerships with the customers. So switching us out in itself for saving a couple of dollars is a large cost to them in just switching for the sake of switching, especially when a partner like ours is performing and has a track record for a number of years. So there has been some planned attrition because as we grew through acquisitions, we did inherit certain clients and certain contracts that doesn't quite fit the go-forward strategy, and in those cases, I think as the contract comes to a natural conclusion, we're not opting to remove some of those contracts, but we are actually choosing to backfill the new business with the current customers, or actually going after the new customers and redeploy those resources to pursue the business areas which are more in line with our growth strategy and our focus areas.
Thank you, Drew. We had actually this question from a few different investors as well to kind of comment today. Will you need to be raising any additional capital to support growth going forward?
On a day-to-day basis, I think we are very comfortable. We are cash flowing positively, nicely. We do not require capital for any of the capital expenses and so forth. But so from their standpoint, there's no planned initiative on the way to raise any capital to just keep the lights on or to fund some of the initiatives. None of that. But that is all planned and budgeted within the current revenue sources and the profits that we are making. Having said that, as you all know, we are going after some extremely large, high dollar value contracts. $15 million 5 years was the last contract that we booked. We had a work cut out for us to convince everybody on the other side, meaning our customers, that we would not have a liquidity crisis, or our cash flow will not create any sort of hiccup for them, because obviously our balance sheet does not have a lot of cash on. So it's a sort of a delicate question. I'm not interested in diluting anybody just to create some cushion on the balance sheet, but everybody knows that we are going after some extremely large contracts, and it's very, very critical question being asked to us every once in a while. What are your plans to make sure that we are working with a stable partner? So I guess we we're not looking to raise money per se, but when the equity value reflects the fair market value of our company, we will consider doing something at that point. But at such low market capitalization, I think it's just impossible for us to think about raising capital of any significant dollar amount.
Very good. Thank you, Drew. And our next question, I guess this is in regards to growing your talent pool in India as far as employees. This investor is wondering if you have a head count that you're striving toward, or will some of the expenses related to this continue for the foreseeable future?
I think the headcount-wise, I mean, we are kind of at a point where we have pretty close to about 400 odd some offshore resources. They are under contract with us. They are our dedicated contractors. They're not our employees, but they are kind of under a non-compete, non-circumvent. There's an outsourcing shop that has an exclusive relationship with us. So we will see some growth in that headcount as we grow our business. Our U.S. headcount is pretty close to about 275, 300, which will stay pretty flat. We don't expect to decrease it much more unless there's a huge implementation or customization related project that can come along. So it will all be gated with the revenue and the kind of revenue and the project that we require. But currently we're doing well. There's no any planned expansion as far as the headcount and the labor is concerned.
Thank you, Drew. And doesn't look like we have any additional questions. So I guess to wrap things up, Drew, I mean, you've already talked about, obviously, most of the major points, but what is the main takeaway investors should really leave today with regarding the Quadrant 4 story?
I think the main takeaway is as follows. Our technology is going to be the winner at the end of the day. As the disruptions make our partners adapt to new and emerging business models, whether be it in healthcare or be it in the media or be it in retail, I think our technology and the platforms are going to be called upon to prove their economics. And I think we have done a tremendous job of building very scalable, very massively scalable, highly leveraged technology platforms, which are getting a lot of validation, and we are getting long-term recurring contracts that gives us a great visibility on where the revenues are going to come and where the year-over-year growth is going to come from. And obviously, healthcare remains to be one of the very bright spots, but we also have media, which is developing extremely rapidly, which also gives an equally well-balanced growth opportunity for the company. And most importantly, our Snack-based technology stack is actually putting us in a position to keep on opening additional verticals if we see ourselves being able to impact that disruption in that particular industry. So we are feeling very good about our chances of being able to meet our $300 million revenue target for next 3-year period.
Very good. Thank you, Drew. And for investors that want to stay current on this exciting story, please make sure that you enter your email address in the box provided below the presentation window, and we'll consistently keep you updated as things develop. We are now going to move back into our interview with Alira Therapeutics, and again, we were just speaking with Drew Desai, Chairman and CFO of Quadrant 4 System, ticker symbol QFOR. We're going to go back now to our interview with Alira Therapeutics, ALDX, on the NASDAQ.
Todd, thanks for being with us today.
My pleasure. Thanks for having me on the program, Dave.
It's my pleasure. And congratulations, you raised $12 million. You were just put on the Russell Microcap Index. I want to start with your background. You have not only a medical degree from Duke, you have a PhD as well, and you've spent 18 years in the biopharma industry. Just give us a brief overview of your background and then what you hope to accomplish with Alira over the next several years.
Well, when I was in medical school and graduate school many years ago, we were involved in starting a biotech company. I've been on the industry side ever since, and most recently spent 10 years on the investment side of the world's largest and oldest healthcare venture capital fund, Domain Associates. This deal, Alira here, was my first deal back in 2005. I've been on the board ever since, and was fortunate to recruit Johnson & Johnson to the table as an investor.
That's very significant, and investors should take note of that. Talk to us about the technology a little bit, and then I want to talk about these two trials that you're going into.
Sure. Aldehydes, Dave, are a toxic class of chemicals. We all have them. They're rampant in many biological species. The problem is they do bad things. So they bind to proteins, they bind to fats, they bind to DNA. They're toxic. And never before has the pharmaceutical industry thought about them as targets. And so we have developed what we think the first concerted effort to trap aldehydes. And that's the whole basis of our pharmacologic platform here at Alira.
Okay, now you're going into 2 clinical trials this year. So talk to us about those clinical trials, and one's a phase 2/3. I think they're both phase 2, phase 3, right?
The first, which is what we hope will be a phase 2/3 trial, a late-stage clinical trial, is in an orphan disease. That is a very rare disease, probably about 1,000 patients in the U.S. that have a genetic mutation in an enzyme that metabolizes aldehydes. That's one trial. The next trial is an anti-inflammatory approach with a severe ocular disease called uveitis. Uveitis is a very poorly treated condition. When it occurs in the front of the eye, it can be very painful. You can treat it with drugs called steroids, but the problem with steroids is they're toxic. So they cause cataracts, which are opacifications in the lens, or they cause glaucoma, which is increased pressure inside the eye that can lead to blindness. So the demand for a novel, non-toxic therapy in uveitis and frankly other inflammatory diseases is very large.
When do you actually go into these trials?
We're hoping, towards the end of this year to initiate these trials. We've told the street that we're going to report these trials the second half of next year. We believe in under-promising and over-delivering, so I think there's some upside to those.
Okay. Now, the trial that treats the ocular disease, that's about a $200 million market opportunity for you, correct?
At least. I think inflammation in general is a large market. We said about Sjogren-Larsen syndrome, which again is the orphan disease that it affects the skin all over the body. That's at least a $200 million market in the U.S.
Okay. So that what alone is a $200 million market. You would be the only one with the drug. Not a bad value proposition for a company with a $40 million market cap at this point?
That's right. And better than that, we get to help a whole subset of patients that have no options today.
30 seconds. I've got to close it up. What's the essential value proposition today, Todd, for investors?
Well, I think if you're an investor, you can focus on 2 things. The first is what I've already talked about shots on goal. I would never invest in a biotech that has a single shot on goal. We have many shots on goal. We're starting with 2 clinical trials. I have high hopes for both of them. The second I would focus on is our comparables. So if you look at other orphan disease companies that are roughly at the stage we are now, they're multi-billion-dollar companies, many of them. We're sitting at a $40-odd million market cap. There's your room for appreciation. I think that's a good value proposition for an investor.
Dr. Reddy, great being with you today. We'll have you back on soon. Thank you.
I want to thank everyone again for joining us today. We were just watching an interview with Todd Brady, CEO of Alira Therapeutics, ticker symbol ALDX on the NASDAQ. We're going to be going into our next presentation in a moment. I do want to remind viewers, if you want to see the schedule, just scroll down on your screen, and the remaining schedule for the day is there for you. Also, you can submit a question by clicking the Submit Question box at any time and entering a question for any of our presenting companies. Our next presentation is going to be Energy Fuels, which trades on the Toronto Stock Exchange as well as on the NYSE market under the symbol UUUU. Again, NYSE market UUUU, Energy Fuels, and we have Curtis Moore, Director of Marketing and Corporate Development, presenting for the company. Thank you.
Good afternoon. My name is Steve Antony. I'm Chief Executive Officer for Energy Fuels Incorporated. a uranium mining company located here in Denver, Colorado, with operations throughout the western U.S. This afternoon, before I begin, please look at the forward-looking statements and technical disclosures required by the applicable markets. This afternoon, I'm going to talk about the company. I'll give you a little bit of an overview of Energy Fuels. I'll touch on the uranium market outlook. Then I'll describe our current operating platform, and I'll close with an overview of our current financials and guidance that's been provided to the market. Energy Fuels is a company that is positioned for growth. We're a major U.S. uranium producer today, and we produce over 25% of the total U.S. production in 2013. We have a strategic position in that we have the only operating conventional uranium mill in the United States. We have significant growth potential through our wide variation of uranium resources located throughout 6 western states. As prices recover, we're in a position to put these resources into production to meet increasing demand. Our staying power is robust in that we currently have $42.3 million of working capital, and we can weather the current depressed market conditions. We are fortunate to have long-term contracts in place at significant margins high above the current spot price. Turning to plate 6, I emphasize we are a conventional uranium producer in the United States. This is in contrast to in situ resource recovery operations, which use a different method to recover uranium. So conventionally, it's a tried and true method, has been significantly de-risked over all the decades of production starting in the 1950s. We incorporate a hub and spoke production strategy around our White Mesa mill located in Blanding, Utah. We're currently producing from that mill along with the Pine Nut Mine, which is located in northern Arizona. Pine Nut Mine is producing because it has the highest grade of some of our active permitted mine locations and can produce despite the current low spot price. We have significant growth potentials through our holdings throughout the western U.S. We have projects on standby, ready to recover as prices increase. We're permitting significant other resources that should be ready when this price rebounds. Our dominant position is the most important uranium districts in the U.S. We have built an enduring uranium mining company. Our significant resources are sufficient to execute our business plan throughout 2015 and beyond. The strength of Energy Fuels is in its long-term contracts. We have 3 contracts averaging over $58.42 a pound. All contracts are currently at their floor levels, which give them insulation against further reductions in the market price. As we move forward with our business model, we are divesting of non-core assets, which were accumulated through 4 acquisitions over the last 5 years. This will just add additional capital for use as we see fit. A snapshot of Energy Fuels is located on plate 8, giving you a look at our current market capitalization of some $156 million. Our current analyst coverage through 5 major investment banks in the country, and our 1-year share performance. We are fortunate to have strong trading liquidity in this depressed market. Plate 9 shows our management team and our board of directors currently as it exists. Most of my management team has been with me the last 6 years of this company's existence and has deep experience in the uranium mining business. Our board of directors are significantly experienced also, with some coming from such major companies as Newmont Gold and Dundee Resources. The uranium market outlook as we see it is nothing but positive. The world energy demand is increasing dramatically. As you look at all statistics, these from the World Nuclear Association show the growth of world electricity demand throughout the world as economies move into larger middle classes and develop their populations such that the increase in electrical devices is just skyrocketing. Especially growth in nuclear generation is expected to service this growth in electrical generation, as nuclear power is one of the most basic load sources of power, along with coal and fossil fuels. As we enter the market and we are faced with questions from time to time trying to ascertain the current market status. Of course, the weak prices are what categorize the market today, and these come from current events that have occurred in the industry. The most notable is the shutdown of the Japanese reactors in Japan. The common question is always, do you feel the market will react once these reactors come online? I think the overall consensus answer is yes, they will respond, and we expect to see upward price movement at that time. The areas that the majority of production in the world comes from today are in highly geopolitical risky areas of Central Asia and Africa. Kazakhstan is the largest single producer country today. Can it maintain its supply? Well, that's another risk factor that has to be judged in the marketplace. The increasing concern about climate change plays right into the supply of uranium as a nuclear fuel for these nuclear power plants. Now, again, nuclear power is truly a green generating source over and above any fossil fuel source. And it's a little fact that doesn't have significant recognition in the overall world marketplace, but we think that will change as countries and governments focus on the climate issue. Of course, China is a major developing nation for nuclear power consumption. They're building many new nuclear power plants, and they expect to increase their overall percent of generation to the nuclear side from the current 2% level to over 5% by 2020. Plate 14 describes the current cost of production situation throughout the world. This place is intended to indicate the level of production that is at above current spot prices. 80% of the current production, we believe, is not economic at today's prices. Moving to plate 15, our strategic position in the U.S. The U.S. is the largest producer of nuclear power in the world. It started with our build of the nuclear power units in the 1950s, continued robustly through the 1970s, and of course came to an abrupt halt in the early 1980s and went into a 25-year hiatus until recovering in the early 2000s. We do consume over 50 million pounds of uranium, of which we only produce 4.5 million pounds a year. This significant shortfall makes us highly dependent on imports from potentially unstable areas of the world. Our moving on to Energy Fuels operating platform, our most strategic asset is the White Mesa Mill, as depicted on plate 17. It was built in 1980 and has been a reliable supplier of U3O8 since that time. It has ample licensing capacity of over 2,000 tons a day, or 8 million pounds of U3O8 per year. At its peak, it produced over 4.5 million pounds of U3O8 per year, and that was in the late 1980s. It's centrally located amongst the resource areas of the western U.S. and can draw through the hub and spoke philosophy as far as 300 miles away. Some of our operating areas I'll talk about next. The Arizona Strip, which is a high-grade, low-production area in northern Arizona, currently hosts our most our largest operating mine to date, and that's the Pine Nut Mine. We have projects in Wyoming. The main project there is the Sheep Mountain Project, which was a prolific producer in the 1960s. It has ample resource that can be restarted, and it is a fully permitted mine. It does require a processing facility, however. Moving into New Mexico, we recently acquired a company, Strathmore Minerals, with a large blue chip project located in the prolific Grants Mineral Belt in the northwestern New Mexico. This is part of the Mount Taylor, Roca Honda, Kerr-McGee trend in the Grants Mineral Belt, which produced in excess of 600 million pounds from the late 1950s through the 1960s and into the 70s. Our other major area of operation is the Henry Mountains Complex, located and depicted on plate 21. The Henry Mountains Complex is a large complex consisting of 2 to 3 mines, which were operated and built and operated in the early 1970s by a company called Detroit Power. This area affords us probably our largest single near-term source of production, and it is only 50 miles from the White Mesa Mill, so we won't need a processing facility for that complex. Additional areas that we have that support our near-term production claim include the Colorado, what's called the Colorado Plateau, around the Colorado-Utah border, between south of Moab, Utah, and east of Nucla, Colorado. There's a series of 6 mines that were producing as recently as 2012 when we acquired Denison Mines and became a production company. These mines were shut in when the price was $52 a pound, and actually can recover and begin operation in anywhere from 3 to 6 months in as the price gets to that level again. As I said before, we have the largest 43101 compliant resource base amongst our peers, boasting some 92 million pounds of resource. Moving to plate 25 is an overview of our financial highlights for 2014 for the first quarter ending through March 31st. Now, we sold 192,000 pounds of uranium, and of course we produced 126,000 of those pounds, and we have 385,000 pounds in inventory currently. We realized $11.4 million of revenue, and we ended the quarter with $16 million in cash and additional working capital totaling $42 million. To weather the current market situation, we employ a 2-pronged strategy. One is to manage assets conservatively. Doing this will fulfill our current contract requirements. We'll focus on low-cost production like the Pine Nut Mine. We'll purchase select spot purchases and deliver into contracts which allow us to do so. And we'll reduce our costs and sell non-core assets which we have accumulated through this series of roll-ups in the last 4 years. We will intend to create and sustain our optionality by maintaining the operations on standby that I previously mentioned. We will pursue and continue to develop our large baseload mines to be in a position to really capitalize on the increasing market price that we all feel is inevitable. Insofar as our 2014 guidance, it has been reported to the market previously that we'll sell 800,000 pounds this year at an average realized price of $58.42 a pound, and we'll produce 650,000 pounds of that, purchasing additional 300,000 pounds from spot purchases in the market. We'll continue to mine at the Pine Nut Mine because despite the low depressed market, it still is a financially feasible mine and can make money at the current price. We will continue permitting, which is a large hurdle to every mining operation in the U.S., so that we're ready to put these operations into production when the price justifies it. And in summary, Energy Fuels, I want you to take away the understanding that Energy Fuels is a current producer. We have produced uranium, we are producing today. We have significant growth potential, and we have the staying power to weather the current storm. Thank you for listening to me this afternoon, and hopefully you'll have interest in Energy Fuels as a prudent investment opportunity. Thank you.
Okay, we were just listening to a presentation by Stephen Anthony, CEO of Energy Fuels, ticker symbol UUUU on the NYSE market. We're now going to go into our question and answer session, and with us today we have Curtis Moore, Director of Marketing and Corporate Development. Welcome, Curtis.
Thank you very much.
Our first question, what realized uranium prices are you currently receiving, and how does this compare to current spot prices?
Okay, well, right now, Energy Fuels is receiving a significant premium to the current spot price of uranium on our contracts. In 2014, we expect to realize an average of $58.42 per pound on all of our sales pursuant to these long-term contracts. Right now, the spot price of uranium is about $28.35. So as you can see, we're getting over 100% premium to the spot market on these contracts. And these contracts, one of them expires after our 2015 deliveries, and two of them expire after our 2017 deliveries. So we have a little bit of cushion here to outlast this current market downturn we're seeing.
Thank you, Curtis. Our next question. How have reductions in uranium spot prices impacted your overall strategy?
Well, as people probably know, uranium spot prices have been declining quite a bit this year. I think they started out 2014 at about $34 or $35 per pound. Right now, we're seeing $28.35 per pound. It's been as low as about $28 per pound. So it looks to us, at least, like we may have at least achieved a level of support in uranium spot prices. From an overall standpoint, spot prices, since we are somewhat insulated from pricing due to our contracts, spot prices have not impacted our operations a whole lot. Right now, what we're doing is that we're only producing enough uranium to deliver into our contracts. That's about 800,000 pounds this year. We do not want to produce any more uranium over that, because if we do produce it, we'll just be unnecessarily building inventory or having to sell that material on the spot market at $28.35. And I can say nobody makes money at $28.35 on those sales, or very few do, including us. So we are currently pursuing a business plan that is trying to conserve capital as much as possible. This market we're seeing right now, to predict, there is a lot of possible outcomes on this in terms of variability. I think we are right now experiencing the downside scenario. I mean, nobody ever expected we'd see $28 uranium, but we are right now. But this market has so much upside. I think that our current strategy could be summarized as plan for the worst but hope for the best, and really prepare for the best as well. And so I think that's a good way to put what it is that we're pursuing right now.
Thank you, Curtis. Our next question, does having mines in the United States strengthen your ability to enter into long-term contracts?
I don't. Well, right now I would say the answer is no. Uranium, but there have been times in the past where U.S. production did command a premium. Now, I'm not saying that could happen, is going to happen again, but it could. The U.S. is the world's largest consumer of uranium. We are the world's largest producer of nuclear energy. We consume about 50 to 55 million pounds of uranium per year, and the world consumes about 160 to 180 million pounds. So we're a significant consumer here in the United States. We do believe that being a major producer of uranium in the United States is particularly strategic. there is a lot of unrest going on around the world. I mean, even today we're seeing some pretty horrific events in Ukraine, and if there are more sanctions, if there's political unrest, if there's war, I mean, who knows what could happen here in the future? And there could come a time when being a U.S. producer is highly strategic and significant, and utilities can't have their reactors shut down for a lack of fuel, especially a fuel that's as abundant as uranium. So we'll have to see what happens. Again, right now, here today, no, having mines in the U.S. is not different. The uranium we produce is no different than the uranium that's produced in Kazakhstan or Niger or Canada or Australia. However, there could come a time when this becomes particularly important in light of today's or in light of world events that are going on right now. Hey, Paul, are you there? Paul, are you there?
Hi, Curtis?
Yes.
Yeah, sorry about that. We had a little technical, got dropped off the call there. We'll go to our next question. Our next question we have is, how are you planning, well, actually, this is kind of a two-part question here. Are you planning on selling any additional assets, and how are you planning on deploying the cash received from recent sales of non-core assets?
Yeah, we are right now, I would say, in the process of really focusing our business. Excuse me. We want to be able to focus, number one, on the White Mesa Mill, which again is the only conventional uranium mill that's operating or operational really in the United States right now. We essentially have a monopoly on conventional uranium production. We are focusing on our Pine Nut mine, which is the only operating conventional uranium mill in the United States, and that's in northern Arizona, as the presentation demonstrated. We're focusing on keeping some of our mines on standby, and again, these are fully permitted, fully developed mines that we could turn on once prices rise to sufficient levels. And we're also focusing on our 3 large-scale projects that really have the ability to ramp up our production once markets recover. That would be, again, Roca Honda and the Henry Mountains project, which would provide a real base load source of feed to the White Mesa Mill, and also developing a second production center in Wyoming centered around our Sheep Mountain project. With that being said, we do hold a lot of other projects that don't necessarily fit into that focus, and I guess I could say that all of those are potentially up for sale, or we're looking to not hold them simply because they don't factor into our main business plan, and they do have costs associated with holding on to them. These are smaller mines. These are higher cost mines. They could go into production if we saw uranium reach $80, $90, $100 a pound, but we don't really see that necessarily happening anytime soon. Plus, even if we didn't own these mines, whoever acquired those mines and put them into production, they'd have no choice but to come through us to process that ore. So we would likely make money on those mines anyway. So I would say yes, we are probably looking to dispose of some of our other non-core assets. We have made some good progress with our 2 recent announcements regarding Copper King and the Pinion Ridge Mill, but there could be more to come. And how we're going to deploy the capital, I think that it's just going to go into general working capital. Again, these are not really core to our current business plan. So it's not like we're selling these for a particular project. We're trying to make sure that we can last through what, if uranium prices don't recover until 2017 or so, we want to make sure that we can last that long without having to go raise capital. again, not to say we would never raise capital, but we want to be, if we do it, we want to do it on our own timing and not because we have to in order to keep the doors open. So I think that's what the situation is with our non-core assets.
Okay, thanks for that. Thanks for that update, Curtis. And that was our last question in. But just to close things out, what you already covered obviously a lot of the great points, but what would be the main takeaway investors should have about the Energy Fuels story?
Well, I think the big story we have about Energy Fuels is that we are a current producer. We have the only uranium mill operating in the United States right now, a conventional mill. Right now, uranium prices are low. It's hard to imagine them going much lower. I mean, they probably could, but I think it would be short term. But as uranium prices begin to rise, I think that Energy Fuels shares should perform very well. We have high leverage to the price of uranium. So as they rise, even if they don't rise enough necessarily for us to go back into production on a large scale basis, I think that our shares should perform well. But if prices do rise to sufficient levels, we have the ability to really scale up production better than almost anybody else out there. We have the largest uranium resource base in the United States, well over 100 million pounds. We have excellent projects that are on standby that could be turned on within a very short period of time to take advantage of improving markets. So I think that's our investment thesis. And again, I'm not saying that uranium markets are going to recover tomorrow. There's right now a significant oversupply out there, but even just yesterday there was excellent news that came out of Japan regarding their reactor restarts. This market can really turn on a dime, and that's and we want to make sure that we're ready for it.
Thank you, Curtis. And we were just speaking with Curtis Moore, Director of Marketing and Corporate Development at Energy Fuels, trades on the Toronto Stock Exchange on the ticker symbol EFR, and here in the U.S. on the NYSE market under the ticker symbol UUUU. We're going to be going to our next presentation here in a few more minutes. We're going to be going on to Richfield Oil and Gas, ticker symbol ROIL on the OTCQX. And there'll be Doug Hewitt presenting for the company, Richfield Oil and Gas, ticker symbol ROIL. And that'll be up next here at 1:30 Eastern.
Good afternoon. My name is Douglas Hewitt, and I am the CEO, Chairman, and the President at Richfield Oil and Gas. Want to bring your attention to the disclaimer, which goes to the forward-looking statements as well as other matters. Not much of what we'll be discussing here will have many forward-looking statements in them. However, it is a general disclosure that we ask that you do read. If you would turn to page 7, inside the presentation materials, you'll see a summary of our corporation. We've presented here several times. We have, as noted before, we have seen a precipitous drop in our share price, I think as a result of a perceived lack of follow-through or performance in the market, or perhaps at the corporation level. And what we're here to do today is to, if we could, allay any concerns, but also to explain to you why we believe this company is a very substantial opportunity to those who are looking and those who are doing their due diligence. First of all, let me just state the obvious. We're publicly traded, OTCQX, Premier. We're based out of Salt Lake City. We were formed in April 2011, simultaneous with a merger with Hewitt Petroleum. We have an incredible, however unique, balance of assets, both inside of Utah and inside of Kansas, and many of which what we have are low risk, high return type of activities and assets that we have inside of our Kansas operation, with the tremendous upside potential we have inside of Utah. I will probably try to overemphasize the importance of trying to do due diligence here on this company as things evolve, and will be evolving over the next several months. And I will call your attention to those things and many different things and many different line items here. Of course, our strategy is to develop assets that are producing, and most recently we announced a merger with Stratex. We will soon be going into an S4 quiet period, and so at this point we have to be entirely non-promotional. However, we can be entirely factual. I think the facts will lead to the same conclusions that it has for many of us. We have some very substantial assets, but they are also being managed by some incredible individuals. So let's go back and begin on page 3, and just this is kind of an overview of the assets in the corporation in terms of low risk, superior economics, and we're also a very liquids-rich, environment-oriented company. So because we believe and have believed for some times as an industrial nation that you need oil, gas also powers things. Oil does a lot more. We've also gone to great extent of developing a proprietary database, and we've also created with this what we call the best in management team, best in geological team. Together we have a good, strong overall management as well as a geological and field operations crew. Myself, I'm the president and CEO of the company. We have many wonderful people associated with this organization. We invite you to look through and look at their resumes, and to also realize that some of the people that are here and will yet be associated with this company through this merger are all tremendous contributors ultimately to our greatest objectives. And we also have a very distinguished board of directors, and of which we'd like for you to look through and review them as well, particularly the independents that are noted here on page 5. When we talk about our technical team, we're talking about bringing in some of the best people who have discovered in their careers billions of barrels of oil with their teams, and many of the people associated with us have been very actively involved in the Utah overthrust. With no surprise, so are we. And with them combining their talents along with ours, them associating their name with this small company, in our world, we can't imagine why these type of people would associate with themselves with us, other than the fact that the goals, the objectives, and the aims of this corporation are to duplicate what they've done in the past. We are a company that is not only looking to build a solid production base in our Kansas assets, as we are inside of our Utah overthrust. We have recently made a press release, and in this press release, we went to the fact that of the $1.7 million that we've recently taken in our merger agreement with Stratex, we've been able to increase our production quite substantially over where we were. We will continue to increase that production as we undertake to do more development work, to drill more wells, as been recently disclosed in this press release, as well as to continue to do our rework operations. We've also been started on some very interesting advanced technologies with polymer, and we're using what we consider to be one of the very best in polymer design and completion technology experts in our business right now, being Monty Hoffman. And we're very grateful to have him as a member of our team. And so we're working together on these operations inside of Kansas, obviously with the goal, again, of achieving our minimum production objectives, which will take us into the full merger, which we anticipate to occur sometime in the next several months as we file the S4 and go through the comment period. If you were to look on page 9, this refers more to our database inside of Kansas, which also extends down into Oklahoma, and we have data on 300,000 plus wells, and we've invested a tremendous amount of money and time in developing and building the system. It is very unique, and it allows us to do high-speed analysis and evaluation on real hard data. The whole idea behind this years ago when we put the system together and what it has turned out to be is essentially we would begin to evaluate and find projects in certain areas. And as we began to do that, what we would do is we'd send out a team of geologists. We'd send them up. We'd have them working in certain areas. We'd have them pulling data, pulling wells, spending time on scout tickets and so on and so forth in the different libraries where we're doing our research. Literally now, we could take those same 3 or 4 geologists we'd send into these areas, and we can literally do this in-house with the data that we've been buying and acquiring over all these years, these many years, all the data that's been digitized, and we literally have incorporated that into a one-source system, which has made this company, has brought in tremendous value. Much of it has not yet been recognized, as we can see in the stock price. However, that as we are capitalized, which we are now capitalized, and we begin to pursue some of these opportunities, and we continue to pursue these properties that we're interested in and acquiring them, and we have the proper financial backing, then this system becomes highly effective and very, very valuable. I'm going to pull your attention here to page 11 of the overthrust discussion inside of Utah. This is the part of the asset that we apparently aren't being valued for. So let me try to break this down and make this very simple for people that that may have any question in their minds as to what the upside value that is not showing any market value yet. The North American area, beginning the Cornelian Belt, going all the way up from Alaska all the way down through the Cantrell Field through Mexico, is on this overthrust Cornelian Belt that is actually manifests itself in different areas of the country, and or through different countries, actually, the 3 North American countries. And as we have seen, that it's developed and created some very large fields. And one on the very top, the Crown in the Prudhoe Bay area is 12 plus billion, as well as the Cantrell field down inside of Mexico is also about 12 billion, or both of them are in excess of 12 billion. There was one that was found just outside, just on the east of the Utah border, and it's known as the LaBarge field. And in terms of total trap, if it was all filled with producible assets, it would have been right around 16 to 17 billion. So it's very large. However, a lot of that was CO2, and that's because as you move up further north in those areas, it's because of volcanism or heat from the volcanoes and the hotter areas, these cauldrons, that actually have heated that up and have dissipated a lot of the oil that would have been in place. It has been, however, a great source of CO2 and helium, as well as a tremendous source for oil and gas. Going down through there, there's been some areas that have never really been fully understood and evaluated. The teams that did a lot of this work are actually the members that are working with our company, Mr. Lamerson Hoffman and Raina Powell. They were part of the teams that found billions of barrels of oil in the this northern thrust area of both Utah and Wyoming. As you move down to central Utah, a lot of the initial work was done, but it was never finished up with any major discoveries, although recently, of course, in 2003 and then 2008, there were two major discoveries by Occidental and Wolverine. We are exactly on that same thrust belt on the Gunnison thrust, and we're to the very northern part of that, which I'll discuss in a moment. But what you have to understand is that we're in an area where billions of barrels have already been found before. And so what we are doing is we are very focused on highlighting the exact acreage that we seek to acquire. A lot of companies come at this from the standpoint of building 200,000 acre positions, 100,000, 500,000 acre positions. What we have found is that most of these fields are usually found and developed and primarily produced from about 600 to 800 acres. The majority of the production in these fields, although the fields may span several square miles, the main portion of the systems are usually almost without exception are produced from just within the best square mile. And so our whole focus and the whole leaning of this organization has been to take the people that are with us and to actually develop and find the best 640 acres. Of course, that's expanded well beyond that, and I'll discuss that in just a moment in terms of why our acreage positions are actually so much larger than what I just described. On page 12, what we're looking at here is a general description of the central Utah phenomenon, and that would be simply that there are 1 to 3 trillion, perhaps more, barrels of oil that were generated in the Chainman oil or the Chainman shale, where it's generating oil inside of Nevada and western Utah. The oil ultimately came under the whole state of Utah and moved directly east and ended up inside the oil sands, 65 billion, that's with a B, billion barrels of oil in the oil sands in eastern Utah. Now you might say, unless someone pushed that through with a plug, there's nothing behind it. And yet that's not the way geology works, as we all know. So in order to get that much oil to the east and to have the quality of the oil that actually would have moved it there, it probably was in the order of a quarter of a trillion barrels that has actually moved. What we're looking for is in this whole process where the oil moved and to identify where those sources had occurred. Now you might say this is a major undertaking for a small company, but not with the kind of people that have already made major discoveries, billion barrel discoveries, that are associated with this very same group. So you have to understand that what we're doing is a major undertaking, but we've already created the first telltale indications of where these hydrocarbons are, and it wasn't until a few years ago we actually discovered that we were the only company that had actually found mobile Chainman oil in central Utah, where this massive movement had occurred, and we found it in what we call our Liberty well. And a lot of people are waiting for updates on our Liberty well. And what we'll say with our Liberty well is that we have identified condensates, we've identified the hydrocarbons, we've identified effective porosities in excess of 30%. We are very, very pleased with what we've identified. We are taking a well that we had to damage very severely in order for it not to blow out. And the well continually tried to flow and blow out on us as we were running logs and trying to set our pipe. And so we had to do a tremendous amount of damage to a very, very good well. In the meantime, we've been going through the processes of finding how to actually recover a lot of the mud and the water and the things that we dissipated through an extensive fracture system, which has caused us some consternation. However, we are now beginning to consistently see condensates, and we are constantly and ongoingly in the recovery process. So that is an update on the Liberty. It's consistent with everything we've said so far, and what it will ultimately, we believe, accomplish for the company is the discovery and the clarification in terms of value of what that field is. We've identified and we've stated to the public we believe there's over 1,200 feet of pay in this system. We are not in any way withdrawing that analysis. We can only say at this point we're confirming it. We are also very active in leasing. We're very active in negotiations right now on some other lands. And so this is something that gives this company some very, very substantial upside that, again, is yet as best as we can see with our production. Is certainly not manifest in our share price. So this is on page 13, gives you a breakdown of where our different properties are. On page 14 goes to one of our major properties, which we disclosed our acreage positions there just today inside of our press release. And that would have been the press release dated July 10th. And this kind of gives a breakdown as to why these systems are overlapping, what they look like. If you looked at the center on that one where it's showing the multispectral satellite analysis, you'll see there's a line in there that indicates 1 mile. That would be the size of the Anschutz field. As you can see, this is substantially larger. The Anschutz field is approximately 200 to 300 feet of pay. We are looking for stacked pays in this system. If you turn to the next page on 15, of 3 major sources of pay, all of which between 12 and 1,500 feet thick. We believe it's all filled with Mississippian oil, since we have found Mississippian oil just west of us, inside the Liberty well, and we know that we are absolutely, no doubt in our mind, we are in the migration path, and we are certainly in terms of when these structures were formed in that window. What we have put also on this page for you to look at on page 15 is the other different fields that have been identified and found. And the geologists that have done most of this are also people that are associated with our company or work for us. The next page is on the Cretaceous reservoirs, and that is inside of, that's what we call the Hewitt Freedom Trend Prospect. We disclosed today that we have approximately 3% in a large position. It is with a major independent. We are not at we're not at liberty to say who that is right now. They will make their own announcements. Everyone is still finishing their land positions currently, including us. And we've identified what our land positions are, which we hold. And then there are other land positions that have been built with a land bank, that are currently being built with a land bank, where we have first option. We cannot disclose at this time how much that is. We're building it in a competitive environment. However, we will say that we believe that this system that we're going to be putting into production, or we anticipate drilling to put in production, that has already been drilled and confirmed and currently flows from a well that we currently are the operator of. We believe that this 750 to 800 foot thick section is not only overpressured, it's not only filled with 48 to 50 gravity, high quality oil with no sulfur and no wax. It is a pure Cretaceous, beautiful green oil that we should be able to get probably posted West Texas Intermediate plus quite a substantial amount over it. Most of our operations are within about 15 miles of a major highway that goes to 6 refineries here in the Salt Lake area. So we are in perfect position to deliver our goods. We're in a perfect environment, and we are in a place in the world where there has been some other tremendous discoveries. I think Abraham Lincoln referred to Utah as the bread basket of future mineral development. So the independence play, which is outlined on page 17, gives a breakdown of our comparison of what we're doing right now, what we have, and gives somewhat of a geological setting, and it shows the thickness of our reservoir system. And on page 18, it compares it to other projects. Now, since everyone knows the Bakken, and I'm just going to refer real quickly, do a comparison to the Bakken, just because I think it's helpful. The Bakken is about 150 feet thick, with in some areas 0, other areas measures 15 or 20 feet of we call unconsolidated. There's sands, rocks of different sorts. And what they do is they kind of provide a pipeline for all this oil that's been generated inside these shales to be able to be fractured, and we call fracked. And they're naturally it's a nice pipeline where oil is able to move through, and it migrates in through the shales. What we have is a system that is a little bit different than this. Their system has a gradient pressure or normal pressure of around 0.5. So anything is a little over normal. Ours is 150% of normal at 0.66. It's actually a little higher pressure than the Eagleford. What is even more remarkable is that this same system we're talking about was put down at the same time as the Eagleford, the Mancos, and the Niobrara. It all was done in the same period of time. We were in an overpressured section of this whole system that was done exactly at the same time. They call it different things in different areas of the country, but it was all the same event. What we do is we hold a big piece of this peninsula right near the thrust plate that we've talked about, where these big, huge fields have been discovered. What is remarkable for our shareholders and for our future shareholders, and for those that are truly doing their due diligence, our section is 800 feet thick. The sand body that's in the middle of it appears to be on the approximate about 180 feet thick. And as the major independent that's working this area, who has not yet been disclosed, has said, the Bakken won't even hold a candle to what this is down here. So those are other people's opinions. It's hearsay, and it's certainly our opinion. What we want to do is just inspire you to know that this company is working not only on our primary assets to bring on and develop our production with our agreement and our alliance with in our merger agreement, but we're also continuing to build, and which has been very hard for a small company, and to build and maintain our land positions over these very, very good particular areas. All I can tell you is that I believe this company is fully on the track to accomplish all of its great dreams and objectives with the agreements we have in place, with the people we have in place, and with the properties we have in place. Thank you very much for allowing me to, again, describe to you this great company. Have a good day.
Okay, we're going to open up our Q&A session for Richfield Oil and Gas. Ticker symbol is ROIL on the OTCQX. We have on the line with us today Doug Hewitt, President and CEO of Richfield Oil. Welcome, Doug.
Thank you.
Our first question, can you review your increased production from Kansas, and is this a trend that we can expect to continue?
The increased production is the press release outlined was just reworking some existing wells that we've had sitting here for quite some time. Wells that needed to have work done on them. We got sidetracked because the issues with the Kansas Corporation Commission, it not only affected us, it's affected hundreds of other companies where they went back and started getting just anyone who owned a lease. They became obligated to have to plug these wells, and I think we spent total in excess of $2 million. That was money we could have put towards the field operations. I think in terms of real hard dollars into the field, we've probably spent well under $1 million. And I should say well under $1 million, somewhere between $800,000 and $900,000 actually to the field. And at this point, we're seeing some fairly substantial results, probably as good as we had hoped for. As far as going future, our plans incorporate reworking several more wells, multiple wells. We actually have a drilling rig that will show up next week, start drilling. And we have that one rig under contract for 2 wells, and these are wells where anticipated production numbers are pretty good. I mean, we're expecting to see our numbers increase steadily month by month. Some of this has been going back and readjusting, reworking pumps, putting the right size pumps, changing electrical grid, type of infrastructure, some of those things, which are just elementary in terms of do you have the reserves? Well, that's obvious at this point. We do. They're now going into production, and we anticipate just ongoing development along those lines.
Okay, thank you, Doug. Our next question, you were just talking about Kansas a little bit, but this would like to know, how do you plan to split up your investments between development in Kansas as well as what you're doing in Utah?
That's an excellent question. Right now, inside of Kansas, it has a set plan. And the plan is with the objective of meeting certain production expectations and certain levels. And when we hit those production numbers, we will begin to spend a little more money and time and be able to allocate a little more time to our Utah operations. However, it must be understood that there are a lot of events that drive properties such as the ones we have in Utah. And everyone needs to understand and keep in mind that we're in an area where we're looking for billion-barrel fields. That's with a B. And I know this sounds a little lofty in terms of our goals. However, they're not lofty in terms of the prospects. And so as we see movement begin to occur in Utah, that will kind of take on its own life and will probably require a very little amount of capital from the company itself, so much as it would be third parties coming in and seeking to participate, drill, farm outs, those sort of things, which we're currently considering at this time. More will come. We can't really say a whole lot now.
Very good, Doug. Understood. And you were just commenting on some aspects of this, but this investor would like to know, do you anticipate needing any additional funding?
Well, when you're in the oil business, you always need more funding. I was, we're all looking at it's such a good job that, some of the recent independents have done in the United States, and these are companies that are major players in the Bakken, for example, that are acquiring other companies. And it's those who understand the finance are the ones that grow. Our whole focus within this organization and some of the people that are being brought to us with this proposed merger are people who have many, many years in merger and acquisition experience, and managing money, acquiring, doing some of those sort of things. That's all going to be integrated into this is one big plan. And I guess that's what I'll say for now. So it's all being considered, and there's a lot of things that we'll be doing, and we've got it pretty mapped out at this point.
Very good. Thank you, Doug. And what are your next steps in your Utah overthrust strategy?
The Utah overthrust strategy, we've announced that we've found both condensates and gas. We have some magnificent flares of the gas that we've produced down on the Liberty, we call our Liberty discovery. And I think a lot of people forgot that, and we've decided that we're probably going to go ahead and set up a link so people can see that. We were in the gas portion of that system. We decided to set a sidetrack and go into the oil portion of the system. We are limited on funds, and so we've been going very slowly. We've been doing a lot of detailed and hard analysis on this reservoir that we think is a very big discovery. And we're also sitting at one of the highest of the precipice or structures of the Mississippian, where that Mississippian Chainman oil is being discussed, is also starting to be discussed very openly on the internet as being one of the single largest sources of oil in the world. And we did find Mississippi Chainman oil in mobile form in our well, and so we decided to focus on that aspect of the reservoir. And so we've done some recent completion work. We've got some flowback numbers, but we are still attempting at this point to recover mud, and a lot of it. We're at 1,000 barrels of mud and filtrate water that was lost in this well while we were trying to drill it. The reason isn't because the well is not under pressured, it's over pressured, and so we had to get very aggressive with it. And sometimes when you have a great well, you can damage it, and we've done that. There's some other options for us, and so I'll just put that off to the side and discuss and answer the other portion of your question. Right now, we're actively acquiring leasing. Right, we've said this for some time. We're taking leases, and the hardest thing in the world would be to take a lease if you have a 1,000-barrel-a-day well right offset to you. So keeping that in mind, we're trying to be as frank and honest as we possibly can with the public so that we're not misleading them. But at the same time, it would be most advantageous for us to also be acquiring leases near and around our operations. And that's what we're currently doing right now, as well as is our other major play that's over just to the east, where we have a substantially larger acreage position. And we're currently building that through a land trust right now. And we have, I give the exact numbers. We made a recent disclosure as to what those numbers are. We've shedded some leasing, we shedded some acreage that we didn't feel as though we needed, and we've been focused more on some of the better acreage. And as I explained in the presentation, it's not how many acres you own, it's what acres you own. And that's our absolute primary and hardcore objective here, is to have the right 10 to 20,000 acres, because you only need the right 600 to have some of the biggest fields in the state of Utah.
Absolutely. Doug, I hate to cut you off, but we have to run into our next presentation. We've been talking to Doug Hewitt, President and CEO of Richfield Oil. We're moving right into Glyeco next. It's ticker symbol GLYE on the OTCQB. Again, GLYE, Glyeco on the OTCQB.
Hi, my name is Alicia Williams-Young. I am the Chief Financial Officer for Glyeco, and I'm happy to have an opportunity to speak with you today. Please take a moment to review the forward-looking disclaimer found in our presentation. Some of you may be very familiar with Glyeco, while others of you may not be. So I'm going to take a little time to go through an overview of the company, and then following that, I'll go through what the company has been working on over the last several months. I'll start my brief overview with a story of something that happens to me on a fairly regular basis when people ask me what I do for a living. When they ask, I say, I'm the Chief Financial Officer for Glyeco, a publicly traded company that recycles glycol. At this point, I'm generally met with a blank stare. And I have to admit that this blank stare actually makes me a little bit happy, because it reminds me that this is an industry that is underserved and is not well known, which means that it is rife with opportunity. And we are excited to be a part of that. The next question I generally get is the name Glyeco. Is it pronounced Glyeco or Glyeco? Well, it's Glyeco, and this is basically a marriage of two words, glycol and ecology. Because, of course, we are an eco-friendly company. The next question, of course, is what is glycol? Glycol is a liquid chemical, and it's derived from crude oil or natural gas. It is a non-renewable resource. And it is primarily used in 5 industrial applications. One of those applications is in the automotive industry, where it's used for antifreeze or coolant. Another application is in the airline industry, where it's used for wing deicer fluid. And yet another in the medical, where it's used for sterilization fluid. It's used in the HVAC industry, as well as the textile industry, where it's primarily used in the manufacture of polyester fabrics. As glycol moves through these different industries and their manufacturing processes, it becomes contaminated with various impurities. And it is through our technology that we are able to refine this glycol or recycle this glycol back to a refinery grade quality material. By refining it, or by recycling it to a refinery grade quality material, we are then able to reuse the material in any industrial application that the original refinery grade material was used for. The standards by which we determine the quality of the glycol that's been recycled were set by the American Society for Testing in Materials. And the specific standard that determines whether or not this material meets a refinery grade quality is ASTM E1177 Type 1, which is our T1 material. The general worldwide consumption of this material is at over 6 billion gallons per year, and it's expected to grow at a rate of 6% for the next several years. Now you can imagine that with 6 billion gallons of glycol being consumed per year, that a huge quantity of waste glycol is being generated. And waste glycols, if not properly disposed of, can harm humans, animals, and plant life. So by recycling this material, we preserve it not only as a natural resource, but we also help to protect the environment as well as ourselves, plants, and animals that are around us. For us, the process of developing and proving out this technology began in 1999 with a group of 4 extremely talented individuals. The founders of the company were our CEO, John Lorenz, who has extensive background in the solid waste industry and over 30 years of experience in doing acquisitions and roll-ups of various companies. And then Dick Geib, our Chief Technical Officer, who is, of course, the genius behind our technology and is one of the founders or the primary people who helped establish the ASTM standards by which we measure and qualify our glycol. We then have our Chief Business Development Officer, Janet Carnell Lorenz, who has over 20 years of experience in branding and establishing new markets and new products. And of course, we have our Chief Operations Officer, Todd Smith, who has over 20 years of experience in the glycol recycling industry. The company went public at the end of 2011, and it's at this time that things really began to accelerate. It is within the last 18 to 24 months that the company has completed 7 acquisitions and implemented the first phases of our T1 technology. We now have operating centers in Minnesota, Indiana, Florida, New Jersey, South Carolina, South Dakota, and Maryland. Our facilities that are located in Minnesota, Indiana, Florida, South Carolina, South Dakota, and Maryland offer waste glycol collection and recycling services, as well as disposal services. They recycle waste glycol into antifreeze, heat transfer fluids, as well as other glycol formulations. And it is at our New Jersey facility that we produce our T1 glycol, as well as other glycol formulations. Now, let's move on to some of the exciting things that have been happening over the last several months. It is at our New Jersey facility that we have had an increase of over 500% in our capacity. The implementation of this was not without challenges. We had several delays due to multiple severe weather storms, as well as transportation outages. We worked through these challenges and have rolled out a key component of our technology plan. We have also entered into an exclusive agreement to recycle all of the polyester purge stream byproducts from a leading U.S. producer of polyester fabrics. They produce about 1.15 million gallons of waste glycol per year. This is another huge step in keeping this material out of the environment, as well as sustaining a natural resource. We also relocated our Minnesota facility and increased the capacity at that facility by over 400%. This was in part fueled by our expansion into the Canadian market, as well as our desire to increase the sales velocity in an expanding and growing market in the Northeast. We have expanded our services into Canada, as I just mentioned, and we have become the only registered processor in Canada who is able to meet ASTM E1177 standards. Canada has tight regulations and a comprehensive program for collection, and we are happy to become part of this sustainable effort to keep glycol out of the environment and reuse it for other purposes. We have 4 processing centers conveniently located to serve the Canadian market. And at our Maryland facility, we have completed substantial storage capacity and throughput upgrades. This facility is strategically located to serve multiple major markets, including DC, Virginia, as well as Maryland and Pennsylvania. We have expansion initiatives targeted for this facility that are projected to increase the sales there by more than 45% over the next year. The team here at GlyEco is working hard to expand the business. And this team is an extremely motivated, intelligent group of people. I can say that it is one of the best groups of people that I have ever worked with. Over the next several months, we plan to increase sales, add additional product lines, and continue moving into international markets. The investments that we have made in technology and infrastructure are the foundation upon which these changes will occur. I am currently busy working with our controller on the preparation of the Q2 numbers, and I look forward to sharing those with you in our next shareholder conference call. There will be a question and answer session following this virtual conference, and that will be led by our CEO, John Lorenz. As always, you're welcome to call or email with any questions that you may have. I thank you for your time.
Okay, we're now live with GlyEco, ticker symbol GLYE on the OTCQB. We're going to go into our question and answer session. With us today, we have John Lorenz, CEO, and Alicia Williams-Young, CFO. And I guess we'll just get started right with the questions. We have several here, John. Our first question, how much type 1 can you currently produce in New Jersey, and what are you planning to expand this facility to?
I can address that. It's a good question. We put out a press release, I think, about 4 or 5 weeks ago indicating that we have increased the capacity there at the plant up to 5 million gallons. As anybody knows, you first have to increase your capacity by putting in the equipment, and then the equipment needs to be tested. The way I compare it is like buying a Toyota Prius, a new one. It's great on gasoline, so on and so forth, and it really is good technology. And what we're going to do there is we're going to continue producing the product, and as time goes on, we will start ramping up, much like pushing the gas pedal down. But as you push the gas pedal down, you got to make sure all of the various equipment functions properly. And I think it's important to remember that this was a facility that was producing 1 million or less gallons on an annual basis. And we have put substantial upgrades and substantial hard dollars into creating a facility that first we'll do the capacity at 5, then we're ramping to 7, and then we'll ramp to 10 million gallons. So it's a process. It's in play. We had obviously some slowdown, and that was primarily due to the installation of equipment due to the weather. We simply couldn't pour concrete when it's minus 12 degrees. So we've recovered from that. We're in process of putting in the equipment, finalizing it. In fact, most equipment's in place. We have to test it, finalize it, and then start to ramp production.
Very good. Thank you, John. Our next question, where are your next Type 1 upgrades taking place at other facilities?
The Type 1 upgrades, and I want to make sure that our audience is not really confused. A T1 product is a concentrate, which means that there is no water in the product. It's 99.99% glycol. And it tends to service customers that blend that product with deionized water or other ingredients to create another product. So that the T1 plant is a concentrate. Our other facilities produce primarily an antifreeze product that is distributed to Jiffy Lubes, Monroe Shocks, so on and so forth, and that primarily is an antifreeze. We will produce at those plants some mix that would be related to your HVAC fluids and maybe a little stuff relating to some of the sterilization material, but not much. So that the criteria the company uses for creating its second T1 plant is that we must have under feedstock supply between 1 million and 1.2 million gallons on an annual basis. That also excludes that we need a rail, a facility that's 3-4 acres, has rail, and that the permitting process for the particular state in question is available. Some states in the United States are not very friendly to chemical companies, regardless of whether they're recycling companies or not. So that states like Texas, for instance, are quite friendly to that particular approach. But there are some places in the United States where that is not, they're not interested in bringing in even recyclers that, like ourselves, that reprocess a hazardous material. So I would suspect that the next plant of that magnitude would be located in the Southwest. We are currently working on that feedstock supply. I've indicated that in previous calls. And I would expect we would have an announcement about that sometime next year in the first or second quarter.
Thank you, John. Our next question, what are some of the partnerships that you've created to obtain feedstock?
The partnerships, we really don't have any partnerships in a legal sense to receive feedstock. We do have an agreement that we were asked to sign by a company in the polyester area, but primarily because they had some environmental issues previously with a spillage, and I believe there was a requirement that they had to have a contract in place to handle all the hazardous material coming from that plant. And it had to be with a company that was audited with an environmental audit and also had the capability of processing the material. That contract, I think, was the nature of both an 8K and a press release. And that's for 1.15 million gallons on an annual basis or more. Contract, I believe, runs 5 years with automatic extensions. That's an unusual situation for us. We normally don't enter into contracts because the material that we reprocess is hazardous material and has to be disposed of and manifested in a proper way. You're just not supposed to be dumping it into the sewer or into the water, as it would have a very deleterious effect upon animal life as well as plant life. So our partnerships are really more with people, if you can describe that. It's more of a relationship where we know that this particular company or companies have a great amount of feedstock that they're getting rid of, and they would like us to take it. The New Jersey plant, because it can handle 50 rail cars, and we have access to our locomotive there, we can move a lot of material in and out of that plant. So that's why we have done the heavy investing in that plant to upgrade it. But we're upgrading it with the concept of festina lente, which is we're making haste, but we're doing it slowly, and we're doing it accurately so we don't have to go back and redo it over again. So, but in terms of the contracts, we really don't have feedstock contracts. We don't see that they are at this point needed. And the one that we do had came about because of a requirement that that particular company had. We had previously processed some of their material, but now I believe we're getting I think we're getting all of it.
Very good. Thank you, John. Our next question, do you anticipate needing any additional funding in the near future?
Well, the additional funding for a growth company is always a matter of concern. As you know, we just put out an 8K where we're attempting to reduce the amount of warrants out there, kind of quote-unquote, as our SEC advisors as well as our investment bankers advise us to kind of clean up the balance sheet. We're looking to uplist, hopefully onto NASDAQ relatively soon. And our audit and comp committee will be cogitating and discussing any needs for capital or projections going forward in the next, I think the next meeting is set up for August. Input into that meeting will be from our CFO, Alicia, from Maria Setz, who's our controller, myself, and also from Todd Smith, who is our COO. So I can't answer that question intelligently right now. I can say that the warrant conversions went very well, and we received some additional capital there. I would comment finally by saying that the business that we're in is a capital-intensive business in a sense. We have to buy equipment, and when we buy the equipment, it's not like a high-tech company. It's immediate. You know, you get the formulas, you do all the material, and suddenly you go from being a $10 company to $1 billion or whatever. We're a company where we buy the equipment, it has to be moved in, it has to be installed, it has to be tested. But once it's there, and it keeps producing revenue for years. And I think that's what people should really realize about the company. We're a technology company, but in essence, we're really the sort of the real American company. We own things, we own assets, and we have real customers that have needs that we service. So capital for us is equipment-based. And also, I think we're going to have to add some engineers. We're running out of some mechanical, but primarily chemical engineers, and we're taking steps to change that. So I can't answer that intelligently right now, but I suspect toward the end of the year in the fourth quarter, we'll have a pretty clear idea as to whether we're going to need additional capital. But I can tell you right now that the uses of that capital would be, again, for more equipment, more upgrades, and also to continue our expansion into the international markets. I would reiterate by saying that I think those of you that follow the company are aware that we have entered the Canadian market. We are now the registered processor in the 5 provinces, and we are beginning to get material coming out of Canada. Should that material increase dramatically, which we anticipate it looks like it is going to increase, we may need to add additional equipment in our Minneapolis facility as well as some of our other facilities. So I can't answer, as I said, the question, but the board will certainly take up that issue, and we'll have something to say on that later. Alicia, do you have anything to add to that?
No, I don't. I think that was a very thorough discussion on that topic.
Thank you.
You're welcome.
Okay, John, our next question, we were just talking about the expansion into Canada. This investor would like to know what's the overall progress and strategy for your international expansion?
The overall strategy for international expansion, I think we discussed about 3 years ago. It really hasn't changed. Our first tendency was to purchase and do acquisitions in areas of high density in the United States. And as you know, that's from Chicago. It kind of forms a sickle. You start in Chicago, you go across the Northeast, you come down out of Boston, down the coast to Florida. And there's a great deal of population in that zone. Our strategy there was to purchase companies that were operating and profitable that could be upgraded and expanded so that we would have access to the Canadian market, which was our first approach internationally. And some people say, well, Canada's really not an international. Well, it is. You know, you've got a lot of different things you have to do, and you got to register, and they had to come down and audit the plants and all kinds of things. So we consider Canada our first real expansion. But that was programmed, and that's why we selected companies in that area, Minneapolis, so on and so forth, so that we could move material from Canada across the border into the States based on the regulatory environment that they have in Canada, which is quite favorable to us, given the fact that we are more closely located to the sources of the glycol versus potentially other recyclers that in theory could take the material. So by locating where we did, we really opened the door for that, and we did that last year. On the other side of international expansion, once we independently validated the technology and our product, which was a press release, which was received very well overseas. By overseas, I mean in the UK and in the EU, which is also highly regulated in the glycol disposal area, as is Canada. We've received numerous inquiries there. We have been following up with those inquiries very aggressively. We've also received inquiries from Turkey, China, so on and so forth. I don't want to go into a lot of them, but they are all at this point being developed. How do we develop those? This way. Most of those people, if not all of them, are textile producers. They are people that are making polyester fiber. The waste material coming out of the plant is an item that they have to dispose of, or they attempt to reprocess and then dilute with virgin to put back in the plant. They don't have to do any dilution with our technology. We can reprocess it right as it comes out of the plant and put it back in. They're very interested in that, because if they have, let's say, 20 million gallons of waste material, by the time we're done with our technology, they're going to save somewhere between $10 and $20 million. And that drops directly to the bottom line for them. Glyco, of course, makes about the same amount or a little more using the technology. So there is a lot of interest. For us to get there, that was part of our budget for this year, is we have to develop a few things internally. One, we have to have a qualified engineer that's dealt in the international area, and we're currently trying to recruit one of those. If you know of anyone or any of you are listening, please get a hold of us. Number two, we have to refine our design package so that we can sit down essentially with these people and their chemical people and go through the package without revealing the guts of the technology. Third, which we are now in the process of finalizing, we have to have an affiliation with an international engineering and chemical firm that we can rely on in two areas. One, that they have process and project engineers that can work with us in a project-by-project basis. And number two, they have a series of customers that they themselves have been servicing in the polyester area that they could introduce us to, so that we could then talk to them about putting more plants in. So our plan internationally is divided into two areas. The first area is North America. North America we consider one block. In Canada, the fellow that's doing point up there, there's really three people. Janet Lorenz is heading up that group together with Everett Alexander and Hubert Bourquet. Hubert is in Canada, and as the process develops, will be taking more and more of a leadership role there. That's point one. Point two is overseas or outside of the continental United States or North America, we will adopt either an M&O policy, which is a manufacturing and operating agreement with a large engineering firm, as I described earlier, or we will work directly with the end user to put a plant in there. Funding these plants is not an issue. The various companies that we're dealing with are very large. They have indicated from the beginning that they would be very interested in building the plant to our specifications. Why? It would save them a lot of money, one, and they can depreciate the plant over the life of it. So really, the international plan involves chemical engineers working together, our chemical engineers working together with a very large independent firm that's chemical engineering, has chemical engineers. The current firm, and I can't release the name because we're under CA and the agreement has not been completed, is a firm that is a chemical company. It has about 2,300 chemical engineers. They do in excess of $1 billion a year, and we anticipate to be able to make some sort of announcement in the future. So we're pursuing the international market, which is a very, very good market for this company, much better than the U.S. market. Here, there's about 700 million gallons available. As you know, there's about 7 billion gallons available, so we're about 10% of the world market.
Very good, John. We actually just ran out of time, but I do want to thank you for being able to participate today. For our viewers who have been listening to John Lorenz, CEO of GLYECO, ticker symbol GLYE on the OTCQB. We're moving right into our next presentation, Big North Graphite, ticker symbol BNCIF on the over-the-counter market.
Hi, and thank you for joining us today. My name is Spiro Lattis. I'm the president and CEO of Big North Graphite Corp. The company trades under the symbol NRT on the TSX Venture Exchange and BNCIF on the OTC. Big North Graphite is a graphite exploration and development company focused on select projects in Mexico and Canada. More recently, we've specifically been focused on our projects in Mexico, as the company's goal is to restart past-producing graphite mines in the near future to capture some of the graphite market for our shareholders. So just getting right into it here, our first slides are cautionary note. Please take some time to review the cautionary note at your convenience. A little bit about the people. It's myself. Daniel Bleek is out of Arizona. He's the chairman of the company. He's got over 30 years experience in mineral exploration and has developed and managed several projects throughout North America and Mexico. He's been instrumental in Big North's advancement and involved, where we are today. We recently added Cesar Guajardo Villarreal. Cesar is has got 18 years of graphite experience in Mexico. He was the former owner and chairman of a private company that used to run the El Tejon flake graphite mine and mill in Oaxaca, Mexico. And that's really important because we recently acquired that project. So he has intimate knowledge of the area, the project, the product, and he was responsible for all sales previously. And as I'll talk about a little bit later on, sales in graphite is the most important thing. Doesn't matter what you think you can produce, only what you know you can sell. And so it's great to have Cesar on board. And the board's rounded out by Andrew Reese and Eric Austin-So, who's a PGO, and has been involved with mineral exploration projects for quite some time. Our capital structure on the next page, as you see it there, we most recently completed a financing at the beginning of this year. In March, we closed the financing. So a little bit about the highlights here for the company. We're one of the only companies on the TSX Venture Exchange, and I, to the best of my knowledge, I don't know of any other OTC companies. There's one Australian company that has a amorphous graphite project. So we're one of the only companies that is pursuing amorphous graphite. Now, many people think that graphite is just one product. Actually, graphite is composed of many different products. So and it ranges in the flake size. So it goes by flake size. So it goes everywhere from amorphous graphite to fine flake, medium, large, and jumbo flake. And there's also something called vein graphite, which is very unique. And currently, 100% of it comes out of Sri Lanka. But going back to it, we're the only TSX Venture company that's pursuing amorphous graphite. And what we did is we acquired 3 past-producing amorphous graphite mines in Sonora, Mexico. And we're proud to report that we've sold 1,163 tons of graphite semi-processed run-of-mine graphite to a customer within Mexico. Our goal, as I mentioned right off the top, was to be one of the first junior graphite companies to actually capture some of the graphite market and actually sell graphite and capture revenue for our shareholders. So our goal is to significantly increase our amorphous graphite business. The key here is being one of the only amorphous graphite companies with an amorphous graphite project. Amorphous graphite actually accounts for about 50% of the natural graphite market. And in 2012, which is the most recent numbers that I've seen, over 90% of the production was out of China. So there's currently no amorphous graphite production in the US. There's very limited amorphous graphite production outside of China. So North America imports amorphous graphite, and we want to be able to provide some of that. As I mentioned earlier, we recently acquired the El Tejon flake graphite mine and mill in Oaxaca, Mexico, and our goal is to have near-term flake graphite production as well. So a lot of investors, you're hearing a lot more about flake graphite, and our goal is to actually restart that mine as quickly as possible. And what the key is here is that that project operated from 1980 till 2002 and shut down due to the price of graphite. So there's a mine and mill on site, and our goal, as I mentioned, is to restart that. I'll talk about that a little bit more moving forward. So on the next page, you'll see some pictures of the project. I was just down there last month. You see the mill there on the left. It was built, as I mentioned, in 1980 by the government of Mexico and shut down in 2002. So while it has been shut down, it's still in pretty decent shape. The company would need to refurb the mill, and our goal would be to restart that project as quickly as possible. So we closed that acquisition in February of 2014. It's Mexico's only past-producing flake graphite mine and flotation mill, and it closed, as I mentioned, due to graphite prices in 2002. At the time, large flake graphite was selling for under $500 a ton, and currently the price of large flake graphite is closer to $1,500 a ton. So there's quite an increase in the price per ton, and we're looking to capture that profit for our shareholders. What is key for these projects is our ability to jumpstart or restart these projects quickly and for low capital cost. All the infrastructure is already in place there. As I said, it operated for 22 years. So there's already roads and power and water to the project. The mill is already built. As I mentioned, we will need to refurb the mill, and that will take some time and money. But we have the ability to restart a project without having to build all the related infrastructure, and that really is a huge advantage for Big North and our shareholders. As I mentioned off the top, we also added Cesar Guajardo, who was the chairman of the company that formerly used to run it. He shut it down in 2002, of course, due to the price, but his wealth of experience and knowledge of the area, project, and customers will be a great advantage to us. A little bit more about the El Tejon project. It's a 500-hectare property. It consists of the mine and mill. It's located about 38 kilometers northwest of the city of Oaxaca in southern Mexico. It's the only flake graphite mine to have produced in Mexico. It was originally built in 1980 by the government and sold off in 89 after a second processing line was installed to increase the capacity. In 1989, the government of Mexico divested themselves of non-core assets, and as a result, this project was sold into private hands. It's an open pit mine, and the mill is used to crush, mill, flow, dry screen, and pack the final product. And historically, it produced 3 products, large, medium, and fine flake. And we look to restart that as quickly as possible. Now, so a lot of investors may have heard about graphite recently, and specifically may have heard about Tesla's announcement to build a $5 billion quote-unquote gigafactory in the Southwest U.S. And why is that important to companies like Big North and graphite companies? Well, 2 things. The gigafactory that Tesla is talking about building will be built to produce lithium-ion batteries, and there's actually significantly more, about 15 to 20 times more graphite in a lithium-ion battery than there is lithium. There's currently no production of graphite in the U.S. at all. The U.S. imports all of its graphite, and Tesla has said that they're planning to source graphite from North American production. So currently there is very little North American graphite production, and we hope to be one of those companies to supply a project such as this. That being said, I'll talk a little bit more later on, but there's many different uses for graphite. But just this one factory alone, as estimated by Industrial Minerals data of London, will increase flake graphite demand by 37%. And it's estimated that this one gigafactory alone will require 6 new mines to feed it. So the estimate is 93,000 tons of flake graphite per year to service this gigafactory. So, I think we're very excited about the graphite market moving forward, and we hope to capture some of this market for our shareholders. Sorry, moving forward, a little bit about our projects in Sonora, Mexico. This is our amorphous graphite projects that I touched on earlier. We acquired 3 past-producing mines, La Fortuna, Carapless, and a 50-50 joint venture in Nuevo San Pedro, and we've been working on restarting the Nuevo San Pedro project. We've test mined, and we started putting together a processing facility about a year ago, started test mining in May of last year, and completed our first sale in August of last year. And as I mentioned, we've sold 1,163 tons to date. Our goal is to significantly increase our amorphous graphite sales, improve our processing capabilities, and also to secure long-term offtakes for our amorphous graphite product in Sonora. I'm skipping forward to the next slide here. There's a property map here. You see where it is. It's outside of the city of Hermosillo. It's about 45 kilometers southeast of the city of Hermosillo, which is a city of about 1 million people. Excellent infrastructure, a very supportive mining community there. I mean, the state is well known for mining activities. There's quite a few Canadian and American mining companies in that area. In fact, there's a private U.S. Graphite company with an operation several kilometers to the west of us there that have been operating there for quite some time, producing amorphous graphite. The other thing that we're doing is we put out a news release about a year ago that we're actually buying unprocessed amorphous graphite from local producers in the area that don't have processing capability. So the goal of this program is to buy. We can specify the quality and tonnage that we want to buy from local producers, reprocess and sell as a final product, capturing the difference in the price of unprocessed and final product graphite. And we continue that program, and we're looking to increase that program significantly moving forward. I'll talk a little bit about amorphous graphite. As I mentioned off the top, there is many investors think that graphite is only one product, but in fact, there's multiple different products within graphite. The total natural graphite production for 2012 was about 1.1 million tons, of which 50% was amorphous graphite. So it's quite a large market, and as I mentioned right off the top there's no other amorphous graphite production out of the U.S. There's that one American company with the operation next to us in Sonora, but very limited amorphous graphite production outside of China. And end users are looking to secure supply outside of China. So we believe we're in a very good spot. We're looking to significantly increase that business. But the United States, Europe, and China have all included graphite on a short list of critical materials. So there is no graphite production in the U.S. right now. There's very limited graphite production in Mexico and a little bit in Canada. So we believe that we're in a very good spot. And then you also see announcements such as the one from Tesla saying that they're looking to build that gigafactory that will increase flake graphite demand by 37%. So there's been very little new exploration or development of graphite projects in the last 20 years. But as it looks like right now, there's significant increase in the demand coming down the pipe. So that creates opportunity, and we want to be one of the companies that capture some of that opportunity for our shareholders. moving forward, we also have two exploration projects in Canada, the Griffiths Brome graphite property located in Ontario. We completed phase 1 exploration, and we'll announce plans for the project moving forward as they're finalized. That's in the southeast part of Ontario. It's very close to Canada's largest past-producing graphite mine there called Black Donald that produced from the 1890s all the way up to 1950 roughly. We also have a project called the Grand Lac du Nord. That property is located in Quebec. Again, we completed phase 1 exploration there in 2012. And we did a program that involved grab samples and trenches. Pardon me. Moving forward, again, we'll announce our plans to explore that project further as we finalize them. So again, what is graphite? It's a critical supply industrial mineral. It's carbon essentially. It's lightweight with the highest natural strength and stiffness of any material. It's a great conductor of heat and electricity. It's corrosion and heat resistant, and it's got high natural lubricity. And because of that, graphite has a variety of different uses that it's good for. We'll talk about that right here on 2 slides later here, the major graphite end users. You'll see that although batteries are getting a lot of attention right now, actually the largest segment of the graphite market is used in the steel and refractories business, automotive parts such as clutches and brake pads. It's used as a lubricant in water-based paints and carbon brushes. Of course, there's a very small percentage of graphite that goes into pencils, but most people think that graphite is just used in pencils and tennis rackets and golf clubs, where in fact that there's quite a few other uses for graphite, and those uses are very, very small. I want to point out comparables to Big North in terms of market cap. Our market cap is currently around $3 million. If you take a look at some of the other comparables that are out there, you'll see that their market caps are significantly higher. Where we have an advantage is that we have 2 projects, one, the amorphous graphite projects in Sonora that we're already selling amorphous graphite from, and there is no other project on that list that you see in front of you that's actually selling graphite. In fact, most of those other projects have significant capital requirements in order to build their mines and mills. Whereas we bought a past producing project with all infrastructure in place, and we only need to refurbish a mill, which the cost will be a lot lower than building a whole new mill and building roads and bringing in power, et cetera, all the other infrastructure needs that most mining projects have. I want to talk a little bit about the supply and demand dynamics of graphite. I touched on it a little bit earlier. The graphite market was flooded out by Chinese production approximately 20 years ago. As a result, the price dropped significantly. And what happened was there's been very little exploration or development of any graphite projects over the last 20 years. In more recent times, as I mentioned earlier, the European Union, the US, and China have all named graphite a mineral that's in critical supply. China, although they control about 80% of the world's flake graphite production and 90% of the world's amorphous graphite production, has now introduced a program where they're retaining graphite in the country and moving it up the supply chain. So rather than sell a raw graphite product, their goal is to move that raw graphite up the supply chain and eventually sell anodes for batteries, or even the batteries themselves, or even electric vehicles themselves. And that's caused a little bit of concern on the supply side. So on the demand side, I should say, on the demand side now, you see companies like Tesla announcing that they're going to build their gigafactory in the Southwest U.S., which will significantly increase the demand for graphite, for flake graphite specifically. And so there's that vacuum there in the middle, because there's been no exploration or development of old projects. And now there's this sudden, in the next couple of years, large increase in the graphite demand, that creates a significant opportunity. And we at Big North believe that with the projects that we have in Mexico, we can capture some of that opportunity, and that'll translate into a profit for our shareholders. A little bit about the demand again. This is from Industrial Minerals data. Graphite demand with batteries and without batteries. It's a growing market, and we believe that we're in the right space at the right time. Finally, I just want to say that if anyone has any other questions about the company or about our projects, please feel free to call us. The website is www.bignorthgraphite.com. My name is Spiro Lattis. Please feel free to call us anytime. Once again, the ticker symbol is NRT on the TSX Venture Exchange and BNCIF in the US. Thank you very much.
Okay, we're now going to go into our question and answer session with Big North Graphite. Trades on the Toronto Venture Exchange under the symbol NRT, and here in the U.S. on the OTC under the ticker symbol BNCIF. With us today, we have Spiro Lattis. Welcome, Spiro.
Hi, thanks for having me.
We'll go right into our first question. We have this investor would like a pretty easy one here for you. What is the difference between large flake, fine flake, and amorphous graphite?
Sure, that's actually a great question. Many people don't know that graphite is not just one product, not graphite like gold or silver. There's a multitude, a range of different graphite products, and it all depends on the flake size. So actually, in reality, all graphite is flake graphite. It just depends on the size of the flake. So amorphous is what's also known as microcrystalline flake, where the flakes are so small that they're almost invisible with the naked eye, so it almost looks like a powder. And the larger that flake size grows, of course, the more valuable the product is. So it goes from amorphous, small, medium, or fine, I should say, medium, large flake, and there's also some projects that have what's known as a jumbo flake product. So to answer the question, it all depends on the size, on the flake size of the graphite, and the price range for the product it corresponds with the size of the flake.
Thank you. And our next question, what price are you currently selling your amorphous graphite at?
So we have to date sold a semi-processed run-of-mine product, so it's not quite a final product. All our sales to date have been semi-processed run-of-mine. Amorphous graphite, again, there is a range of final sale prices, and it depends on the carbon content of the product. So our most recent sale, we sold two different grades of product, and it was a plus 80%, which is rather high. In the amorphous graphite world, it's a very good high-grade quality amorphous graphite product, and we also sold a 65 to 75% product, and that range depends on the negotiated price between buyer and seller. As I mentioned, we're not selling a final product yet, so in our previous sales, I can talk on that because those numbers have been reported. We received approximately $150 to $160 a ton. Obviously, with the 80% product, that demands a higher price. Once it is crushed down and can be sold to an end user as a final product, the price increases.
Thank you. Our next question.
And I should mention that, I'm sorry to interrupt you, but I should mention that an 80% final product sold to an end user sells for considerably more. So our goal is to increase our processing capability, and we're working on securing long-term offtake agreements to sell final products to end users where we'll get the highest possible price for our product. So please stay tuned for that. We are working on that at presently.
Very good. Thank you for the additional clarification there. Our next question, how has anticipated graphite demand affected prices for amorphous and flake graphite?
In the short run, it has not. To the best of my knowledge, I haven't seen an effect either way in the graphite price for any type of graphite product. That being said, I recently just read a report by Industrial Minerals Data. It's a group out of London, England, that is, I would say, the authority on graphite and industrial minerals. And Simon Moores, their head analyst, suggests that his thinking is that there's going to be significant, there's going to be an increase in graphite pricing in the second half of this year. So we're anxiously awaiting an updated table of graphite prices from them. And we think that with the recent announcement from Tesla to build a gigafactory in the southwest U.S., which will require approximately the equivalent of 93,000 tons of flake graphite, that would cause a significant increase in pricing for flake graphite in the medium term here.
Thank you. And our next question, this one's asking if can you provide an update on the current supply of graphite that's coming from China? Yeah, again, I just read a recent report, again, by Industrial Minerals Data out of London, and the report covers how China is actually consolidating their graphite production. So at the peak, China produced about 90% of the world's amorphous graphite and about 80% of the world's flake graphite. Recently, what's happening is that they're trying to clean up the industry. It's not been in China. It's not known to have been particularly environmentally friendly. There's been some changes to legislation which demands that these projects become more environmentally friendly. So, for starters, there was a consolidation of graphite mines, and a series of graphite mines were shut down by the government. There's the second sort of development in China is the environmental laws that have come into place that have caused companies to be shut down until they meet environmental standards. There's also a move in China towards value-added products, meaning that the government wants to establish high-tech industrial parks to produce value-added graphite products and move away from being just a concentrate supplier. So rather than sell just flake graphite or amorphous graphite, there's a move in the industry in China to turn that flake graphite into anode material or batteries in country, or even right into the electric vehicles. So that's causing a little bit more of a pressure on the supply side out of China. So if you take all those factors into consideration, you can see that out of China, there is currently a little bit of strain on the supply side, and there's been no new graphite mines, to the best of my knowledge, that have come online in the last several years. So there's a crunch on the supply side. With the Tesla announcement, there is going to be significant increase on the demand side, and what happens there is that there's a vacuum in the middle, and we hope to feed that market and create value for our shareholders that way. So currently, I mentioned earlier that China used to produce over 80% of the world's flake graphite. The last I saw, it's down to about 70%. And we believe that number will actually come down considerably. Okay, thank you. And we have just under 2 minutes to go. What's the main takeaway you think investors should have about the Big North Graphite story? Well, our goal is to be the first junior company in North America to produce and sell graphite and a full range of graphite products. So we have already been selling amorphous graphite from our projects in Sonora, Mexico, but recently we acquired Mexico's only past-producing large flake graphite mine and mill, and it's a full mill that shut down in 2002. So really what the takeaway is that it's not an exercise in exploration or development. It's an existing mine that shut down due to price in 2002. At the time, large flake graphite was selling for under $500 a ton. It's currently closer to $1,400 a ton the last I saw. And we don't have to, all mining projects need capital expenditures to get the project up and running. The mill is in place. It does need to be refurbished, but the mill is in place.
there's power, there's water, there's roads, there's all the infrastructure needs are already there. So we believe that gives us a significant head start over all the other junior graphite companies in our ability to restart this project as quickly as possible for as little amount of capex as possible, and capture some of the market for our shareholders. Graphite is a finite market. We believe it's a race to the finish line, and we want to be one of the first to cross that finish line. And as I just pointed out, on the supply side, there's currently some strain on it, and the demand looks to be growing, and that creates opportunity. And we at Big North want to fill that opportunity and create profit for our shareholders. So, I urge everyone out there to please pay close attention to Big North, the news releases that will be coming out in the next months, and as we outline our plans and how we're going to move forward and how we're going to restart our Oaxaca large flake graphite project.
Very good. Thank you, Spiro. We were just talking to Spiro Lattis, CEO of Big North Graphite, ticker symbol BNCIF on the over-the-counter market. We have to go right into our next presentation. We are moving on to XEO Entertainment, ticker symbol EXEO, with Scott Amaral, CEO, presenting. And that will start right now.
Hello, this is Scott Amaral. I'm CEO and co-founder, XEO Entertainment. We appreciate you tuning in. Before I get too far, I wanted to let everyone know that we have multiple products. So what we'll be doing is skimming through the products that we have, concentrating more emphasis on the Psycho headphones, which are ready to roll out, and we'll be discussing the marketing and rollout strategy on how to increase sales. Slide number 2 is the safe harbor statement, which you should all make yourself familiar with. Going on, slide number 3, about us, XEO Entertainment. We were started in 2011. We're headquartered here in Las Vegas, Nevada. We manufacture, license, distribute consumer electronics in the video gaming, music, and smart TV sectors. XEO is the company. The brands that we have, we don't market XEO as a brand. That's the company name. Our brands are Psycho, which are the gaming headphones, Cranks, the music headphones, Zaz keyboards for smart TVs, the Extreme Gamer, which is a multi-disc game changer, and the portable Android-based gaming system. The next slide will give you a better pictorial or graphic representation of the industries that we serve and the products in those industries. The first is video gaming. We have our Psycho headphones, we have the Extreme Gamer, and we also have the portable gaming system. Interesting to note that the video gaming sector is valued at approximately $93 billion and growing every year. The music offering that we have, the second one down, is the Cranks headphones. That's a $2.3 billion arena. The last product is in the smart TV industry. That is the Zaz keyboard, and that's currently a $86 billion arena, forecasted to grow to $265 billion within the next 2 years. The next slide we have, we'll give you an overview of the various products that we have. This is going to be starting from last to first. So the portable is the last product we're launching, and we'll get to what we currently have in inventory. The portable is an Android-based portable gaming system, 5-inch touchscreen, your standard SD card slots, nothing proprietary, Wi-Fi camera, 5 megapixel, Wi-Fi with a 5 megapixel camera, utilizing the freemium model, and we're expecting a launch next year for Christmas. Next slide we have in product is the Extreme Gamer. That's actually what we initially started the company after. That is a patent-pending multi-disc video game changer that uses a standard USB connection. It's Bluetooth, works with both your CDs and your DVDs. So what it does is it allows a gamer to load in 10 of their favorite games, plug it into their console. When they're done playing game 1, they hit the back button and can toggle through a menu of 10 various games. The next product we have is the Zaz Smart TV keyboard. That is the only keyboard on the market that's specifically designed for the smart TV. It gives you instant access to the TV's popular features, the Netflix, the Hulu, the Amazon, the Twitter. The problem is, out of all the smart TVs out there, 85% of people do not use the smart TV features. If you want to know why, try to type an email with a remote control. This solves that issue and unleashes the power of your smart TV and turns it basically into a big computer monitor. Next product, let me scroll down. Next product we have are the Cranks wireless on-ear headphones. The big distinguishing factor between these, Beats, SMS, Sony, what's out there now, these are actually 10 decibels higher than the Beats at half the cost. They're Bluetooth. They last around, the batteries around 24 to 30 hours, compact, foldable, built-in microphone. So if you get a phone call while you're listening to the music, it will ring. You hit the button, it answers your phone. Once that's done, you're off to the next track. Let me see here. Let me scroll down. The other Cranks, the other product that we're working on right now, and we're in the prototyping stage, is the Cranks Max. That's your big over-the-ear wireless plus cabled headphone that has active noise cancellation, same built-in microphone. Again, we've completed the engineering on this and we're off to the prototyping stage. The product that we're going to be spending a little more time on here is the Psycho headphones. These are patented. These are true 5.1 surround sound. They are, in fact, the only true 5.1 surround sound headphone on the market. I don't know if you can see from the picture, but in the bridge of the headphone is wide because there's actually 5 speakers in the bridge and 2 in the ear. The interesting thing about these headphones is that they solve a very real problem. You see, the game, whether it's Call of Duty, Halo, these games are an environment, and part of the environment is the audio, not only just what you see. Some would say the audio is equally as important as the visuals. With the current generation of headphones, what they do is they place multiple speakers next to your ear or a single speaker trying to replicate surround sound. That confuses the brain, and anytime the brain is confused, it blocks out that information. That information is not processed. So in these first-person shooter games, it's important for the player not only to know that the sound is coming from the front or the back, but the sound is coming from the front right or the front left, the back right, the back left. And this is the only headphone on the market that is immersive and allows that experience to happen. Some of the reviews on the next slide of the Psycho headphones. PC Gamer stated, sounds better than any headset I've ever tested. Psycho named one of the must-have products for 2010 from Wired Magazine. Best directional audio we've ever tested, Tom's Guide. You can see the Best of CES, the Innovation Awards, the Red Dot Awards. Again, very different than anything that is currently out there on the market. The next slide will give you a competitive comparison of our headphones versus what's currently out there. Keep in mind, our PC headphones are $149, our console headphones are $199. So we're at the same price point in the premium market. We don't sell the entry-level models. Triton is the market leader at $54 million a year in annual sales. Astro is the middle company with $47.4 million in sales. And Turtle Beach was just acquired by PAMT Parametric Corp earlier this year. So they were a private company. They haven't combined their financial statements to release actual sales data, but estimates are anywhere in the $45 to $50 million category. So anywhere from $45 to $55 million a year in sales is where the competition is coming in, all utilizing the same technology, which is algorithms and processing to deliver or replicate 5.1 surround sound. So if we stop for a second, let's back up. What do we know so far? So what we know is we have the best headphones on the market. They sound definitively better than the competition. They're at the same price point as the competition. They've been reviewed by thousands upon thousands of people. And even more interesting is that we have historical sales data of an average sale of 8 units per store a couple years ago when they were being sold. The problem is they were only sold in 4 stores, or 40 stores rather, and that wasn't enough revenue to sustain the company. So that's where we stepped in. we like to jokingly tell people that the Psycho headphones are the best product on the market from a company that nobody knows about. So the key question is, how do we change that? And the answer is marketing, and that's what we'll talk about next. Go down to the next slide. The marketing campaign is really a couple-fold, but initially what we'll be talking about is advertising on Google, getting the Psycho name out there, getting the Cranks name out there, getting the Exio name out there. So the search engine marketing on this first slide really consists of two things. It consists of pay-per-click and sponsored product. Now, if you're actually looking at the PowerPoint now, on the right-hand side, you'll see the sponsored product. You'll see all the various models of the headphones. That'll take you directly to a store where you can purchase them. On the left-hand side are your normal pay-per-click ads in a slightly muted tannish tone, I would say that is. And then after that, starting with top 10 reviews, that's organic. So that's from Gaming Headsets Review, Best Buy. So the pay-per-click advertising will get us at the top of those listings, and also the sponsored content will give people an opportunity to buy when they search for a specific term. This particular one is on Bing. If we go down to the next slide, this is the same thing except searching for gaming headphones in Google. If you notice, it has the pay-per-click on the left, the sponsored product on the right. The interesting thing on here is if you look under images for gaming headphones, the Psycho headphones are the first two that show up. And, go into Google and type gaming headphones. It shows up on Google. It's not just tracking me because I've searched for those. So we're in there. The problem is it doesn't take us directly to a store like Newegg, Amazon, Best Buy, where they can purchase it. It just takes it directly to our site. So we need, again, to change that. The next slide talks about sponsored content. The sponsored content it improves the brand awareness and credibility, it positions you as an industry leader, and fuels your overall media strategy. How that works is, let's say you're reading the Wall Street Journal. You read about a tornado hit Canada and, 3 houses were destroyed. Immediately under that, in the news feed, talks about the Psycho headphones as if it's news, but we just paid for it. So then when you later use that for advertising, as seen on TV, as seen in the Wall Street Journal, as seen on the Business Money Report or any other vehicle that you're using to advertise that. The next slide down, so we have search engine optimization, pay-per-click, sponsored content. Now we're off to the ad networks, the banner advertising on IGN, on CNN, on GameStop, all of the various targeted sites that cater to our specific demographic. These are all ways in which we're going to start the advertising campaign to increase the awareness and pull sales through the channel. One of the other components of that is they call it pre-roll, video pre-roll. What that is that's essentially a 30-second commercial that'll show up on Google right under the product listings. It's a video. The video pre-roll generally will have a higher completion rate, a higher share rate than a straight pay-per-click ad or even a product-sponsored ad. We're looking to do that on Google and Steam. On the right-hand side of the PowerPoint slide, it'll talk about Steam. I've been in discussions with one of their ad partners. They have 55 million accounts. If you are a PC gamer, even though you go down to Fry's and buy the game, when you install it on your computer, you need to interface or you need to install Steam on your computer to be able to access that content. I guess that's the management or the content on the back end, but it's specific to PC gamers. So in the not too distant future, when someone goes and they, let's say, are playing Call of Duty, while that game is loading, they're going to see a 30-second commercial for these Psycho headphones. And that is all part of the strategy. Let's go down one more. The other part of our marketing campaign is on the next slide, it'll talk about Supercross. I don't know if any of you are motocross or Supercross fans, but we currently support one rider as title sponsor, help out a couple other riders depending on the event. Next year, we're looking to start a 3-rider team to contest the 250 East Coast, West Coast, and 450 across all 17 rounds. The beautiful thing about Supercross is it has an unbelievably high brand loyalty. 87% of race fans indicate they purchase products from companies that sponsor motorcycle racing. So what this does is it has your product, your logos, your images rolling down, I think it's 20 or so thousand miles across the country in a period of 5 months. Nearly 900,000 people attend these races. They're aired live on Fox Sports 1 and CBS. Millions and millions of social interactions. And it just gives fans, or in our case, prospective customers, an opportunity not only to see the product, but test the product, use the product, and interact. So we get very valuable feedback from our audience. And you can't really sell product there, but you can gather data. You can hand out coupons, hand out flyers, promotional materials that'll directly lead to sales. The next slide down. So that's kind of a basic gist of the marketing strategy and pulling those sales through the channel via increasing awareness. Obviously, there are a couple other things that we need to have in place in order to, accomplish that. So this slide basically touches on manufacturing, just to let everyone know that we do have contract manufacturers in place in Shenzhen, China. We actually have 2 factories, one for our headphones and one for our keyboards. We also have a management team over there that has 20 plus years of industry experience and has worked for the competition, elite product management. And right now we have on the assembly line right now are the Psycho PCs, the PC models, and we have the Cranks headphones. We have another batch coming over, a different color. We have black in stock in the warehouse, or we have white, and we're ordering black. So those 2 are both on the manufacturing line right now. So we have that's the manufacturing. The next slide, I'm not going to go into a lot of detail on this, but after the presentation, if you want to look through the slides, this will give you a breakdown of the actual manufacturing process and where we're at with each of the main products that we're looking to promote in the course of the next couple months. Scrolling down to the next slide. So we've got the product, we've got manufacturing, distribution already taken care of. It's not something we're looking to do. It's already been done. Right now we have a contract in place with Navar, who sells to all your major brick and mortar stores. They also sell online. 80% of your market is Walmart, Best Buy, GameStop. That's where 80% of your gamers stop, or shop rather, not stop. So GameStop, it'll show you here, 6,627 stores. Best Buy, 1,056. Walmart, 3,783 stores. Target, 1,797. Our products, we're on the online catalogs. You can go into Best Buy. The problem is they're not going to order inventory from us until we have people going into the store and asking for our product. But there's probably 1,000 different sites that you can order our product on online right now. So to kind of summarize all this, I know I've kind of gone through this in a whirlwind, but what we have is the manufacturing and the distribution already in place. We have 2 products that are in launch mode right now, the Psycho PC headphones and the Cranks music headphones. We'll have 2 additional products by year's end. That'll be the Psycho console unit, and that'll also be the Zaz keyboard and potentially the Cranks Max, although that's not expected until January. So a minimum of 2 additional products by year's end. The sales right now are completely and entirely dependent on an effective marketing strategy. We need to establish that name recognition, the brand awareness, pull those sales through the channel. I tell people all the time, the difference between selling 1,000 units a month and 10,000 units a month, the only difference is your marketing budget. So the potential of this, we're looking at probably 45 to 55 million in the gaming headphones. Again, that's what the competition is doing with a product that's just copying each other. We have patents. Our definitively sound better. We're looking at a potential of 100 or 50 to 100 million in the music headphones. You know, a 10th to a 20th of what Beats was able to accomplish. We're looking at another 50 to 100 million potential on the Zaz keyboards. And important to note, if we didn't already, that there is no other specific smart TV keyboard out there that works across the board with all of today's smart TVs. So in sum, to sum this all up, we believe this is a good ground floor opportunity in a public company with a low float, fully reporting, and with a ton of upside potential. And that is that.
Okay, we're now opening our Q&A session for XEO Entertainment. Ticker symbol is EXEO on the OTCQB. And with us on the line today, we have Scott Amaral, CEO of XEO Entertainment. Welcome, Scott.
Hello, thank you.
And I have several questions already. Our first question, when would you expect to achieve $1 million in revenue?
That's one of those refer back to the disclosure, because that's very future-oriented. I would say we're looking to achieve those numbers within a 12-month time frame. The goal within that time frame is to ramp these Psycho units up to 10,000 units monthly, which would produce approximately 1.3 in revenue on a monthly basis.
Very good, thank you. And our next question, how many product units can be produced at your contract manufacturing facilities?
The MOQ is 5,000 units, the minimum order, which we negotiated down from 10. They currently claim a 20,000 unit per month capacity.
Okay.
And that's on each product, because we're dealing with both factories.
Okay. And what products will be available to consumers in 2014?
In addition to the products now, the Psycho headphones for PC and console, we'll be wrapping up the console unit will be available, as well as the Zaz keyboard and the Cranks Max. And we're looking for a January launch to tie that into the Supercross team that we're doing that starts off in January, early January, and runs through May.
Okay, very good. And how much of your budget is dedicated to marketing and advertising?
That's a tough question, because sales are so minimal right now, because we don't have that awareness out there. So we're kind of starting it in reverse. We have a marketing budget right now that the campaign we're launching is $50,000 a month. We're going to see what the numbers are on that, tailor it, tweak it, and adjust the budget up or down. The immediate term goal is to get a install base, so that, let's say the 50,000 generates, 1,000 units in sales. Now there's 1,000 people out there talking about Cranks or talking about Psycho, and that organically grows our social media. We start getting the reviews, and then people start going into the Best Buys, the GameStops of the world, and requesting the product. So we're not only generating revenue, but we're increasing the awareness and implementing that pull marketing strategy.
Very good. Thank you, Scott. And our next question, what are your plans for raising any additional capital?
It's, again, one of those, we can map it all out right now, and plans change on a minute-to-minute basis. We do forecast having some additional dilution over the course of the next year. Basically, depending on the return that we get for the advertising campaign, we're looking for an approximate infusion of $2.5 to $3 million.
Okay, very good, thank you. And just want to remind our viewers, if you do have any questions, you can click the submit question box above the presentation window or below. A few more moments to see if any further questions come in. Doesn't look like we have any further questions. So just to wrap things up, Scott, you've obviously explained a lot within the presentation and then with several of these questions you just answered. But what would be the main takeaway investors should really have about the XEO story?
Well, the point I was hoping to get across is that, we're more than just a PowerPoint presentation. We're not an idea. We're actually a physical brick and mortar company with inventory sitting in our warehouse. So none of this is ideas. Of course, there's things we have to test on the marketing. These are new things to us. There's some art to it, but this is a company that we're not hoping to launch a product. We're not hoping to do a lot of things. We are actually doing those things. We've been to the trade shows for the last couple of years. We walked away from E3 last month. 98% of the people that try the Psycho headphones say the exact same thing. And the first word out of their mouth is awesome. These are awesome. So we know factually, we're not thinking, we're not guessing, we know factually that we have hands down definitively the best gaming headphones on the market. Like I said in the presentation, the problem is nobody knows that we exist, or very few know that we exist. So this is really nothing more than an exercise in marketing. We have products that the market wants. We have to reach that market, advertise the products, and I believe as the presentation laid out, I think we have a rock-solid plan to do exactly that. As far as the stock goes, because we're new, the revenues are minimal. I think we have a ton of upside potential, and I think, the sky is the limit on this. And in the coming years, we have the potential over the course of, let's say, the next 36 months to ramp this thing up through multiple products to $100 million a year revenue opportunity.
Very good, Scott. And for our viewers, we were just talking with Scott Amaral, CEO of XEO Entertainment. Ticker symbol again is EXEO on the OTCQB. With all the exciting things coming down the pipeline for them, please make sure that you sign up for the email alerts so that you can keep up to date on all the developments as they happen. You can have your email below the presentation window to do that. And we'll be moving on to our next presentation just in a few more minutes, and that will be with Station Digital. Ticker symbol is ALDV on the OTCQB, and that will be starting here just in a few more moments. we're just listening to earlier XEO Entertainment, ticker symbol EXEO. And for anybody who's interested in XEO products, you can always visit them online and purchase the products today online at store.exeoent.com. Again, that's store.exeoent.com. We're going to be moving into our next presentation now, and that is going to be with Station Digital. Ticker symbol is ALDV on the OTCQB. Again, Station Digital, ticker symbol ALDV. And we'll be starting that here in a few moments.
Hi, I'm Lou Rossi, President and CEO of Station Digital Corporation, and this is our investor presentation, July 2014. I am required by law to, of course, start off every presentation that I give with our legal disclaimer that any forward-looking statements that I make can or may not happen in the future. So please be sure to read your legal disclaimer and to check with the licensed consultant before investing. Station Digital Corporation's mission is to build and continually improve upon an easy-to-use platform whereby its users may stream or access any media or purchase digital or physical goods from any device at any time and from anywhere. And our founder, Tim Roberts, and our master digital architect, when he came up with this plan, was very attractive to me, because when you think of Station Digital, what I want you to think of is those of you that use a lot of digital media, stream music, stream video, like myself. I have an account with Netflix. I have an account with Vudu so that I can watch first run movies, and Netflix is more my second tier movies. And then I have an account with Nook for my ebooks. I have an account with Amazon to purchase my physical and digital goods. And the list goes on and on. And Station Digital's attempt is to bring all of these digital access methods together under a single platform with a single account. But to top it all off, we've added a little wrinkle that makes it very attractive to potential consumers that I'll talk about in just a second. Some interesting facts that I wanted to bring up that really kind of led Station Digital to become what we're trying to build today is that Gartner predicts that there's going to be a $1.9 trillion e-commerce market by the year 2020. So from the standpoint of building an e-commerce platform, this is very attractive. There's a large growth area. But in addition, there's also a lot of advertising spend that is being placed in the online space, and that area is growing tremendously as well. TV is dying. Audiences are not responding like they used to, and people are accessing their media in different ways. Radio is also becoming a thing of the past, and users are moving more to online or streaming methodologies that are now available to them within their own cars. So in addition to the radio stations over the air, in addition to satellite, but now we have these streaming sites like a Pandora that we can access and get our music through, and we can generate advertising dollars. Internet radio is booming. Right now, ABI Research predicts that music streaming services are going to generate about $5 billion in revenue this year alone. But what makes it even more remarkable is that by the year 2018, they estimate that it's going to be over $46 billion. So the digital media is very explosive. Those of you that are familiar with Netflix have probably seen, explosive numbers in the number of subscribers that they have. Pandora also has over 73 million subscribers or active listeners today. So what do we see ahead for digital consumers is that people are going to access video, audio, anything really through either a mobile device, in their automobile, while they're at a restaurant, using simple Wi-Fi. The 4G and the Wi-Fi that is becoming prevalent in this country is making it very easy for users to access any media, anytime, anywhere. So this has really led to the dawn of the Station Digital era, where we can change the way everyone is consuming digital media. But for the first time, what we're doing is we're combining all of these products And then we are creating a loyalty program, a rewards program. What this means is that for every minute that a user listens to the radio or watches a television or movie on Station Digital or purchases physical and digital goods, we will give reward points to this individual. Those reward points can then be used to purchase actual physical or digital goods in the Station Digital e-commerce store, which is the back end and the core of the Station Digital platform. All of our media will lead to these rewards that will allow users to be able to monetize the amount of time that they've listened and the amount of time that they've invested in Station Digital. And so this is a way to give back and create loyalty. This is the first time this has ever been done. In addition, the platform is going to be completely device agnostic. We are not going to be aligned with any one manufacturer or any one platform. We will run on any of the platforms, whether it be from Roku's to digital connected cars to Droid devices or Apple iOS devices, Mac, PC. We don't care. The key is to be device agnostic so that users can choose any device and they can access it from anywhere at any time. So if you take a look at what we've done so far at Station Digital, is we publicly launched our website in September of 2013. Several months later, we had our Droid app and our Apple iOS app available so that users could stream music. Right now, music streaming is the only available service that we have up and running in a short period of time. However, we have driven almost 7 million users to the site, and we have over 350,000 users a month that are actively listening to Station Digital. In addition, with Station Digital, we've created a music service with a library of over 22 million songs in our library, more than any other service out there right now. As I mentioned, the company the website launched in September of 2013. We have offices right now. Our headquarters is in St. Louis with offices in Tampa and soon to be in New York and LA as we attack the advertising market. As I mentioned, I'm the CEO, one of the key management here at Station Digital. Our founder, Tim Roberts, has over 20 years experience in building organizations and one of the founders of a company called CenturyLink's Savvis product that some of you may know. Myself, I've started several web companies from training companies, ccprep.com, resellers of hardware products, and have over 20 years experience in the industry. Our CFO, Terry Taylor, is got 20 years experience working in public companies as an accountant, CFO, and a controller. And Ed Storm has joined our team as well as our COO and comes from a long background of president or CEO of other firms. So we have a good key management team. We have a great product. Right? But how are we going to win the media wars? Right? To survive, so to speak, on Internet Island, we feel that we're going to have to be device agnostic, as I've mentioned before. We're going to have to be portable. In other words, we're going to have to be able to run on anything, no matter how small it may be, from the Google Chrome device all the way up to your bigger popcorn hour boxes. We are going to make our platform completely device agnostic. And what's allowed us to make this happen is HTML5. It's allowed us to create a completely independent, not just of hardware platforms, but also of the software, whether it be the Google Chrome browser or Internet Explorer. HTML5 is allowing users to be able to program and create websites that are completely device agnostic and software agnostic and operating system agnostic. Our mobile apps are, of course, going to be available on Droid and on Apple iOS. And our future vision is that we are going to continue to always have free ad-supported access to our media. That's not to say that we will not have premium subscriptions for users that will want to pay a monthly fee and eliminate those ads. But we always, at Station Digital, we feel that ad-supported content is always going to be the future, because that's how users experience new content. Nobody just goes out and buys a song that they've never heard. The person has to hear that song. No one buys a movie that they've never seen. They've seen that movie, and now they're going to purchase it. So the ad-supported content is very important to Station Digital, and we will continue to have it. And advertising is increasing every day. The online advertising continues to get bigger and bigger and bigger. Now, why are we disruptive? How are we going to change the market? You say, well, you got Netflix out there, you got Pandora out there, you got Hulu, you have all of these competitors. What they don't have is they don't have the back-end e-commerce platform that allows them to reward their consumers for what they're watching or what they're viewing or what they're listening to. It's the rewards program that really sets us apart from our competitors, in addition to consolidating all of these different things. Because when you think about movies today, Netflix is a fantastic, think of it almost like HBO, although HBO is a great example with their HBO Go platform of ways that we can access this media. And what we're doing is we're bringing all those together. Vudu is a great way to purchase movies, leave them in the cloud. iTunes is a great platform to purchase songs, leave them in the cloud. With Station Digital, what we're doing is we're bringing all of that together. You'll have a digital locker that will have your e-music. You'll have your movies, you'll have your ebooks. Any content that can be purchased and stored online will become part of the Station Digital locker, in addition to the streaming services and subscription services that you would expect from a Netflix or a Hulu. And as I mentioned before, we will run on any of the devices that are out there. As I also mentioned, Station Digital today has over 350,000 users. We've done this in a relatively short period of time, which we feel is going to give us, it has shown us that we can grow much, much faster than a Netflix or Pandora did in the past, because users are craving this content more and more. So although we're not an early adopter of this technology, users are no longer in the early adoptive phase, and users are really craving the media from anywhere, at any time, from any place. Our infrastructure has been built to scale. We are internationally available. So we've already built this infrastructure in place, and now we are just adding more and more subscribers, and then we're continuing to build out the platform and add content. The difference between us and a Amazon or a Netflix or a Pandora or a Hulu is our ability to monetize and retain our customers. So at Pandora, you're only going to have your advertising revenue and based on your millions of subscribers. They're at 73 million right now. So at Pandora, once they reach market saturation, how are they going to grow their revenues? Well, they're going to try to grow their premium subscription. You're only going to have a certain percentage of your users are ever going to pay for that premium subscription for music. Most of your users are going to continue to use the ad-supported and free content. What we've done at Station Digital is we've created a way to monetize our subscriber base long after we've reached market saturation, because of the rewards program that will continually drive people to our e-commerce platform. So a user to Station Digital will be worth a lot more money than a user to a Pandora or a Netflix, where the Netflix only gets $8.99 per user. If they're lucky, they might get some advanced subscriptions on the DVD side. With Station Digital, we can monetize that user so that they are paying for maybe an audio premium subscription and they're watching the video free content. We can combine all of that together, which will also save us significantly when it comes to our advertising budgets, unlike a Netflix or Pandora where they have to advertise for their audio-only service or their video-only service. We advertise together. It gives us a huge competitive advantage. And what we're finding is that the finance activity in this space right now is extremely active. Station Digital has raised over $5 million in its first year. We haven't even completed our first year, and we're working, of course, on our A round right now. But if you look at Asongza, just recently got purchased by Google for upwards of $20 million. That number was undisclosed, but estimated at $20 million. We see that Beats was purchased for $3 billion by by Apple, excuse me, we can see that a lot of activity. If you look at your presentation, you'll see we've outlined several more, but we'll also see that valuations are very high right now. This is we're getting great multiples in this space because of the huge growth that we have moving forward. If you look at Netflix, their recent valuation was at $28 billion. This is over $700 per subscriber in market cap. At Station Digital, we think that we can get well beyond these valuations moving forward because of our ability to monetize. But we don't need to even come anywhere close to that to be a very successful organization and very profitable. Now, how are we growing? How are we going to get consumers? Well, in online, it's very easy. We're gonna work on an online advertising. As I mentioned before, we've gotten almost 7 million users. We have 350,000 active users today in just a short period of time, and we've done this on a very limited budget. With our future rounds of fundraising, we will continue to grow our online ad space. We will move into other forms of advertising through sponsorships, through racing, working with NFL, Major League Baseball, NBA. We will be able to grow our brand awareness and drive more and more users to our site. More importantly, because of our rewards program, we will generate loyalty. We'll retain those users, in addition to having great word of mouth as users get to go out and purchase free goods. In just a short period of time, if you look in your presentation, you'll see that we've actually taken Station Digital to number 5 in the free download of iOS top charts. So it's just a very limited budget. We've been able to be very successful and to start driving that user base. So we feel that we're going to have some great rates of growth. Although our projections, if you look at our presentation, you'll see that we are not projected to grow as fast as a Pandora or a Netflix, but yet we will still be extremely profitable with estimated revenues in the third year of around $750 million, which sounds like a high number for 3 years of growth. But when you look at where that revenue is coming from, when it comes from advertising, premium subscriptions, an e-commerce platform, this is a lot different than the other models that are out there today in the market. We have many different places that we can generate this revenue from. We also have a great advisory board. John Fanning, Kevin Backus have helped us out tremendously and are part of the team helping guide the management team as we negotiate an ever-changing landscape in online media access. So why would you invest in Station Digital? Because online media is the future. It is a huge growth rate. We also feel like we have the best product. Our loyalty program, it gives us the ability to distinguish ourselves with the others that are out there in the market. There is a meteoric growth right now in this industry, and we feel that we have a great platform to do it with. So if you have any questions, please reach out to us at lrossi@stationdigital.com or visit our website, stationdigital.com. Thank you very much for your time.
Okay, we're now opening the Q&A session for Station Digital. Ticker symbol is ALDV on the OTCQB. With us today, we have Lou Rossi, CEO. Welcome, Lou.
Hi, how you guys doing?
Very good. Got several questions that have come in so far. First, how does your digital and physical goods store help differentiate you from other competitors?
Well, there's two sides to that question. So on the revenue side, how does it help us to generate revenue and distinguish us from our competitors is that it is a revenue stream that really there's only one of the competitors out there that has that capability, which would be Amazon.com. But a Pandora, a Netflix, a Hulu, any of these others do not have an e-commerce platform that they can sell goods related to the products or the services or their media that they're delivering. One of the great things that we're going to be able to do, in addition to just using our reward points, which of course is a huge distinguishing part of this whole system, is that the reward points is going to drive people to this store, but then we're going to be able to do some tie-ins with marketing and advertising where we can sell widgets and we can have a featured store about those widgets and really generate activity around certain products, and obviously we'll charge for that. So advertising is not just going to come from the traditional online ads or video ads that you would get through any online platform, but it's also going to come through some unique marketing that we'll be able to do with that e-commerce platform. So from a revenue side, the e-commerce platform, it really is going to be a huge part of our revenue, and also be able to distinguish us from our competitors. Then on the user experience side, why would a user use our e-commerce platform as opposed to an Amazon or a buy.com or whatever the case may be? It's because, once again, we're consolidating all of these accounts. So you've got, I mentioned in my video there that, I've got Nook, I've got iTunes, I have Amazon, I have all of these apps on my phone. And that would be really nice if I just had a single account that I can manage all of these things with. So from a user experience, we feel that by consolidating the marketplace and all of these goods, that users are going to be very attracted to it. It's very annoying having to enter my credit card information into site after site after site after site, and then to get a call from my bank saying, oh, by the way, your information has been hacked and we've got to lock up your card. So we're hoping that users really respond well to the fact that we are bringing all of these things under a single roof. We're making it very simple, very secure. And of course, with 50 million SKUs, we've got pretty much everything that they need.
Very good, thank you. And our next question, what devices does Station Digital currently run on?
Okay, well, currently right now we have the music application that is up and running on any web device. So that would be any browser, whether it be PC, Mac. We also have a Droid app. We have a iOS app on the Apple platform. And right now we are currently working with Western Digital and Roku to have that app up very shortly. But we have plans for Popcorn Hour, Google Chrome device. We're working with several car manufacturers to be able to put that in some of the newer cars that will be coming out that will be connected with 4G. And a host of others that we're working on. You can see in the presentation we had some ideas of what we're working on.
Very good, thank you, Lou. And our next question, can you talk a little bit about how you may go about upselling some of your customers to some of the premium services?
Sure. So, obviously we feel like the ad-supported content is going to be a huge driver. We're going to use advertising, outbound advertising to drive users to that content. But we hope that the content kind of sells itself, and the convenience of the fact that somebody is going to be able to listen for free or watch for free, like something, and then with the e-commerce platform there, it makes it very easy for us to upsell. So, and you can see that we do it already in the existing site. If you are, and I do this all the time, I'll be listening to a song on my Station Digital radio, and it says, oh, you like this song? Here, purchase here. And you can click, and you can go right to the store. Now, right now, we're actually, the store isn't up and running, but it will be here shortly. And when it is, it's going to be very easy for us to continue to upsell these upsell to the e-commerce platform and then upsell to premium subscriptions. We'll be able to have advertising in there. One of the things that I always hated at Hulu is I hate those ads. Well, eventually, if you're watching that ad-supported content for long enough, you say, oh, you know what, the heck with it, I'll pay the $7 to upgrade. So we think that just by driving the subscribers to the website and then using some online advertising on the site, which is our inventory anyways, that we'll be able to do a very effective job of upgrading people to, or upselling them, I should say, to either premium subscriptions or to e-commerce.
Thank you, Lou. And our next question, what are your plans for additional funding? Will you need any new funding here in the near term?
Yeah, absolutely. So right now we are just finishing up a bridge round that we had a $2 million bridge round that we're currently partially subscribed. We're just finishing up. And then we have a second plan for an A round, which is approximately $10 million with another $15 million in warrants behind it, which we feel between those two rounds that we'll be able to get to profitability.
Okay, very good, thank you. And our next question, how much do you plan on spending to develop your products and to market your product?
Well, all of this is in the operating plan that I would be happy to share with someone that wanted to reach out to me. but we have very good. Our master digital architect has worked tirelessly with a lot of the providers and the developers. We are using a lot of resources overseas to keep our development costs down. And we have learned to automate a lot of the things that our competitors are doing manually, which obviously keeps our costs down as well.
Okay, thank you. And that was actually the last question that had just come in. I guess to wrap things up, I mean, you've already covered a lot of great points today, but what's the main takeaway investors should leave with today regarding the Station Digital story?
Well, there's a couple things that people should walk away with. Number one, this is an explosive growth area. The internet radio, as I mentioned in this presentation, I mean, it's going from $5 billion to $46 billion here in the next 3 to 4 years. It gives us obviously a huge opportunity. And regardless, I mean, we realize that some of our competitors already have great strongholds. We're not saying we're going to be larger than those competitors. We hope to be someday, but we don't have to be an extremely successful organization. The other thing that people need to take away is that we have a great product that is very unique. Look how well rewards programs work for all of these different products that are out there today, starting with the airlines all the way to, we were just talking about the stamps that you used to get from the gas stations years ago. I mean, these reward programs they drive loyalty, they drive business. And so, we have two things I think that are going for us. Huge explosive market, number one, and then number two, we have that characteristic that's going to distinguish us from the others and keep our customers with Station Digital.
Very good. Thank you, Lou. And for our viewers, we're just speaking with Lou Rossi, CEO of Station Digital. The ticker symbol, again, is ALDV on the OTCQB. You can learn more about the company, of course, at redchip.com. And to stay up to date on all the developments as they take place, be sure to enter your email address in for email alerts on Station Digital. You can do that right below the presentation window here on the site. We're going to be moving into our next and final presentation for the day. Lightbridge, ticker symbol is LTBR on the NASDAQ, and that's Lightbridge, ticker symbol LTBR on the NASDAQ, and that'll be getting started here just in a few minutes. going to move into our next presentation now, actually our next and final presentation for the day, which is Lightbridge. Ticker symbol is LTBR on the NASDAQ. Presenting for the company is Seth Gray, President and CEO.
Hello, I'm Seth Gray. I'm the CEO of Lightbridge Corporation, LTBR on the NASDAQ. We are bringing great technology to the nuclear power industry, bringing non-carbon emitting technology to address the greatest concerns of utilities and companies around the world in nuclear power. We're also generating revenue today through our consulting business. I'll call your attention to slide 2, our safe harbor statement that you'll see on the screen. And I'll call out some slide numbers as we go through so you can see which slide I'm on. Lightbridge is bringing value to the industry through 2 business units of the company. First, we're developing nuclear fuel technology that addresses the greatest concerns of utilities today, which is decrease the cost per unit of electricity generated so nuclear power from existing plants as well as new ones can compete with hydrofracking gas, with coal, with other ways of generating electricity, can compete and win in the marketplace based on economics with nuclear power. And secondly, we are bringing in consulting revenue by advising governments and companies around the world that are starting new nuclear power programs or expanding existing ones. On slide 4, our nuclear fuel technology that can be used in existing reactors is reducing the cost per unit of electricity generated by allowing the existing reactors to make more energy. It also reduces the number of days the reactor is shut down per year, so the reactor is generating revenue by producing electricity more days per year. As we go into slide 5, this is some of the key independent validation of our technology. Siemens Corporation has issued reports that are available on the Lightbridge website at ir@ltbridge.com, where they are validating the numbers on the economics of the benefits of Lightbridge fuel that are quite significant and that we'll go through in this presentation today. The American Nuclear Society has published a peer-reviewed article validating Lightbridge's technology. On slide 6, we're dealing with a world with increasing demand for energy, and the world needs clean, non-emitting baseload electricity that can compete and win. So if we look at slide 7, these are the main ways the world produces our electricity. Coal emits a tremendous amount of CO2 and is polluting. Technologies for carbon capture and sequestration are extremely expensive. Hydroelectric doesn't produce pollution, but is tapped out everywhere that can have a dam already does. We're not going to add a Niagara Falls to Manhattan. Natural gas is more plentiful now, but emits half the CO2 of coal as we're displacing coal plants with gas plants. That's helping the environment, but we're going to run out of just how many coal plants we can replace with gas plants. Wind doesn't produce energy when the wind isn't blowing. Solar doesn't produce energy when the sun isn't shining. There's a lot of work on renewable energy technology, but battery storage that will make them economically competitive for baseload electricity against power like nuclear and coal is well in the distance, way beyond, I think, the time frames the world needs to have new clean power on the grid. And what you can do with Lightbridge fuel is dramatic. If you look at slide 8, you'll see that solar and wind are very expensive. They're basically surviving because of government subsidies. Gas and coal are off to the right because of the environmental impacts, but nuclear and green to the left is a bit more expensive than gas today, and that's a problem for the utilities that own and operate the reactors. But if you use Lightbridge fuel to upgrade the existing reactors, that added electricity is what's in blue. And these numbers are right out of the Siemens report that you can see on the Lightbridge website. And if you already have reactors and you upgrade them using Lightbridge fuel, that added electricity will be the cheapest electricity on the grid in the country. the cheapest way to add massive amounts of electricity is to upgrade existing reactors with Lightbridge fuel. So on slide 9, nuclear and coal are baseload generation, but in order to meet climate goals, environmental goals, and meet the nuclear energy goals of those countries that don't have fossil fuels and don't want to rely on imports of fossil fuels, we have to expand nuclear energy with existing reactors and new reactors, and Lightbridge technology enables that to happen. As we go on to slide 11, some of the main benefits of Lightbridge's fuel. What the utilities are telling us is they have to increase electricity generation from existing reactors. It takes many years to build a new reactor. It's very expensive. Lightbridge's fuel will increase electricity generation from an existing reactor 10% to 17%, 30% in a new reactor. So you could build 3 new reactors with 30% more power each, get almost the equivalent of that 4th reactor without having to build it. Lightbridge dramatically improves safety. This fuel would perform much better by much more time under accident scenarios like at Fukushima. The Lightbridge fuel enhances the economics throughout the nuclear power industry, lets nuclear utilities compete better, and decreases waste. Lightbridge fuel just generates less waste, less toxic waste per unit of electricity generated than what's used in reactors today. On slide 12, you see a lot that goes toward proof of concept on Lightbridge fuel. In the top right is a photo of a cross-section of an actual Lightbridge fuel rod made in Russia for testing. And that picture in the top center is channels in a research reactor in Russia that tested the fuel. And in one of those channels is that actual fuel rod that you see the photo of on the right. We've made samples demonstrating the production of Lightbridge fuel that you see on the bottom left. We've assembled these into the kind of assemblies that go into Western reactors you see on the top left, and Russian-type reactors on the bottom right, so that we can target essentially the whole world market. Nuclear safety is, of course, extremely important. And on slide 13, it goes a bit into why Lightbridge's fuel is designed for safety, brings dramatic benefits for safety to nuclear utilities. Lightbridge fuel, even with the power uprate and the longer fuel cycle and all the other benefits, runs almost 1,000 degrees Celsius cooler in a reactor than current fuels used in reactors. Lightbridge fuel brings dramatic safety benefits to existing and new nuclear plants. Let's go on to some of the economic and financial impact. On slide 15, switching an existing typical reactor to Lightbridge fuel will bring in new revenue and savings to that reactor of about $60 million per year, according to Lightbridge analysis by Siemens Corporation, published in their independent report. This technology will add about $60 million of direct economic value per reactor per year. That's not including anything for safety benefits, for less spent fuel benefits, for the other benefits we bring, just pure real dollar benefits to the customer. If you look at slide 16, we look at the size of the world market. If you look at the 2014 numbers, to the top of the green is the amount of nuclear electricity in the world today, and using the very credible data from the World Nuclear Association that looks at the reactors on order and under construction and planned around the world, you see how much nuclear power will increase around the world by 2025, by 2030. Looking at the 2014 numbers, what's in blue, about a third of the nuclear power in the world, is what we call our target market. While Lightbridge fuel could work in just about all the reactors, we go through a down select process for the ones we'll initially target, even though we could hit just about all the way up to the top of the green. And we're initially targeting the largest Western pressurized water reactors.
Yeah, he was
so
here
if you just look within that target market, say, which is about a third of the world, say we hit 20% of the target market, how much revenue would that be to Lightbridge? So if you look at the next slide, the Siemens report assumes a 10% royalty for Lightbridge. Let's be conservative, use an 8% royalty. And what you see on slide 17 is a 20% of just that target market would bring in about $500 million a year to Lightbridge. And because it's royalty revenue licensing our patent that was issued at the end of February, that would be money that would virtually all drop to the bottom line. If we hit 40% just of that target market, that'll be about $1 billion a year, year in and year out to Lightbridge, year after year, almost as an annuity. Looking at slide 18, let's quantify some of these benefits to a utility. Using a wholesale electricity price of $65 per megawatt hour that the Siemens report assumed, it would, according to Siemens, for the first of a kind reactor to switch over to use Lightbridge's 10% power uprate fuel and increase its fuel cycle from 18 months to 24 months, so it sells more electricity, more days per year, it would be about a one-time $85 million cost to the utility to do everything needed to make the changes. $85 million is something that a utility can finance from its balance sheet, dramatically cheaper than building a new reactor for billions of dollars. The incremental gross margin to that utility would be $43 million. So this is after the utility pays for buying its nuclear fuel. This is after the utility has paid Lightbridge's royalty through the fuel fabricator that sold the fuel to the utility. So on that one-time $85 million cost, the utility would have a 50% internal rate of return. A one-time $85 million cost with a 50% IRR. For as long as that utility runs the reactor, it will have that 50% rate of return on that one-time initial investment. And we expect that that $85 million is just for first of a kind, and each subsequent plant would actually cost a bit less, as there was knowledge gained after doing it the first time. But just taking a conservative approach of the $85 million, that's a 50% IRR to the customer. Looking at slide 19, this year we're going to announce some partnerships with major fuel fabricators. Next year, they're going to make this fuel. The year after that, they're going to put it into research reactor under commercial reactor conditions. And the year after that, we're going to start getting data to confirm this to the industry. We're going to work with these partners to manufacture full-length commercial fuel. We're going to have these milestones over the next few years that will include major revenue milestones to Lightbridge, because we own all the intellectual property, we own all the patent rights, no one else owns any of it, and they will be in accordance with how licensing works in the nuclear industry, technology access fees paid to Lightbridge. And with the lead times in nuclear of ordering fuel before using our reactors, there'll be royalties paid to us before that first commercial use in commercial reactors on the chart. And going on to our commercial strategies and footprint, if you look at slide 21, we have what we call a push and pull strategy. We listen to the voice of the customers. Major nuclear utilities have their heads of nuclear fuel advising Lightbridge. We hear the voice of the customer directly. Utilities like Exelon, Southern, Dominion, Duke. We're talking to them, learning their concerns, which center on economics of nuclear power generation, safety of nuclear power. They're helping us so we can deploy this fuel to address those problems. Along the bottom of this table, you also see nuclear fuel fabricators. We're talking with the companies that make and sell nuclear fuel to make sure they can produce and sell this nuclear fuel to the customers. So the push strategy is we work with the companies to which we would license our patents that can make the fuel, and the pull strategy is we go beyond them directly to their utility customers that own and operate the reactors that will order the fuel and use it in their reactors. On the next slide, Lightbridge is already generating revenue. We started in 2008 with a consulting business where we're helping governments and companies that are starting or expanding new nuclear power generation. We have tremendous in-depth knowledge from feasibility through safe regulation of operating reactors. We have to know this to deploy a fuel that utilities will use in existing reactors and new ones they build, and people are paying us for this expertise. If you look at the next slide on 23, we have helped Kuwait look at the feasibility of what should be their energy generation mix and the feasibility of nuclear power. We wrote the plan for nuclear power for the United Arab Emirates, where we're still advising the program. We have reviewed reports prepared by a U.S. utility before they submitted them to the Nuclear Regulatory Commission for our expertise in nuclear regulation. We've generated over $52 million in consulting revenue since we started doing this consulting work in 2008. And we listed on the NASDAQ in 2009. So the last slide I'll mention is the Lightbridge investor value proposition on slide 24. We're already generating revenue through our consulting business. We're going to be deploying this fuel. This year, you'll see the fuel in contracts with fuel fabricators to produce the fuel, to test it, to generate electricity that will save utilities money so they can economically compete against hydrofracking gas, against coal with clean, non-polluting nuclear power, and also dramatically increase the safety of reactors. We believe at Lightbridge we are answering the main questions being raised by the voice of the customer in the nuclear power industry. And now I look forward to answering your questions. Thank you.
Okay, we're now opening our question and answer session with Lightbridge. Ticker symbol is LTBR on the NASDAQ. With us today we have Seth Gray, President and CEO of Lightbridge. Welcome, Seth.
Pleasure to be here.
We'll just jump right into the questions. We have quite a few. First of all, what is your biggest source of competition? Is it natural gas, renewable energy sources, or some other type of competition?
Everything that generates electricity is competition for nuclear power. Right now, we're working closely with utilities, and they're most concerned about plentiful natural gas, cheaper prices for natural gas. Lightbridge will improve the economics for nuclear reactors, produce electricity cheaper than with hydrofracking natural gas. So natural gas is very much a focus for us now, as well as simply making nuclear power cheaper than using the current type of fuel in reactors by switching to Lightbridge designed fuel.
Thank you. Our next question, who are some of the potential fuel fabrication partners?
Well, you know, it's publicly known that we're working with Babcock and Wilcox here in the United States, exploring building a pilot plant to manufacture commercial fuel for reactors using Lightbridge technology, and also that we work in Russia with Rosatom entities. We're also in discussions with other major fuel fabricators around the world, but those are the two main ones.
Thank you, Seth. Our next question, with the commercial nuclear energy industry growing fast internationally, which countries are you most likely your most likely prospective customers for consulting services?
Right. Nuclear power is growing very rapidly in Asia, in the Middle East, and across Europe. We're in discussions with utilities, with fuel fabricators, and with governments in those regions in particular, and also in some other places in the world. For our nuclear fuel, the United States for existing reactors is our largest market. We have 100 operating reactors in the U.S., more than any other country, and so we're certainly targeting U.S. reactors with Lightbridge's technology. The fastest growing single market for new nuclear reactors is China, and we're definitely targeting that. For our advisory services, in which we've already made $52 million in revenue advising governments, in particular we're working in East Asia, where it's been announced that, for example, we work in South Korea, and in the Middle East, where it's been announced that we work in the United Arab Emirates, among other countries.
Very good, thank you. Our next question, if the Obama administration is promoting carbon-free energy, is Lightbridge a candidate for any type of government grants or loan guarantees or any other type of support?
Lightbridge has received into our project some government financing support in the past. Going forward, it's more likely that our partners and customers would receive it. For example, in our work in the United Arab Emirates, you'll see Westinghouse doing some work there. They receive funding support from the U.S. government, which helps our client in the United Arab Emirates. For climate, there's definitely going to be growing government support from the U.S. and other governments, and utilities that reduce carbon emissions will be receiving various types of benefits from governments, including the U.S. government. So again, by working with us, we really enable some major corporations to receive those benefits rather than more likely going directly to Lightbridge.
Okay, thank you. And our next question, if members of Lightbridge's Nuclear Utility Fuel Advisory Board are telling you what attributes they want in a fuel or your fuel, does that mean that they will buy it when it's available? And will this type of member support accelerate NRC review and or approval?
Well, Lightbridge's Nuclear Utility Fuel Advisory Board consists of the top nuclear fuel managers at Exelon, Duke, Southern Company, and Dominion, which are four of the largest nuclear utilities. In fact, collectively they generate half of the nuclear electricity in the United States. So their advice is extremely important to us. They bring the voice of the customer right into our company, and their two biggest concerns are how do we improve the economics of nuclear power so that it's better for utilities, better for consumers, by competing and winning against natural gas and other generation methods, and how do we make nuclear power much safer, which is what Lightbridge's newly patented technology does. Yes, the testing that we're doing, benefiting from their advice, is generating the data that will be useful to the NRC when fuel fabricators and utilities apply for licenses and license amendments from the NRC. We do expect reactors in the U.S. to be among the very first to be using Lightbridge's technology.
Okay, thank you. And our next question, how much will be a typical technology licensing fee, and would all fabricators pay the same fee?
Siemens conducted an independent report that's available in the investor relations portion of Lightbridge's website, looking at what the licensing fee would be that would be paid to Lightbridge. They calculate about a $60 million benefit per year, every year that a reactor uses Lightbridge's technology, which we agree with. They predict a 10% royalty to Lightbridge, which would be about $6 million per year per reactor. We also think that's in the right ballpark from our own discussions with utilities, but that's very independent of us from Siemens, and you can read that report. So there will be, I think, different structures of deals with different utilities around the world, with different countries, but I think that's about the right ballpark. We will be a non-exclusive licensor.
Okay, thank you. And you mentioned Babcock and Wilcox earlier, but what is the status of the contract negotiations, and is an agreement still expected here in 2014?
Yes, the status is very good. We've been moving forward. We've determined the feasibility of the technology of moving forward toward a pilot scale plant and considering locations where it would be deployed in the U.S. at an existing Babcock and Wilcox site. And we definitely expect more major announcements of progress with Babcock and Wilcox this year.
Very good, thank you. And I guess just to wrap things up, you've already covered so many great points, but what's the main takeaway investors should have about the Lightbridge story?
The main takeaway of Lightbridge is that nuclear power has to be part of the mix if we're not going to increase carbon emissions, if we're not going to have air pollution here around the world, but it has to be safer and it has to be cheaper. Lightbridge's technology is the only way to achieve that. We're now in the process of proving it out. Our expertise has already been hired by several countries around the world for over $50 million of consulting business that we continue to provide, and we expect to announce some very significant milestones with major parties this year on the nuclear fuel deployment and development.
Very good. Thank you, Seth. And for our viewers, we were just listening to talking with Seth Gray, Lightbridge. The ticker symbol again is LTBR on the NASDAQ. You can find some more information at redchip.com, or you can visit Lightbridge's website as well and download a tremendous amount of information, as Seth was just referring to as well, on their investor relations page. If you want to sign up for email alerts, you can do that right here on the redchip.com underneath the presentation window. And that was actually our last presentation for the day. So we do want to thank all of our viewers who have joined us either for today or for both days. We will be making all of the videos available on an archive basis here in the next day or so. So please check back to redchip.com to catch any presentation that you missed or that you want to see again. And once again, I want to thank everybody for joining us for the RedChip Global Online CEO Conference.